Welcome back, listeners, to part 3 of the audiobook, Encyclopedia of Chart Patterns by Thomas Bulkowski. We're glad to have you with us as we continue exploring the fascinating world of technical analysis through chart patterns that traders and investors use to anticipate market behavior. In this segment, we'll cover chapters 21 through 30, diving into 10 distinct and powerful chart formations. Chapter 21. Cup with handle, a classic bullish continuation pattern that resembles a teacup. This formation signals a potential breakout after a period of consolidation. Chapter 22. Inverted cup with handle, the bearish counterpart of the previous pattern, indicating a possible downward breakout following a topping formation. Chapter 23. Diamond bottoms, a rare but highly bullish reversal pattern that forms after a downtrend and typically precedes strong upward moves. Chapter 24. Diamond tops, the bearish version of diamond bottoms, appearing at the end of uptrends and suggesting a trend reversal to the downside. Chapter 25. Diving board, a lesser-known pattern often characterized by a horizontal base followed by a sharp drop, a cautionary signal for potential breakdowns. Chapter 26. Double bottoms, atom and atom. This version features two sharp, narrow V-bottoms, both aggressive and indicating a strong bullish reversal. Chapter 27. Double bottoms, Adam and Eve, a mix of sharp and rounded bottoms, suggesting accumulation and potential breakout with varying intensity. Chapter 28. Double bottoms, Eve and Adam, similar to the previous chapter but with the rounded bottom first, providing a slightly different psychological setup. Chapter 29. Double bottoms, Eve and Eve, two rounded bottoms, indicating a more gradual and often more reliable reversal pattern. Chapter 30. Double tops, Adam and Adam. This chapter flips the theme, introducing a bearish reversal pattern made of two sharp peaks, a warning of potential price declines. Stay tuned as we explore each pattern in detail, learn how to identify them in real charts, and understand their historical performance. Let's continue our journey into mastering market patterns. Let's begin with Chapter 21, Cup with Handle.
Chapter 21, Cup with Handle. Results snapshot. Appearance looks like a cup profile with the handle on the right. The cup with handle pattern looks like, well, a cup with a handle on the right. Finding one is more complicated than that, but I simplified the identification guidelines to find patterns that are more prolific than the O'Neill version and work nearly as well. Several of his guidelines are oriented toward trading and not identification, so I exclude them. I'll discuss identification guidelines later in this chapter. With additional samples, the cup with handle pattern has shown good performance improvement, moving from a mid-list performer to posting a rate 2, ranking second where one is best. I require at least 150 bear market samples to include in the statistics, but I couldn't find enough cups to qualify. So this chapter only describes bull market results. Tour. The cup with handle pattern was popularized by William J. O'Neill in his book, How to Make Money in Stocks, McGraw-Hill, 1988. Figure 21.1 shows an example. The stock climbed 295% in about 2 months, computed from the right cup rim to the ultimate high. The stock began rising in early August at a price of about 5.50 and climbed steadily until it bumped up in early December. Volume, incidentally, was very high for the stock at this stage. The stock climbed robustly, then rounded over and plunged back through an earlier trend line, completing a bump and run reversal bar top. During the stock's climb, it reached a high price of 26.88 during late December and a low of 12.38 after the bar top, a loss of 54%. The rise and decline formed the left side of the cup. Over the next 2 months, price meandered upward and pierced the old high during late March. The rise in price to the old high completed the right side of the cup. Profit-taking stunted the climb, and price moved horizontally for almost 2 weeks before resuming its rise. This movement formed the cup handle. Incidentally, the handle in this pattern is a high, tight flag chart pattern. Volume during formation of the handle was down-sloping, higher at the start and trending lower. When price closed above the right cup rim, a breakout occurred. This accompanied a surge in volume that propelled price higher. However, a week after the breakout, price threw back to the handle top before continuing upward. This throwback allowed nimble traders the opportunity to enter new positions or add to existing ones. By late May, just 44 days after the breakout, the stock reached the ultimate high of 120. Identification guidelines. Table 21.1 shows the identification guidelines I used to find the cup with handle pattern. Appearance. looks like a cup profile with the handle on the right. U-shaped cup. Judging whether the cup is V or U-shaped depends on the experience of the person looking at the chart, and to some extent, on the software used to display it, the aspect ratio. So it's an objective interpretation. Mostly, I found patterns with rounded turns and removed V-shaped ones. Figure 21.5 shows a cup with a rounded turn more V-shaped than I like to see. Use the other figures in this chapter as guides. Uptrend. I don't recall excluding any cups with price trending down, such as an inner cup, but you'll want to see price rising into the start of the pattern. O'Neill looks for a 30% rise to the start of the pattern, but that's a trading style and not an identification guideline. If price entered the left cup rim from the bottom, then I was happy with that, without the need for a 30% rise. Handles. A cup with handle without a handle is like peanut butter without jelly. I required my cup with handle patterns to have a handle. After cataloging nearly 1,000 of them, I let the statistics determine the size of things, such as the handle length. The minimum handle length is 1 week with a median length of 22 days. I measured the length of the handle as the span from the end of the cup to the breakout. The median ignored outlier patterns where price took months to break out. Handles shorter than the median associated with better performing cups. I also eyeballed the handle to make sure it formed in the upper half of the cup. Cup rim. I look for the two cup rims to peak near the same price. Sometimes the handle was above the left cup's rim, and sometimes it remained below. I didn't want the pattern to look like an ascending or descending scallop, where the right side of the cup only reaches halfway up the left side. Breakout direction. The breakout direction is upward when price closes above the right rim or handle high, whichever is higher. Downward breakouts, where price closes below the bottom of the cup, invalidate the pattern. Duration. I kept the cup duration to about 15 months or less. Figure 21.2 shows another good example of the cup with handle pattern on the daily scale. The cup gently rounds up, and price climbs just beyond the left rim before pausing. Price drifts down in the handle, along with a downtrending volume pattern before the breakout. Then volume surges, and price moves upward. 2 days after the breakout, price moves marginally lower again and enters the region of the right cup rim. After a brief throwback, price is soon on its way again. Less than 2 months later, the stock tops out at 15.50 for a rise of 22%. Figure 21.3 shows a cup with handle pattern on the weekly scale. When I was searching for cups, I found that weekly scales provide an easy way to identify many of the patterns. Of course, I also looked at daily price data to refine the weekly patterns and identify new patterns that I may have missed. The chart shows an example of a cup with handle in which the rise falters after rising just 11%. Fortunately, after declining back to the handle base, the stock recovers and goes on to form new highs. Ultimately, the stock gains 52%. The figure also highlights an inner cup. The left rim sees price trending downward into it instead of upward. The handle lasts just 2 weeks too. However, inner cups offer wonderful trading opportunities because they allow traders to get in on the ground floor of an impending rise. Even if price only rises to the height of the outer left cup rim, the move can be significant. Focus on failures. Like most chart patterns, cups fail because of the inability of the stock to rise by more than 5% before declining. Figure 21.4 shows an example. The nicely shaped cup forms after an extended price rise from 33 to 45. The two cup rims are at about the same price level. The handle seems to form a small cup of its own, but no handle. Price moves up sharply in late September and breaks above the right cup rim before continuing higher, but only briefly. The stock tops at 47.88, moves horizontally for about 3 weeks, and then starts down. 2 months later, the stock hits a low of 37.63. The rise after the breakout is slightly less than 5%. I classify as a failure a stock that does not continue moving higher by more than 5% in the direction of the breakout. Why do cups fail? Remember that the failure rate for cups is low, just 5%, ranking second out of 39 patterns, where one is best, fewest failures. That's a low failure rate, or the other patterns have atrocious failure rates, depending on whether you're a half-glass full/empty person. The answer to the question is manifold. Overhead resistance can stop price from rising. Because cups tend to be long patterns, fundamentals may change, which sends the stock crashing. The industry might develop supply problems for a main ingredient to a product the company makes more common as price rises for the feedstock. The general market may turn down or become a bear market. Anything can happen. Often it's as simple as the company failing to beat earnings estimates. Later in the chapter, we'll see failure rates and discuss them. Let's talk numbers. Statistics. Table 21.2 shows general statistics for cup with handle patterns. As I mentioned earlier, I removed bear market statistics because I didn't find enough examples to be comfortable commenting on them. They might be offended. Number found. I found 995 cups in 645 stocks, with the first cup in September 1991 and the most recent in January 2018. Only 913 of those were from bull markets, so that's what I reported on. Reversal R, continuation C occurrence. A definition: with price rising into the pattern and an upward breakout, a continuation of the prevailing price trend results. Average rise. The average rise is yummy, but the median rise not shown is an earthbound 34%, Standard & Poor's 500 change. I compared the rise in the index with the move from the date of the cup's breakout to ultimate high. The index underperformed the cup with handle pattern during the same time period, days to ultimate high. Because the rise is robust, it takes a long time for price to reach the ultimate high, about 10 months. The median time is half that though. How many change trend? Here's where the pattern really shines. Over 2/3 of the patterns will see price rise by more than 20%. Very nice indeed. Table 21.3 shows failure rates. Cups show failure rates that climb rapidly as the maximum price rises. For example, 5% or 48 patterns see price fail to rise more than 5% after the breakout. An additional 68 patterns, combined with the prior 48, means 13% will fail to see price rise more than 10% after the breakout. Half the patterns will fail to see price rise more than 35%. Even though the rise from one row to the next seems big, it's much better than for many other chart patterns. Table 21.4 shows breakout-related statistics. Breakout direction. By definition, if you don't have an upward breakout, then you're not looking at a cup with handle. A breakout happens when price closes above the right cup rim or handle high. Yearly position performance. When I saw the average rise of 238% for patterns within a third of the yearly low, I thought it was a typo. It's not, but it's based on just 5 samples. Even the 58% gain uses only 29 samples, so it's tiny too. Most of the patterns will have breakouts within a third of the yearly high. Throwback occurrence. Price throws back to the breakout price or comes close to it almost twice in every 3 trades. It takes price a dozen days to make the round trip and half that time to see price rise an average of 5% before starting on the return journey. Patterns without throwbacks, which see upward momentum work for them, perform better than do those with throwbacks. That's typical behavior. After a throwback completes, price resumes, rising nearly all of the time, except for the stock you own. Doesn't it seem to work like that? Gaps. Cups with breakout day gaps don't see the kind of boost traders expect, only 1 percentage point between gaps and no gaps. Table 21.5 shows pattern size statistics. Height. Here's where things get weird. Most patterns see tall patterns outperform short ones, but not cups. It's the reverse. I measured the height of the pattern from highest peak to lowest valley and divided by the breakout price, the highest peak. If the result was bigger than the median shown in the table, then the cup with handle pattern was tall. Width. Patterns narrower than the median width shown in the table outperformed by a substantial amount. Usually wider patterns show a small performance edge over narrow ones, but not with cups. Width includes both the rounded cup and the handle. Height and width combinations. We've seen that short cups outperform and narrow cups outperform, so you'd expect the combination of short and narrow cups on average to be the best performers. Nuo. Tall and narrow ones do best. Short and narrow places second. In last place are cups both tall and wide, which is usually the best performer. Table 21.6 shows volume-related statistics. Volume trend. Volume trends downward most of the time, but the result is not far from random. Does the trend direction really matter? rising/falling volume? The answer to the above question is no. The performance difference between cups with a rising volume and those with receding volume is 2 percentage points. That's probably because the pattern is so wide that any volume pattern will appear irregular. Linear regression, which is what I used to determine the trend, set the record straight, so I didn't have to guess. Breakout volume, heavy breakout volume, light breakout volume. The cup with handle pattern showed no preference in my tests. Table 21.7 shows how often price reaches a stop location. I split the pattern in half and hope it didn't hurt. I checked how often price returned to one or more of the locations shown in the table as price made its way to the ultimate high. Price returned to the top of the pattern nearly all of the time, so a stop-loss order placed there would trigger frequently. The middle and bottom of the pattern almost never saw price drop that far. Thus, a stop placed at either of those locations would work well, except that the potential decline might be too large. So do check the drop and see if you can tolerate such a loss without having a coronary. A handy stop location is below the handle low. I checked it to see how well the location worked. A stop placed a penny below the handle low would trigger 21% of the time. That sounds a bit high to me, but it will keep the loss reasonable, but check that too. Table 21.8 shows the performance over 3 decades. This table interested me because I wanted to see the performance over time, because the cups in this new edition perform much better than the ones I found in the second edition, which I wrote in the early 2000s. Performance over time. Performance has been improving steadily over the years. So it's not my imagination that cups perform better now than the ones I looked at 15 years ago. Failures over time. I counted how many patterns failed to see price rise more than 5%. The failure rates are stable over the 3 decades. Table 21.9 show busted pattern performance. Busted patterns count. Few patterns bust 10%, which is refreshing. With some other chart patterns, you need supplemental oxygen because the busted count can take your breath away. No so with cups. Busted occurrence. I sorted cups by how many times they busted, single, double, and more than 2, triple plus. Most of the busts are single busts. That doesn't surprise me, but with a pattern as tall as a cup with handle median height 23%, I would expect fewer double and triple plus busts than that shown. Obviously, some cups struggle to find a trend direction. Busted and non-busted performance. Because there is not a cup with a downward breakout, I don't show non-busted performance in the table. I only compare single busted patterns with all 3 varieties, single, double, and triple plus. The negative sign means price dropped, and it's a measure of how far below the bottom of the cup price falls on average. Trading tactics. I show 2 tables of trading tactics. Let's begin with the usual one for chart patterns, shown in Table 21.10. Measure rule targets. The measure rule predicts the price to which the stock will rise. The traditional method involves determining the height of the pattern from lowest low in the cup to the high at the right cup rim. Adding the height to the high at the right cup rim gives the target. How often does this work? The bottom portion of the table shows the answer, depending on the height used in the calculation. A full height, as described above, works 64% of the time. If you take half the height and apply it in the same manner, you'll get a closer target. Using 2 or 3 times the height gives a target farther away, one that price may struggle to reach. Once you know the target, measure the distance from the current price to the target and change it into a percentage. For example, if the target is 54 and the current price is 45, that's a move of 9/45 or 20%. Page back to Table 21.3 for a sanity check. How often will price fail to rise more than 20%? Answer: 31%. So you have a probability of making money 69% of the time, and that's if you trade it perfectly, and it behaves like the cups I looked at. If I didn't look at them, would they behave better or worse? That's like saying Heisenberg may have slept here. Figure 21.5 weekly scale is an example of the measure rule in practice. Compute the cup height by taking the difference between the right cup high point at 19 and the cup low point B at 10. Add the difference 9 to the right cup rim to get the price target, 28. Mid may see price hit the target but plummet the following week. A more conservative price target uses half the formation height. This method gives a target of just 23.50, reached during early July. The stock climbs to the nearer target quickly and without the severe declines experienced on the way to the more risky, higher price target. Buy inner cup. Figure 21.5 also shows an inner cup. If you are going to trade this chart pattern and can identify an inner cup, buy it. An inner cup appears as two widely spaced minor highs that are at about the same price level. You score as the stock advances to the old high, the price of the outer, left cup rim, and further if the outer cup with handle pattern succeeds with an upward breakout. Playing the inner cup, shown in figure 21.5, would have boosted profits about $2 a share or 12%. Stop location. Once you initiate a trade, place a stop-loss order 15 cents below the handle low. Note table 21.7 places the stop a penny below the handle, so the stop triggers slightly more often. The handle is a place of support, and sometimes declines will stop at that point. Placing a stop just below the handle low will get you out of those situations when the stock continues tumbling. However, price will trigger the stop an average of 18% of the time, so you'll have to decide if that's the right location or not. Table 21.11 shows special features based on the cup with handle pattern. I played with handles and rims and checked performance. Handle height. I measured how far down the handle price dropped below the right rim, 7% median, and then compared the performance of those patterns with tall or short declines. Cup patterns with short handles outperformed those with tall handles. In other words, if price does not retrace far in the handle, performance improves. Handle length. I measured the duration of the handle from the right rim to the breakout and found the median was 22 calendar days. Handles shorter than the median saw performance better than patterns with wider handles. Higher rim. I separated cups into those with higher right rims and those with higher left rims. Those with higher right rims performed better after the breakout. Experience. The following describes some of my experience with the cup with handle pattern. Rowan Companies. In December 2006 and into May 2007, Rowan Companies RDC formed a cup with handle that also looked like a double bottom. I had a buy stop placed 2 cents above the top of the handle. The day it broke out was the day I bought. From my notebook, buy reason, cup with handle / rounding turn in hot industry. Every chart pattern is a sell did I mean buy signal, and so I'm going to take this one. The upside will be 44, so I stand to make $5 per share on the trade if all works as planned. Downside is stopped out at the volatility stop setting of 35.45. Yuck. At an entry price of 39.11, downside is 12% and that's too far. Let's keep the stop loss at 10%, so that would make the stop 35.20. Upside is 13%, not a large ratio. Yesterday I didn't feel good about this trade, so I called it off. Today I'm looking to buy something in a hot industry. Sounds like this trade is going to be a dud. The stock climbed a wall of worry in a series of steps. Perhaps it was me worrying. 6 weeks later I wrote this. Sell reason. Yesterday I noticed that many stocks in the industry and the other oil industries had topped out and were heading down. I did a survey and found that 11 of 14 in the oil field, 9 of 10 in the integrated petroleum field, and 6 out of 6 in the producing field were trending down. That's 26 out of 30. I can't expect Rowan to buck against such a trend. It's time to take my gain and exit as best I can. I made 6% on the trade, about half of what I expected. If I wasn't frightened out of the stock and held on until it peaked, it would have reached my 44 target and kept going up to 46.16. If I sold at the peak, I would have made 18%. But selling at the peak would have represented a perfect trade. Lesson. Not all cups with handles see big gains. Median rise is 34%. Lesson. This trade would have benefited slightly by using a trailing stop placed a penny below the prior day's low. I was proactive in this trade by looking at other stocks in this industry and similar industries, but that turned out to be a mistake. It forced me out of the trade almost a month too soon. Lesson. Watch other stocks in the same industry for insights of how your trade may unfold. EMC Corp. After a nice rise from 9 to 15, EMC Corp. EMC formed the left lip of a cup with handle at the start of 2005. The cup completed the right handle in June. The bottom would have looked at like a complex head and shoulders bottom multiple heads if price didn't spike downward for 2 days in April. Here's my notebook. By reason, a perfect cup with handle. I'm buying before confirmation because I feel strongly about this one. On the weekly chart, The Jan 2005 peak pokes through a long-term downtrend line. If this stock can finally push through that resistance, the sky's the limit. I might buy more if that happens. Score +3 for 18.19 target. Only two problems, a weak market and lack of confirmation yet. Before the open on 7 July 2005, terrorists exploded 4 bombs in London. I thought that would cause the stock to gap lower on the open and then recover through the day. It turns out I was right as I got a fill 14.22, much lower than yesterday's close, 14.48. A week later I was out. Sell reason, I believe this has formed a lower high. That suggests a short-term trend change. Since I have a profit, I thought I'd cash out now and wait for it to go down, then recover. When it breaks out of the long-term downtrend line, then it might be worth another look. I made 2% on the trade, but it was a good thing I sold. The stock tumbled and broke out downward from the cup pattern, bottoming at 9.44 or 35% below where I sold. My instincts on this trade were good. Lesson: sometimes when price fails to follow through to a new high, it means a trend change. CNO Financial. This trade was a mistake. CNO Financial, CNO, started forming a cup with handle in October 2009. In March 2010, the stock completed building the right rim. Then it went to work on the handle. It completed the handle in the middle of April when I bought. Buy reason, possible cup with handle, good profit potential for a long-term hold 3 times, triple my investment, and only own 3% of this. I wanted to spend some of the dollar I have collecting almost no interest. The word possible is a warning. The cup never broke out upward, at least not before I bought. The stock retraced its gains, dropped as low as 12 cents above the bottom of the cup and recovered. During July 2010, I worried over the stock. 5 July. I don't know what to do with this stock. I can see it going down to 2. One insider bought at $5.94, 41K shares, and the stock is about $1 lower. If this breaks support at 4.18, then it's a sell. I put a conditional order to sell at 4.13 until 6 September 2010. The price is just below the low in February. From 7 July to a week later, I raised the stop almost daily. I am canceling the stop because the market wants to go higher, and this still has great upside potential. The stock formed another cup throughout 2010, another in 2011-2012, and finally broke out upward in the summer of 2012. The stock moved higher, not a straight line run upward, but a nice climb nonetheless. My notes to the buy said the stock targets were 8, 10, 17, and 20. I bought at 6.52, and when the stock started moving up, it was at about 8.50. It had pierced the resistance at 8. The stock paused at 10, as predicted, blew past 17 to reach 19 where it retraced, and moved sideways with a floor of about 16. Fast forward to 26 September 2015. Sell reason, diversification. Zach says the company is overloaded with debt, and another broker report says debt is above industry average. If this stock should DCB, it would be a tragedy, but it only makes up 8% of my portfolio. Nonetheless, it's time to sell a bit. The stock hasn't done anything since 2014, so maybe it's time to find something that will do well going forward. I made 195% on the trade, almost the triple I was looking for. Lesson: sometimes mistakes turn out well. Lesson: if a stock isn't performing as expected, consider selling, but also recognize that stocks need time to regroup before moving higher, especially after sharp gains. Sample trade. Cody is in high school. He is not sure what he wants to do for a living, but he still has a few years to figure it out before he graduates. And he is not chasing cheerleaders. He either has his nose buried in the financial websites or is reviewing charts on the computer screen. His interest in stocks follows in his father's footsteps. The man works for a brokerage firm and taught Cody the ropes. Although Cody does not belong to the investment club at school, he pals around with the players. One day, he overheard them talking about the stock pictured in figure 21.5. At first, he did not think much about it until he looked deeper. That is when he saw a cup with handle pattern. He was not convinced the stock was a good trade and did not have the money to buy it anyway. He decided to paper trade it to see what he could learn. On the daily time scale, he saw an inner cup forming at point C, so that is the one he decided to trade. Week after week, he waited for the buy signal that did not come. Eventually, the stock climbed above the right cup rim, but he missed it. When he pulled up the stock chart on his computer, a throwback had already occurred, so he waited for price to climb above the cup rim again. That happened on 9 May, his girlfriend's birthday. Sensing a positive omen, he made a notation to buy the stock on paper at the closing price the following day, filled at 15.25. When he met his girlfriend the next day, she was not impressed with the birthday present he gave her, and the stock closed lower as well. 2 weeks later, the stock was moving up. Cody placed his stop 15 cents below the handle low at 14.38 which also marks the purchase point. When the stock climbed above the outer cup, he raised the stop to 17.50. Then he noticed a problem forming, a right-angled broadening top formation. It was a bearish signal, so I raised my stop to just below the base at 20.25. Then he waited. He got word that the stock was in trouble from his pals. They were not too happy with the company for some reason. When he pulled the stock up on his computer screen, he noticed that it had hit his stop in late August when price momentarily dipped. Cody whipped out his calculator and tallied up his gains. He made $5 a share for a gain of over 30%. He chuckled to himself that next time he would use his paper profits to buy his girl something other than cubic zirconium. Chapter 22, Cup with Handle Inverted. Results Snapshot. Appearance, price follows the shape of an inverted cup followed by a handle. To find this pattern, I had 2 things to work with, a picture of an idealized inverted cup from a website and 1 line of text describing it. That was enough. I searched through my databases for the pattern, created some identification guidelines, and then gathered statistics. The pattern performed better than I expected. As the accompanying results snapshot shows, in bear markets the pattern has a 9% break-even failure rate, ranking 10th out of 19, not shown. The average decline is 23%, a good showing for a bearish pattern. The performance ranks are even better. They are close to the best performance, a rank of 1. The percentage meeting price target is based not on the height of the pattern, but on the height of the handle to boost the success rate. Subtract the handle's height from the right cup rim to get a target. Let's whip out our magnifying glasses for a closer look. Tour. Figure 22.1 shows an example of an inverted cup with handle pattern, I-cup. The pattern looks like a rounded top, but includes a handle on the right side of the pattern. This particular handle is narrow and tall, retracing from it to be a significant portion of the decline from the top of the pattern to the right cup rim point A. Price continues dropping, confirming the pattern as a valid one when it closes below the right rim. The figure shows price gapping lower breakaway gap on high volume, but do not expect such behavior. Once the I-cup confirms, price drops but usually not as steeply as that shown. Identification Guidelines. Table 22.1 shows identification guidelines for I-cups. Refer to Figure 22.2 as I discuss them. Appearance. Imagine a teacup flipped upside down with the handle on the right. That's what an I-cup pattern looks like. Rounded cup. I did not check the performance of rounded cups versus V-shaped ones. However, I tried to limit my selections to the rounded shape. I consider Figure 22.2 to have the V shape, but used it in the study anyway, and the other figures in this chapter to be rounded looking. You may find it easier to picture an inverted teacup or coffee cup in your mind as you search for the pattern. Cup rims. The cup rims are points and B in the figure. Few patterns I looked at had the same price across the rims. Price in the bottom of the pattern varied by a median of 2%. Cup handle. I define the cup handle as the price movement from the right cup rim to the breakout, that is, until price closes below the level of the right cup rim. In the figure, the handle is from point B until almost May. The handle length is a median of 30 days, so that gives you some idea of how long handles can be. Expect variations. Cup retrace. I followed 2 rules. 1, the handle could not rise above the cup top, and 2, there must be at least some rise, a bounce to the stock after the right rim hits bottom. The most common retrace is listed in the table. That is, price climbed up a portion of the cup during creation of the handle before returning to the breakout. Breakout direction. You must wait for the breakout with this pattern before trading. Too many of the patterns I looked at had price moving upward instead of downward, especially in bull markets. A breakout is a close below point B, the lowest low on the right rim. Confirmation. The pattern confirms when price closes below the right rim, stages a downward breakout. Figure 22.3 shows another example of an inverted cup with handle. This I-cup has uneven rims and a top that is really an eve and eve double top chart pattern with a diamond bottom, not highlighted, nestled between those two peaks. The inverted cup makes a gentle swing upward from A to B. Points and B are 9% apart in price. That is wider than I like to see, but I consider it a valid I cup. The handle forms a second bump well below the main cup, but this one has an irregular shape. Focus on failures. What do failures look like, and what causes them? Figure 22.4 shows one type of failure, an identification failure. The cup appears in an upward price trend, suggesting it will act as a reversal after a downward breakout. The cup itself is rounded with rims that bottom 5% apart in price. That is close enough for government work, as the saying goes. The pattern qualifies as an I cup with one glaring exception. Do you know what it is? As you probably guessed, the breakout is upward, it should be downward. Had you shorted the stock in the handle, you would be looking at a loss. The image is a glaring example of why you should wait for the breakout, especially when considering a short sale. Figure 22.5 shows the next example of a failed trade. Running through the identification guidelines, the price trend leading to the pattern is flat, but that's okay. The cup is rounded with rims at the same price. The handle has an upward bounce that measures 61%, close to the Fibonacci retrace of 62%. The breakout is downward, as required by the guidelines. However, price drops just 3% before rebounding. What happened? Looking back on the weekly scale shows extensive support and resistance beginning in mid-1999, not shown, and lasting for a year at 6.50. That price is also where the rim of the I cup formed. When the downward breakout occurred, price ran into stiff support and stopped declining 3% below the breakout. This is a good example of how important stops are when trading short. After opening a short position, place a stop just above the prior minor high or above a nearby resistance zone. Do not place it too close, or you will be stopped out on normal price volatility. Using a stop would have saved a trader from an embarrassing loss. Why do these patterns fail? No one knows for sure, and the reason varies from pattern to pattern. A good earnings report, one that beats expectations, will send a stock higher. Other fundamental factors such as good same-store sales, the win of a new contract, or even a takeover bid by another company will stop a decline. Statistics. Table 22.2 shows general statistics for I cups. Number found. I found the first pattern using data from August 1991 to November 2017 in 591 stocks and cataloged 944 patterns. Not all stocks covered the entire period and some no longer trade. Reversal R, continuation C occurrence. In bull markets, a slight majority act as reversals of the upward trend. In bear markets, the pattern acts as continuation patterns half again as often as reversals. Reversal/continuation performance. The performance difference between I cups acting as reversals and continuations is minor, 2 percentage points in bull markets and no difference in bear markets. Statistical differences of a percentage point or two are common for downward breakouts in all pattern types. Average decline. The performance of this pattern is above the averages posted by other bearish chart pattern types. That's why the performance rank is as low as it is low is good. Standard & Poor's 500 change. You can see how the general market influenced the average decline. In bull markets, it helped the decline but only marginally. In bear markets, it helped dramatically, or so the theory says. Days to ultimate low. I checked the velocity of the decline in bull and bear markets and found that price dropped 2.5 times as fast in bear markets as in bull ones. Trade with the trend downward in bear markets. How many change trend? Values above 50% are terrific for upward breakouts, but they are very rare for downward breakouts. And yet we see that 57% of I cups in bear markets see price drop more than 20%, a trend change. That's exceptionally good. Even the bull market drop beats the average of 28%. Table 22.3 shows failure rates for I cups. I found that in bear markets, just 9% of the I cups failed to see price drop more than 5% after the breakout. As you scan down the list, notice that failure rates skyrocket. 21% will fail to see price drop more than 10%. That's double the prior row's failure rate. The bull market numbers for the first two rows are double the bear market rates. Half, 52%, will fail to see price drop more than 15%. If you want to make money trading this pattern, Then concentrate on finding it and trading it in bear markets. Table 22.4 shows breakout-related statistics. Breakout direction. By definition, the breakout is downward from the I cup. The breakout occurs when price closes below the right cup rim. Yearly position performance. Does performance change depending on where in the yearly price range the breakout occurs? The answer seems to be that the lower the breakout appears in the yearly price range, the better the performance. That's clear in bull markets, but bear markets muddle the numbers. Pullbacks. A pullback occurs between 60% and 67% of the time on average. During the average pullback, price drops 5% to 9% below the breakout in 6 days before returning to, or coming close to the breakout price for a round trip of 12 days. When a pullback occurs, performance suffers. You can see the effect in the table. Look for nearby support zones, regions that might repel the downward move before taking a position in the stock. Gaps. I cups with gaps show improved performance after the breakout, but only in bear markets. Table 22.5 shows pattern size statistics. Height. Tall patterns perform better than short ones, but the performance is marginal and it applies only to bull markets. To use this observation, compute the formation height by taking the difference between the top of the I cup and the lower of the two rims, and then dividing the height by the price of the right rim low. If the result is higher than the median shown in the table, then the pattern is tall. Otherwise, it's short. Width. I didn't see any performance difference after sorting the patterns by width. Height and width combinations. Tall patterns perform better than short ones, but the differences aren't substantial. Table 22.6 shows volume-related statistics. As you scan down the table, notice that the performance difference is minor, regardless of which category you are looking at. Thus, volume is not a good predictor of performance of the I cup, at least for the samples I used in the study. Bear markets show no performance difference at all. Volume trend. Volume trends downward most often, but the results are about random. Don't throw away a pattern just because volume trends upward. Rising/falling volume. Patterns with falling volume in bull markets tend to see price decline a bit more than for their rising volume counterparts. Breakout day volume. Light breakout day volume helps performance bull market only, but the performance boost is negligible. Market lore says heavy breakout day volume helps performance, but we don't see that here, nor in some other chart pattern types. Table 22.7 shows how often price reaches a stop location. You can use these numbers to help locate where a stop-loss order should be placed to protect profit and limit losses. I checked how far price climbed after a downward breakout on the way to the ultimate low. I did find one pattern in a bull market that made it back to the top of the I cup, but it didn't make an impact on the numbers shown, 0% shown. If you place a stop order at the top of the highest peak in the handle, your stop will be triggered between 6% and 11% of the time on average as price searches for the ultimate low. You can see the hit rates for other locations in the pattern. Table 22.8 shows the performance over 3 decades, performance over time. Because bear markets only occurred in the 2000s, the numbers are not included in the table. The 2010s showed the best performance for I cups, and the 2000s showed the worst, failures over time. As one might expect, failures were highest in the 2000s and lowest in the 2010s. That makes intuitive sense because performance was worst in the 2000s, more failures, and best in the 2010s, fewer failures. Table 22.9 shows busted pattern performance. Busted patterns count. The I cup pattern has comparatively few busted patterns, especially in bear markets. Busted occurrence. Of the patterns which bust, most of them are single busted patterns, but notice that triple busted patterns, triple plus, which means busted more than twice, place second. Busted and non-busted performance. Because I cups only break out downward, there are no non-busted I cups to compare the results to. Single busted patterns perform better than 1, 2, and triple plus combined. Trading tactics. Table 22.10 shows trading tactics. Measure rule targets. To get the measure rule to give good success rates, I decided to use the height in the handle subtracted from the right rim low as a target. Ignore values below 0 and convert the height as a percentage of the right rim low to see if the projected decline is reasonable. Use Table 22.3 to determine the chance of price declining that far. For example, Suppose the handle price peaks at 20, and the breakout, the low at the right cup rim, is at 17. Subtract the difference, 3, from the right cup rim, 17, to get the target price of 14. A drop of 3 points in a $17 stock is a drop of 18%, which sounds reasonable. However, Table 22.3 shows that in bull markets, about 60% of stocks will fail to see price drop that far. The lower portion of the Table 22.10 shows how often various heights change the success rate. Using the full height like I did in the example, price will reach the target 62% of the time on average. Of course, your mileage may vary. Head and shoulders. Look to the left of the cup to see if another handle looks like the one on the right. If so, then you may have a head and shoulders top. Consult the head and shoulders top chapter for more information on trading that chart pattern. Open short. This reminds me of the time I tested my new circuit board for the Patriot Air Defense System. Each time I applied power to the board, the breaker tripped. I discovered that the layout people wired power to ground. Oops. When price closes below the right rim low, open a short position. Be sure to use a stop or other method to exit the stock in case price rises. Close short. If price drops quickly, a straight line run of several points in a few days, consider closing out your short when price stops declining. Sometimes the snapback rally sees price rebound quickly. Trend line. Another exit method is to draw a trend line down the right side of the cup, touching the top of the handle and extended lower. After a downward breakout, the slope of the decline will usually be steeper than the slope of that trend line, so price drops below the line. When price closes above the trend line, exit the trade. If price forms a new trend downward, one steeper than the cup to handle trend line, draw a new down-sloping trend line along price peaks. When price closes above the new trend line, close out the position. Measured move down. Look for a measured move down chart pattern. In some cases, the handle is the corrective phase of a measured move. If the second leg of the pattern mirrors the length or the first leg, be ready to close out the short. See the measured move down chart pattern for details. Stop location. Consult Table 22.7 to see if placing a stop above the handle might work as a stop location. Before placing a trade, convert the potential loss into a percentage to see if you can tolerate the loss. Busted trade. I-cups that bust tend to make large moves upward during recovery. Trading a busted pattern might make more sense than trying eke out a small profit from shorting. Sample trade. Sam, short for Samantha, works as a blackjack dealer in Las Vegas. She takes the money earned from tips and invests it in the stock market. In the decade since she started tossing cards, she has built a tidy nest egg. Figure 22.6 shows an inverted cup with handle dealt her and how she traded it. First thing Sam did was to qualify the pattern. Did it meet the identification guidelines listed in Table 22.1? Quickly running through them, we find that the cup looked rounded with rims uneven but not too far apart in price. The handle showed a distinct bump up in May, but some distance away from the cup. She did not know if this made any difference. The handle retraced 69% back toward the high at A. Patiently, she counted cards until the odds stacked in her favor. When price closed below the right cup lip, I shorted the stock at 7.90. The following day's tall trading range bothered me, but the close was in the middle of the intraday range, so it was not a one-day reversal. Fortunately. Price eased down each day, but not quickly enough to suggest a sale, attempted a pullback at the start of July, but soon continued lower. After a few weeks, I drew a trend line down, as shown in the figure. I measured the cup height and handle height as a kind of target window, both subtracted from the right rim low, but found that price had declined below the window. So I placed a stop-loss order at 6.10, a few cents above the brief pause in mid-July. The cup target in the figure points to just above her stop price. After her shift ended each night at the casino, she logged onto the web and updated her chart. When price jumped upward in late July, the stop took her out at 6.10. She made about 22% after commissions. Chapter 23, Diamond Bottoms. Results snapshot. Appearance, diamond pattern forms after a downward price trend. How is a diamond bottom like asking a girl out on a date? When dealing with either, it's all in the approach. Diamond bottoms have price entering the pattern from the top, heading down. Diamond tops have price entering from the bottom, trending up. What more is there to know? Plenty, and the results snapshot just scratches the surface. Based on what we see in the results snapshot, diamonds favor downward breakouts. Show the best performance of any chart pattern, but upward breakouts are closer to the worst performance. Break-even failure rates, a measure of how often price fails to move more than 5% after the breakout, are close to one another, with downward breakouts suffering a bit more than upward breakouts. Pull out a loop, and let's take a closer look at this chart pattern. Tour. Figure 23.1 shows an example of what a diamond bottom looks like. Notice that price trends downward into the pattern, the diamond appears, and then price reverses in this example. Price dropping into the pattern from the top means it is a diamond bottom and not a top. I ignore any overshoot and undershoot in the week or two before the pattern begins. Overshoot and undershoot are like having a pullback or throwback precede the start of the pattern. See the glossary for an example of overshoot or undershoot. The diamond bottom begins with price tracing higher highs and lower lows, then the process reverses. The price range narrows until the breakout occurs. Volume throughout the chart pattern is diminishing. The breakout usually sports a significant rise in volume. The figure shows high volume on the breakout when price gaps through the diamond trendline boundary. There are 3 gaps along the upward breakout trend. The first is a breakaway gap. The middle one, when price pierces the top trend line, is a continuation gap, and an exhaustion gap ends the uptrend. In less than 3 months, the stock climbs over 20% to a high of 22.25. A diamond bottom represents the struggle between buyers and sellers. Buying demand pushes price up to a new minor high until selling pressure forces price back down. If selling pressure is strong enough, price drops to a new minor low. The widening pattern continues, but usually not for many swings. On the right half of the diamond, greedy holders, seeing a good price for the stock, sell, and the price rise stops, turns around and drops. Sellers buy but do so before price makes a new low. They are excited about the stock and buy in before price can reverse and leave them without a position. This activity blunts the downward momentum and creates a higher minor low. Thus, price begins narrowing on the right side of the diamond. Eventually, one of the warring parties will win, and overwhelming buying demand or selling pressure will cause price to break out of the diamond pattern. Price continues in the breakout direction until it pauses several points beyond the diamond boundary. For upward breakouts, the pause may be frightening enough that holders sell, driving the price back to the diamond trend line, a throwback. For downward breakouts, buying demand from traders believing they are getting the stock at fire sale prices creates a pullback. The smart money knows the score and takes the last opportunity to dump their holdings. This additional selling pressure forces the stock down again, usually for quite some time, weeks to months. That is the life of a diamond. Identification guidelines. Do you identify a diamond bottom? Review the identification characteristics shown in Table 23.1. The hardest part of identifying any pattern is seeing the shape price makes. For diamonds, they are especially difficult to identify. However, they occur many times at price turning points. Thus, look for diamond bottoms at the end of a downward price trend. Appearance. When prospecting for diamonds, look for price to widen out over time, forming higher highs and lower lows. The price pattern should look like a broadening bottom chart pattern. Then, price narrows, forming lower highs and higher lows. The second half should look like a symmetrical triangle. If you draw trend lines around the minor lows and highs, the result should appear diamond-shaped. Don't expect perfection. More likely, the diamond's top or bottom will be pushed to one side as if a gust of wind was playing games. Also, I don't set a minimum trendline touch count. One of the trend lines may have only one touch in a minor high or minor low. The other trend lines may have 2 touches, but the diamond shape should be apparent. Use the figures in this chapter as guidance. Price trend. Since we are dealing with diamond bottoms and not tops, the prevailing price trend is downward leading to the diamond. Ignore any overshoot or undershoot in the week or two before the diamond begins when trying to gauge the inbound price direction. Volume. Volume usually trends downward over the course of the pattern, but need not. Do not discard a chart pattern simply because volume trends upward instead of downward. Breakout day volume is usually high, meaning it is above the 1-month average. Again, do not discard a diamond because the breakout volume is light instead of heavy. Breakout direction. price can break out in any direction but is upward most often. In trading tactics, I'll discuss a way to help improve determining the breakout direction using a single diagonal pattern. Figure 23.2 shows an example of a diamond bottom. The price trend is downward for nearly 2 months leading to the diamond. Price moves sideways as the diamond reversal forms, and the range widens as higher highs and lower lows appear. Then the tide turns and the range narrows. Lower highs follow higher lows. The diamond pattern takes shape after connecting the boundaries of the price movement with trend lines. This is a pretty-looking diamond with price crossing the pattern from top to bottom, filling the white space with price movement. Volume throughout the diamond is receding. This occurrence is typical but not a prerequisite for a well-formed diamond bottom. Volume usually surges on the breakout. The figure shows that breakout volume is 4 times the prior day but is just slightly above average for the stock. Figure 23.3, weekly scale, illustrates the support area often promoted by diamond bottoms, in this case at $10. Although support varies from diamond to diamond, when it appears after a diamond bottom, it is usually near the base of the diamond. Another area of support commonly appears when the stock throws back to the level of the breakout. Figure shows an example of this if you ignore the weekly scale and the requirement that a throwback must return to the breakout price within a month. During a throwback, price climbs away from the diamond after the breakout, reverses course, and heads lower. Support meets the stock at the apex of the right half of the diamond. Think of the apex of a symmetrical triangle, usually stopping briefly near the breakout price, then price turns around again and climbs. A throwback to the diamond happens about half the time, and represents another opportunity to initiate a trade or add to an existing position. Figure 23.4 shows another example of a well-formed diamond bottom. Quarterly earnings were released on 9 May, and the stock reacted at D by forming a breakaway gap on high volume. The stock formed a 2-diagonal diamond, more about that later at ABC, with a breakout at E. Price pulled back to F and bottomed at G, 11% below the breakout price. Measured from the close the day before gap D, the stock lost 37% of its value. That was the reaction to just one earnings report that the market didn't like. However, the stock recovered. In fact, the continuation gap at H opposite D was the next quarterly earnings report. The two gaps set off the diamond as an island bottom reversal. The stock continued to recover, as if the D earnings had never happened. Traders or investors who sold as price dropped to G were probably kicking themselves and yelling at the company when price climbed to a new yearly high in November. Focus on failures. Diamonds have one type of failure that I call a 5% failure. A 5% failure happens when price breaks out and travels no more than 5% before reversing. Price after the reverse may move more than 20% or close at the other side of the pattern, bottom of the pattern for upward breakouts or above the pattern for downward breakouts. Figure 23.5 shows an example. Is this a valid diamond? Price trends downward into the pattern, the diamond shape is clear, but volume trends upward higher on the right than the left. Is the rising volume trend cause for concern? No. Breakout day volume is also low instead of high, but who's counting? Everything looks fine except for volume. If this were my trade, the volume anomalies would not even register. I would be more worried about something else. You know what it is. Look at the figure again. See that descending triangle hanging above the diamond like an approaching storm. Although you may not recognize the triangle pattern, you should be on the lookout for overhead resistance. That solid block of near horizontal price movement starting in October, where the triangle begins, to December where it ends, would scare me off. The only way I would take this trade would be to short it once price turned down at the triangle. That is essentially what happened. Price broke out upward and the massive overhead resistance stopped the rise. Price threw back to the diamond but kept going down. Let me also mention that this pattern occurred in the middle of a bear market. So, we had a bear market sucking price lower, a falling price trend leading to the diamond, and massive overhead resistance. The only surprise would be if the price floated like pumice instead of sinking as does a diamond tossed into a pond. Your job as a trader is to find the gems that float. Statistics. Table 23.2 shows general statistics. Number found. I found diamonds starting in September 1991 through October 2019 in 419 stocks. Not all stocks covered the entire period, and some no longer trade. After removing 119 bear market cubic zirconium, too few to report on, I was left with 477 bull market patterns. That's not a lot of samples. With just 126 breaking out downward, it suggests the low sample count may be the reason for the good performance of this chart pattern. Something to ponder. Reversal R, continuation C occurrence. Because price must enter the diamond from the top trending down by definition, an upward breakout means it's a reversal. Downward breakouts act as continuation patterns, average rise or decline. The average rise is below the 42% we see for most other chart pattern types, but the average decline is higher than the 15% loss for other chart pattern types, hence the number 1 performance rank highlighted in the results snapshot at chapter start. Standard & Poor's 500 change. I measured the performance of the index from the date of the diamond's breakout to the ultimate high or low. If you think that the market trend helps a pattern's post-breakout performance, then the move in the index did just that. A rising tide lifts all boats in a rising market, and you hear a giant sucking sound in a falling market. Days to ultimate high or low. I measured the velocity from price rising 39% in 182 days and compared that to a 19% drop in 40 days. Result, the drop is 2.2 times as fast as the rise. Neat, huh? How many change trend? I like to see values above 50% for this item. Upward breakouts frequently see patterns with that kind of performance. In this case, 56% of diamonds with upward breakouts see price rise more than 20% after the breakout. The 39% seeing price drop more than 20% after a downward breakout is quite good too. In fact, it's probably better than good. The average for other chart pattern types is 28%, so yes, diamonds do particularly well. Table 23.3 shows how often the pattern fails. For example, 13% of diamonds in bull markets with upward breakouts fail to rise more than 5%. A total of 26% fail to rise more than 10%. One last example for downward breakouts. 51% fail to see price drop more than 15% after the breakout. Notice how quickly the failure rate increases for small changes in the maximum price rise or decline. Moving from a 5% max to a 10% one, failures double. Table 23.4 shows breakout-related statistics. Breakout direction. I don't know why, but the 74% of diamond bottoms breaking out upward fascinates me. Maybe I need to get out more. Yearly position, performance. Where are the best performers located in the yearly high-low price range? Diamonds that perform best break out in the middle of the range. My guess is that additional samples would tilt the scale to the lower third of the range, but that's just a guess. Throwbacks and pullbacks. Throwbacks and pullbacks, when price returns to the breakout price or diamond border within a month, occur over half the time. When a throwback or pullback occurs, it takes 12 to 13 days on average to complete the move back to the breakout price. Performance suffers if a throwback or pullback appears too. To avoid a throwback or pullback, look for overhead resistance or underlying support before trading. Avoid the diamond when congestion is nearby. After the throwback or pullback ends, price rises most often. That's bad news after a pullback, though 46% continue lower, meaning price rises the other 54% of the time. Gaps. I compared the performance of diamonds with and without breakout day gaps. Most often, gaps help performance, and that's what we see with diamond bottoms too. I use the opening price the day after a gap in the measure to the ultimate high or low. Thus, you can buy into the trade after the gap appears to participate in the better performing move. Table 23.5 shows statistics related to size. Height. Tall diamonds perform better than short ones. To use this result, compute the diamond height by subtracting the lowest low in the diamond from the highest high and then dividing by the breakout price, the point where price closes outside the diamond trendline boundary. If the result is larger than the median listed in the table, then you have a tall pattern. Width. Wide diamonds perform better than narrow ones, but only after an upward breakout. Downward breakouts show no preference. I used the median length as the separator between narrow and wide. Height and width combinations. For upward breakouts, tall diamonds outperform and wide ones also outperform. You'd think it obvious that diamonds both tall and wide would perform best. However, tall and narrows ones actually do best for both up and down breakouts. You'll want to avoid trading short diamonds either wide or narrow. They perform worst. Table 23.6 shows volume-related statistics. Volume trend. Diamonds having a falling volume trend most often. Do not discard a diamond because volume trends upward. Rising/falling volume. Upward breakouts with a falling volume trend show a 2 percentage point performance advantage compared to those diamonds with a rising volume trend. Downward breakouts favor a rising trend for better performance, but the difference is small. Breakout day volume. Results are mixed with upward breakouts showing better post-breakout performance if breakout day volume is above average and downward breakouts seeing better performance after a breakout on light volume. Table 23.7 relates to how often price reaches a stop location, but due to the way I calculate the location, it doesn't apply to diamonds, so it isn't provided here. Table 23.8 shows the performance over 3 decades. Performance over time. Diamond performance has deteriorated since the 1990s, as the table shows. That's shown in the column of upward breakouts. Downward breakouts don't fare much better, though, with the last 2 decades having similar performance, but both are well below the 1990s level. Failures over time. This shows how many patterns fail to see price move more than 5% after the breakout. The sample counts are few, totaling 46 for upward breakouts and just 19 for downward ones. I'd ignore the results, especially the 26% failure rate bull market, 2010s. All 3 decades have samples counts ranging from 110 to 121, up breakouts only, so it's not a low sample count problem. The numbers might be correct. Table 23.9 show busted pattern performance. Busted patterns count. Diamonds bust frequently, but not as often as other chart pattern types. Busted occurrence. Sorting the busted patterns into single, double, and more than 2 busts, triple plus, shows that single busted patterns happen most often. Which one comes in second depends on the column you're looking at. It's typical for triple plus to place second in frequency. Downward breakouts show this. Busted and non-busted performance. If you're lucky enough to trade a single busted pattern, you can do as well or better than non-busted diamonds. Of course, you have to trade it perfectly and often to match the rates shown in the table. Good luck with that, but the 48% gain after a downward breakout makes me want to wait for a diamond with a busted downward breakout to come along. Maybe I can hitch a ride. Trading tactics. Table 23.10 shows trading tactics. Measure rule targets. The results snapshot, percentage meeting price target, at the beginning of this chapter shows how often the measure rule works using the full pattern's height. For an example, refer to figure 23.7. In both diamonds, compute the height by subtracting the lowest price in the pattern point B from the highest high point A, then adding to upward breakouts, or subtracting from downward breakouts, the breakout price point C. The breakout occurs the day price closes outside the diamond boundary. Specifically, the diamond top left diamond shows a height of 7.62. That is, 79.25 minus 71.63, or the high minus the low. Since the breakout is downward, subtract the result from the breakout price. That gives a target of 65.88 or 73.50 minus 7.62, the breakout price minus the height. For downward breakouts, ignore targets below 0. The bottom portion of the table shows how often various heights work with the measure rule. For example, using half the diamond's height means price will likely reach the target more than 80% of the time. That's very good. Using tall heights 2 times, 3 times in the projection means the measure rule target will be harder to hit, but if price does reach it, the profit will be better. Once you have a target, you can use the diamond's height to see if the target is reasonable. Let's use the left diamond's numbers. Divide the diamond's height, 7.62, by the breakout price, 73.50, to get a potential 10% drop. Table 23.3 shows that 37% of diamond bottoms with downward breakouts in bull market will fail to see price drop more than 10%. Flipping that around, it also means that 63% of the time, the stock will reach a target 10% below the current price. That's not terrific, but it's not awful either. Quick rise or fall. Figure 23.7 also shows an alternative way of determining the magnitude of the rise or decline. When price shoots upward leading to the start of the diamond, in the case of the left diamond, a quick decline often follows, which can take price back to the launch point, often stopping just above it. I show this as the expected decline in the figure. The diamond bottom, right diamond, shows a similar situation. Price makes a steep drop into the pattern and soars back out in a similar trend. The stock stops climbing near the launch point, shown as the expected rise. Wait for breakout. Before you invest in a stock showing a chart pattern, wait for the breakout. Since diamonds can break out either up or down, you cannot predict the breakout direction with certainty. Thus, wait for the breakout, a close outside the pattern boundary before taking a position. Yes, premature breakouts do occur, but they are rare. A premature breakout happens when price closes outside the diamond boundary but returns in a day or two. In the 288 diamonds I looked at, I found fewer than a dozen with premature breakouts. Busted trade. Downward breakouts that single bust show good gains. See Table 23.9 for more information. Table 23.11 shows a table for diagonal diamonds. The name comes from an article in Technical Analysis of Stocks and Commodities magazine, November 2018, by Igor R. Toshchakov. Figure 23.6 shows a simplified drawing of his examples. Let's discuss the patterns before I talk numbers. Look at AB, a diamond pattern he calls a single diagonal, where the top and bottom are connected by the longest trend in the pattern. It's a diamond pattern, yes. I could have drawn it better, so pretend it's a good-looking diamond, but the bottom B appears before the top, A. He says that this combination indicates the breakout will be downward. Pattern CD is another single diagonal diamond, except the top C comes before the bottom, D. The predicted breakout direction from this pattern is upward. The right portion of the figure shows two diagonal diamond shapes. Instead of one long trend connecting the top and bottom of the pattern, we see two equal or nearly equal lengths connecting the top and bottom. Two diagonals tend to be a bit squatter, looking on the side with two touches, FG and IJ. So there's a bit of a difference between single and two diagonal shapes, making it easier to determine which is which. In the top right panel, trends EF and EG form the two longest segments. Notice how the lines do not connect to the bottom of the diamond. Instead, price touches the sides and they straddle the bottom. The bottom right panel shows the pattern flipped upside down. Trends HI and HJ connect the top and bottom. Again, they straddle the diamond's top peak where the trend lines join. Toshchakov says that with two diagonal shapes, the breakout can be in either direction. Single diagonal. I used 246 diamond bottoms found from May 1996 to April 2020. I went through each pattern and marked whether it was a single or two diagonal pattern and logged when the top and bottoms of the pattern appeared. Table 23.11 shows the results in the lower portion of the table. If you ignore whether the pattern is a single or two diagonal configuration, a downward breakout will happen 26% of the time, and an upward breakout will happen 74% of the time. That's the benchmark for the breakout direction from Table 23.4, which is what I want to test. I sorted the diamonds into single and two diagonal shapes and sorted by whether the top or the bottom of the pattern came first. The configuration shown at AB in the figure, where it's a single diagonal with the bottom coming before the top, is supposed to break out downward. I found that worked only 28% of the time. That's better than the benchmark's 26%, but it's well short of the 72% that break out upward. In other words, it's more correct to say the pattern breaks out upward most often. Configuration CD shows a single diagonal with the bottom coming after the top. His technique says these types of diamonds break out upward. Indeed, they do 81% of the time compared to the benchmark's 74% of the time. That's a handy improvement. Two diagonal. For two diagonal patterns, I checked whether the top or bottom came first and checked the breakout direction. The benchmark rate doesn't change with 26% of diamonds breaking out downward and the other 74% breaking out upward. For two diagonal patterns, when the bottom F happened before the top E in pattern EFG, I found they break out downward 26% of the time. That ties the benchmark, but far from the 74% that break out upward. The two diagonal, bottom H after the top pattern, INHIJ pattern, correctly predicts an upward breakout 76% of the time. That's slightly better than the 74% benchmark. Of course, Toshchikov doesn't claim that the 2 diagonal has a defined breakout pattern, but I checked anyway. Figures 23.1 and 23.2 show 2 diagonal patterns and both have upward breakouts. Figure 23.4 shows a 2 diagonal diamond with a downward breakout. How do you apply this to your trading? When the bottom comes after the top, expect an upward breakout. 2 configurations meet that test: the single diagonal, top before bottom, shown as CD in figure 23.6, and the 2 diagonal pattern HIJ. Expect an upward breakout 76% to 81% of the time on average, depending on whether it's a single or 2 diagonal pattern. Figure 23.5 shows a single diagonal pattern with the bottom coming before the top. The breakout is supposed to be downward, but it's not. Figure 23.7 shows 2 single diagonal patterns with the top coming before the bottom. The left one breaks out downward, the prediction fails, but the other diamond on the right shows a correct, upward breakout. Sample trade. Scott graduated from engineering college and took his first professional job at a growing software company. The job pays well, but he has many school loans and a mountain of department. He thought of using his paycheck to keep ahead of the bills while depending on the bull market to furnish the luxuries. He had his eye on a new stereo system and wanted it for a party he was hosting during the 4th of July festivities. That did not leave him much time, so he searched for a chart pattern he could trade profitably. He chose the diamond bottom shown in figure 23.7, the diamond on the right. Scott first noticed the diamond in May, a few days before the breakout. He believed that the price would not decline below 69.88 or 12 cents below the round number of 70, and at the same level as a couple of price peaks in January. Risking just $0.75 with a possible reward of $3.75, the pattern's height gave him a risk-to-reward ratio of 51.5 is the reward for every dollar risked. If everything worked as planned, I would make enough to buy the stereo. The day after the stock broke out upward, he bought and received a fill at 71.75, near point C. Entry was higher than I liked, but with the strength shown, I was sure the trade would work out. I placed a stop at 69.88 with my broker. 3 days later, the stock closed at 75, above the target price. He dropped by the music store just to fondle knobs and flip switches of his dream machine. And things began going wrong. The stock closed down nearly $3 to 72.13. It dropped to 71.38 the next day and made a lower low a day later. Suddenly, Scott was losing money, and his dream stereo was in danger of remaining on the store shelf. Should he sell the stock and put off the party for another time? Luck was on his side and price began climbing again. Soon, it reached 74, but the honeymoon didn't last long. Price completed a symmetrical triangle, but I didn't see it. The stock broke out downward from the triangle. The stock even gave him another chance to get out at a profit when it attempted a pullback to the triangle boundary. I was busy making party favors and missed that signal too. Am I an idiot or what? When he received a call from his broker in mid-June reporting that the stop took him out at 69.88, Scott scratched his head and wondered what went wrong. He asked me. One word: greed. Since you needed money for the stereo, once price cleared the top of the diamond, you should have put a limit order to sell at your target. Although this technique limits the profit potential, because you get taken out even though the stock may double after that. It allows a trader to capture the turn near an expected high. Chapter 24, Diamond Tops. Results Snapshot. Appearance: after an upward price trend, a diamond pattern forms. The results snapshot shows the important results for diamond tops. In appearance, the only difference between diamond top and bottom patterns is the price trend leading to the diamond. For diamond tops, the price trend is upward leading to the pattern. Diamond bottoms have price trending downward into them. A review of the numbers shows that upward breakouts rank last for performance. The average rise, at 29%, is well below the 42.4% gain showed by the average chart pattern. The failure rate is high too, ranking 33 out of 39. That's not dead last, but the patient might need a respirator. Diamonds with downward breakouts do well as far as the average decline goes. They rank third. It's as if diamond tops are bearish patterns and an upward breakout suffers while a downward breakout thrives. Tour. What does a diamond top look like? Figure 24.1 shows a good example. This diamond signals a reversal of the prevailing upward price trend and shows the preferred behavior of a top. Price returns to the level before the diamond began, the launch price. The reversal stands out and makes the diamond easier to find because it's at the end of a swift uptrend. Of course, not all diamond tops act this way. Some signal a reversal of the prevailing trend, and price not only retraces recent gains but continues moving down too. I want to emphasize the return to the launch price in this figure. Notice the strong upward move at a. Price zips skyward on high volume. After the diamond top completes, the stock drops. Often the drop isn't as fast as the rise. Indeed, price may move sideways for a time. In some cases, certainly not all, and I don't have a good number for you as an estimate of how often this occurs, price returns to stop just above the launch price. By that, I mean point B will bottom just above the price of point A. In this case, that doesn't happen. Price meets at B and the drop from the diamond to B doesn't take long either. In many cases, you may see price move up strongly at A, but a downward breakout won't return price to or even slightly above it. The stock just doesn't make it back down. However, this idea of returning to the launch price makes for setting a price target easier. It won't always work, but you have an idea of how far price might drop. Identification guidelines. Table 24.1 lists identification guidelines for diamond tops. Consider the diamond top pictured in figure 24.2. A broadening top looks like a mouth opening at G, inhaling price. The diamond appears at D, so let's talk about it. Appearance. The fluctuations of peaks and valleys form the diamond shape when trend lines connect them, such as that shown in the figure. Notice that the diamond is not symmetrical. Irregular diamond shapes are common for this pattern. Even so, they do look like diamonds. Price trend. The short-term price trend from A to B is upward, leading to the start of the pattern. We see a bit of overshoot at B and undershoot at C before the diamond builds. Ignore the overshoot and undershoot when assessing whether a diamond is a top or bottom. Volume. The volume trend is receding in this diamond, according to linear regression. All I see is a big volume spike in the middle of the pattern. It's like a middle finger pointing at the diamond. Breakout day, E volume at H is high but not even close to what it was in the middle of the diamond. Price throws back to the breakout price, F, before resuming its upward move. Support and resistance. Support and resistance for diamond tops commonly appear at the top of the pattern, as seen in figure 24.3. The diamond reversal forms a resistance level, repelling price during the rise in March and April 1993, and is not pierced until a year later. A congestion zone forms in October 1993 and lasts through March of the following year before price climbs convincingly above the resistance area. Even then, during April and May 1994, price is buoyed by the support zone at 31 created a year and a half earlier. Figure 24.4 shows another example of a diamond top. I would expect price to break out downward because of the quick rise leading to the pattern late January, and drop until they found support around the 108 level, the price range of the January lows. As you can see, that did not happen. Price broke out upward instead. Does this diamond obey the identification guidelines? Price rises into the pattern from the bottom, so the upward price trend is correct for a top. The diamond shape becomes clear after drawing trend lines along the minor highs and lows. Linear regression on the volume trend shows that it tilts downward. As expected, take my word for it. Breakout day volume is high, but again, this is not a rule, just an observation. A breakout on low volume is fine. In short, the diamond top pictured in figure 24.4 is valid. With an upward breakout, I would check for overhead resistance to the upward move, but this figure does not show any. A look at the weekly chart would clarify the situation and allow a trader to estimate the likely rise, assuming price stops at overhead resistance. Breakout direction. Price breaks out in a direction that's almost random, but it favors a downward direction. Focus on failures. Figure 24.5 shows a diamond top failure. The diamond may look odd by its unsymmetrical appearance, but does it qualify as a valid diamond? Yes. The price trend leading to the pattern is up. there are plenty of trendline touches in the pattern, and volume diminishes from being high on the left to low on the right. All are ingredients of a properly selected diamond top. Breakout volume, however, is timid, falling well short of the peaks posted during the prior 3 days. Price breaks out downward from the diamond and reaches the ultimate low as shown on the chart. After that, a pullback sees price recover to the breakout price and keeps climbing in a swift move upward, peaking in early February. The price drops, gapping lower breakaway gap. Is low breakout volume the reason why price failed to descend far, just 3%? Maybe. A high volume breakout would have given more confidence to a bearish situation and perhaps prevented a pullback. I have noticed that high volume downward breakouts pull back less often than do low volume ones. This makes intuitive sense, as a high volume descent tends to push price down farther than a low volume one. Perhaps the key to this failure is like many others: support below the pattern stops the decline. On the weekly chart not shown, support appears in February and August 1996 and May 1995, all with price peaking near 17. Coupled with a bullish general market, the rising tide lifted all boats and prevented this one from sinking. Based on this chart, if this were my trade, I would have seen the support in July point A as a warning sign. That would be my guess as to how far price would drop. Indeed, price does stop at that level in April, but that is well after the pattern fails. If price pierced the point of support zone at 15.50, I would expect a continued decline to the September low. To play it safe, perhaps a target of 14.50 above the September tail, because you do not want to place a target based on an outlier spike, would work. A stop would have closed out my short position at the prior minor high near the price level where the word pullback points in the figure. Why do chart patterns fail? Who knows? They just do. Use stops to protect your position and use conservative price targets. Statistics. Table 24.2 shows general statistics for diamond tops. Number found. I scoured my 3 databases to unearth enough diamonds to make the statistics tables worthwhile. I found the first pattern in August 1991 and the most recent in November 2019. I found 896 diamond tops in 539 stocks, but not all stocks covered the entire period and some no longer trade. Bear market samples were too few to include in this chapter. Reversal R, continuation C occurrence. Because we know price trends upward into the pattern, an upward breakout means the pattern acts as a continuation. Those with downward breakouts act as reversals, average rise or decline. As I mentioned previously, the meager rise falls well short of what we see in other chart patterns. However, downward breakouts do well for a bearish breakout. Standard and Poor's 500 change. The numbers suggest how well you could have done if you bought the stocks in the index as opposed to trading the diamonds perfectly. The numbers also show the influence of the general market on the average rise or decline. A large up move, bull market, helped price rise, while a downward move, bear market, pulled the stock lower. Days to ultimate high or low. I checked my speedometer and found that the drop after a downward breakout from a diamond is nearly twice as fast as the rise, upward breakout. So if you've ever wondered why you lose so much so quickly when price drops, now you know. How many change trend? I consider values for upward breakouts above 50% to be good, but diamond tops fall short of that goal. Just 48% see price climb more than 20% after the breakout. Downward breakouts, however, exceed the 28% average for most other chart pattern types by a handy amount. Table 24.3 shows failure rates for diamond tops under varying breakout directions. How do you make sense of the numbers? The table shows how likely it is that your pattern may fail to rise or drop a given amount. For example, in bull markets, 21% of the diamonds with upward breakouts failed to see price rise more than 5%. 37% failed to see price climb more than 10%. Similarly, 15% of the patterns in bull markets with a downward breakout failed to see price drop more than 5%. For small moves up to 15%, diamonds with downward breakouts are the best bets. They have the lowest failure rates. This changes for moves 15% and higher. For large moves, patterns in bull markets with upward breakouts show smaller failure rates. Table 24.4 shows breakout-related statistics. Breakout direction. Downward breakouts occur most often, but the direction is almost random. Yearly position performance. Mapping performance onto the yearly price range, we find price within a third of the yearly low as having the best performance. The other 2/3 don't show much performance difference between themselves. Throwbacks and pullbacks. How often does price throw back upward breakouts or pull back downward breakouts to the diamond trendline border or breakout price? Answer: about half the time. The time to complete the throwback or pullback ranges between 10 and 13 days. When a throwback or pullback occurs, performance suffers as the table shows. Thus, the key to selecting better performing patterns is to search for underlying support or overhead resistance before trading. Nearby support or resistance may repel the downward or upward move, respectively. Gaps. Across the board, gaps hurt performance. By gaps, I mean a price gap that occurs on the day price closes outside the pattern boundary, the breakout day. Not sure why this is, because gaps are supposed to help performance, not hinder it. Table 24.5 shows pattern size statistics. Height. I consider height to be one of the best predictors of future performance. Tall diamonds perform better than short ones. To determine if the pattern is short or tall, measure the diamond height from the highest high to the lowest low in the pattern, and then divide by the breakout price, where price pierces the diamond boundary. If the result is larger than the median shown in the table, then you have a tall pattern, less than the median, and the pattern is short. Width. Wide patterns perform better than narrow ones. I used the median width as the separator between narrow and wide. Height and width combinations. Diamond tops both tall and wide either tie or outperform the other combinations. Upward breakouts. Avoid those patterns that are short and narrow. Downward breakouts suffer when the pattern is short and wide. Table 24.6 shows volume-related statistics. Volume trend. Volume trends downward, but the results are almost random. I used linear regression on volume to determine the trend, so no guessing was involved. Rising/falling volume. There's no consistent trend for rising and falling volume. Upward breakouts do better if volume is rising throughout the pattern. Downward breakouts show the reverse, with falling volume showing a slight post-breakout performance advantage. Breakout day volume. Upward breakouts do best if volume is above the 30-day average. Downward breakouts show the reverse, with light breakout day volume showing price having a larger decline. The inability of upward and downward breakouts to agree for both rising/falling and heavy/light volume suggests the findings are unreliable. As a trader, I don't put much stock in volume. In fact, I prefer to look at charts without volume showing. I have seen that rising volume on the way to the ultimate high seems to help performance, but I haven't found a way to predict that kind of volume trend. Table 24.7, how often stops hit, is missing. My computer can't correctly place stops for this pattern, so I don't show the table. Table 24.8 shows the performance over 3 decades. Performance over time. Downward breakouts show good performance back in the 1990s, but performance has steadily declined since. Upward breakouts did best in the 2000s, with the other 2 decades performing close to one another, within 2 percentage points. Failures over time. Downward breakouts show steadily increasing failure rates, where the numbers represent how often a diamond top fails to see price move more than 5% after the breakout. Upward breakouts don't show the same trend. Rather, the 2010s have the highest failures and the 2000s showed the fewest. Table 24.9 shows busted pattern performance. Busted patterns count. A third of diamond tops will bust. That means price moves no more than 10% after the breakout before it reverses and sails across the pattern to break out in the new direction. Busted occurrence. Single busts happen most often, but you'll have to consult the table for whether double or more than 2 triple plus busts come in second. I like to see single busted counts higher, like 70% or more. That way, if I want to trade a busted pattern, I can assume it'll single bust and give me the best performance. Because single busts are below 70%, I'd avoid trading a busted pattern unless you were sure it would single bust. Why the emphasis on single busted patterns, busted and non-busted performance? The answer is because single busted patterns perform best. They beat the 3 combinations singe, double, and triple plus combined and non-busted patterns. In fact, patterns busting a downward breakout perform twice as well as their non-busted counterparts. Isn't that a trip? Trading tactics. Table 24.10 shows trading tactics. Measure rule targets. Use the measure rule to predict a price target. Consider figure 24.7, a chart of a diamond top. Compute the formation height by taking the difference between the high and the pattern point at 43.85 in this example, and the low be at 38.08. Add the difference, 5.77, to the breakout price, C at 41.85, the point at which price pierces the diamond boundary to get the target, 47.62. In this example, price didn't reach the target. The lower portion of the table shows how often the measure rule works using various heights in the computation. For example, using the full height like we did in the example shows price reaching the target between 63% and 65% of the time, depending on the breakout direction. Cut the height in half, use it in the formula, and the success rate increases. Double or triple the height and the success rate tumbles. After you compute the height, divide it by the current price and compare it to the results in Table 24.3. In the above example, the height is 5.77, and let's assume the breakout price is the current price, 41.85, for a potential rise of 14%. How likely is that? Table 24.3 says that in bull markets, almost half, 46% of patterns will fail to rise more than 15%, which is closest to the potential rise of 14%. That also means 54% will exceed a 15% rise, so the probabilities could be a lot stronger for this trade. However, there is an alternative method that sometimes yields more accurate results. The method involves looking at the price chart and seeing if there is something to reverse. By this, I mean diamonds sometimes form after a quick run up or down in price. The reversal could erase the gains and return price to where they were before the run-up. Figure 24.1 shows an example of where it worked, price at B returned to the price of A. Wait for breakout. When trading technical patterns like diamond tops, it is always safest to wait for the breakout. If you do not wait for the breakout, you may face a situation similar to that shown in figure 24.4. Instead of price retracing the quick rise from the January low, price resumed trending higher. Traders shorting the stock before the breakout would likely take a loss. Risk/reward. Before placing a trade, consider the risk/reward ratio. In essence, you first identify the support and resistance levels and calculate the difference between those levels and the current price. Trades that result in risk/reward ratios of 1 to 2 or higher are worth making. With smaller ratios, the risk may be too high to warrant a trade. I'll confess that I'm holding my nose as I'm typing this, which isn't easy, by the way. In my trading, I don't care about the risk/reward ratio. Why? Because I let profits run, easily beating a lousy risk/reward ratio in a trade others might discard. Busted pattern. Consult Table 24.9 for guidance on trading busted patterns. Downward breakouts provide the best performance advantage. After the stock busts a downward breakout and closes above the top of the diamond, buy. Table 24.11 shows a table for diagonal diamonds. The name comes from an article in Technical Analysis of Stocks and Commodities magazine, November 2018, by Igor R. Toshchakov. Figure 24.6 shows a simplified drawing of his examples. Let's discuss the patterns before I talk numbers. Look at AB, a diamond pattern he calls a single diagonal, where the top and bottom are connected by the longest trend in the pattern. It's a diamond pattern, yes. I could have drawn it better, so pretend it's a good-looking diamond, but the bottom B appears before the top A. He says that this combination indicates the breakout will be downward. Pattern CD is another single diagonal diamond, except the top C comes before the bottom D. The predicted breakout direction from this pattern is upward. The right portion of the figure shows two diagonal diamond shapes. Instead of one trend connecting the top and bottom of the pattern, we see two equal or nearly equal lengths connecting the top and bottom. Two diagonals tend to be a bit squatter looking on the side with two touches, FG and IJ, so there's a bit of a difference between single and two diagonal shapes, making it easier to determine which is which. In the top right panel, trends EF and EG form the two longest segments. Notice how the lines do not connect to the bottom of the diamond. Instead, price touches the sides and they straddle the bottom. The bottom right panel shows the pattern flipped upside down. Trends HI and HJ connect the top and bottom. Again, they straddle the diamond's top peak where the trend lines join. Toshchakov says that with two diagonal shapes, the breakout can be in either direction. Single diagonal. I used 388 diamond tops found from May 1996 to April 2020. I went through each pattern and marked whether it was a single or two diagonal pattern and logged when the top and bottoms of the pattern appeared. Table 24.11 shows the results in the lower portion of the table. If you ignore whether the pattern is a single or two diagonal configuration, a downward breakout will happen 54% of the time, and an upward breakout will happen 46% of the time. That's the benchmark for the breakout direction, from Table 24.4, which is what I want to test. I sorted the diamonds into single and two diagonal shapes, and sorted by whether the top or the bottom of the pattern came first. The configuration shown at AB in the figure, where it's a single diagonal with the bottom coming before the top, is supposed to break out downward. I found that worked 58% of the time. That's better than the benchmark's 54%, but it's too close to random for my taste. Configuration CD in figure 24.6 shows a single diagonal with the bottom coming after the top. His technique says these types of diamonds break out upward. Indeed, they do 65% of the time compared to the benchmark's 46% of the time. That's a significant improvement. Two diagonal. For two diagonal patterns, I checked whether the top or bottom came first and checked the breakout direction. The benchmark rate doesn't change with 54% of diamonds breaking out downward and the other 46% breaking out upward. For two diagonal patterns, when the bottom F happened before the top E in pattern EFG, I found they break out downward 57% of the time, a slight improvement over the 54% benchmark. The two diagonal bottom H after the top combination, I in HIJ pattern correctly predicts an upward breakout 52% of the time. That's almost random. Of course, Toshchakov doesn't claim that the two diagonal has a defined breakout pattern, but I checked anyway. Figure 24.4 show a good example of a two diagonal pattern with the bottom coming before the top. It's supposed to break out upward, which it does in this example. How do you apply this to your trading? Only single diagonals with the bottom after the top work well enough to consider using. First, you have to determine if the diamond is a single or two diagonal pattern. Once you figure that out, check to see if the bottom comes after the top. If so, there's a 65% chance price will break out upward. Figure 24.6 shows a single diagonal with the bottom after the top. And look, it breaks out upward. Figure 24.5 shows a single diagonal with the bottom after the top and a downward breakout when it should be upward. Sample trade. Figure 24.7 shows a diamond top Lorenzo traded. He first noticed the diamond well after it formed, during the throwback to be exact. The throwback's hooking pattern caught his attention, and he searched for a nearby chart pattern. In this case, he saw a diamond top, but was it a valid diamond? Lorenzo reviewed the identification guidelines and found that price was rising into the pattern, verifying a top. The diamond shape, although pushed to one side, had an adequate number of touches of each diamond boundary the trend lines. Volume receded from the middle of the pattern to the end, so it had a downward trend. Breakout volume was high but nothing to write home about and well below the peaks of a few days earlier. Price also gapped upward C, suggesting buying enthusiasm. However, he knew that breakout day gaps resulted in performance that was not as good as those diamonds without gaps. That made him nervous. Since the breakout was upward, he checked for overhead resistance and saw the Long Island pattern in May. Price tested the region at point D, leading to the throwback. Still, he knew that price would eventually pierce that resistance, perhaps after multiple attempts to break through. He computed the predicted price target using the diamond height projected upward from the breakout price. The target was at the high end of the resistance area, he said. I hoped price would reverse there. That meant watching the stock closely and selling when it neared the target to maximize profit. On the downside, if price dropped, he would close out his position just below the diamond bottom, point B. 2 days after price closed the gap in the throwback, I bought at 43. In the days that followed, the stock dropped. It's been my experience that many of my trades either do well right from the start or fall apart. This looked as if it were going to crumble, so I placed a stop-loss order at 37.93. That was below the round number support at 38 and just below the diamond bottom. Price climbed. When they closed above the prior minor high, point D, he raised his stop to just below point E, a nearby minor low. Price continued higher for 2 more days, then retraced its gains, attempted another high point F, and then started a long slide. I know from experience that failure of the stock to make a higher high was a bearish sign, but hoped the stock would rebound. It didn't. Instead, price gapped down and tripped my stop. I took a 5% loss. What did he do wrong? I would not have taken this trade because of nearby overhead resistance. Since there are plenty of chart patterns in other stocks under more promising circumstances, why take one with high risk and limited profit potential? On the plus side, he used a stop-loss order and raised it as price climbed. Eventually, the order took him out for a small loss. That is the way it should work when a trade goes bad. Let your profits run and cut your losses short. Chapter 25, Diving Board. Results snapshot. Appearance, price moves horizontally for several weeks to months, forming a flat base followed by a sharp plunge. Late in 2019, individual stocks were struggling to climb higher in the rarefied atmosphere of high altitude. Many moved sideways, forming a flat base going into 2020. Then, COVID-19 came along and started killing hundreds of thousands of people and infecting millions worldwide, so far. The indices tumbled, sinking 35%, sending them into a bear market. Individual stocks have been decimated, dropping up to 70% from their peaks made late last year. In late March 2020, the markets started to rebound on hope that the recovery is in sight. Poor corporate earnings usually send their stocks down, and the larger names pull down the general market as well. But the markets shrug off the bad news, a bullish sign. Future quarters may also suffer, so there's lots of risk or potential reward to buying now. Uncertainty is why the markets are so volatile, gaining or losing thousands of points in one trading session. The pattern we're seeing in individual stocks is called a diving board. It's a flat base, the board followed by a steep plunge and then a recovery. The pattern shares a shape similar to the cloud bank chart pattern, but the details are different. I discovered the diving board pattern on Thanksgiving Day, 2010, when I went shopping for stocks to buy. I was on the weekly scale and saw a flat base followed by a plunge, diving into the water, and a straight line recovery, returning to the surface and climbing out of the water. Flat base reminded me of a diving board and subsequent plunge into the water, hence the pattern's name. This pattern is one I search for frequently when the markets are soaring to new highs and many good stocks are overvalued, priced too high. I switch to the weekly charts and search for diving board patterns. They represent good value with the potential for long-term appreciation. But they are not low risk, especially if you buy near the plunge low. I'll discuss what plunge means later. The above results snapshot shows a high average rise and small failure rate. Those two are like opposite ends of a seesaw. When one goes up, the other goes down. Because the pattern is so tall, the percentage meeting the price target, 62%, is not as high as I like to see. It's a warning that making a profit from this pattern may not be as easy as the low failure rate suggests. Numbers also come from the weekly scale, so there are only 2 other chart patterns to compare against. Searching for the ultimate high on the weekly scale gives much higher results than doing so on the daily scale, so don't compare the results of this pattern to those on the daily scale. Let's take a look at this chart pattern. Tour. Figure 25.1 shows an example of what a diving board pattern looks like on the weekly scale. The board portion of the pattern is at I emphasize board because I refer to it often in this chapter. It's the flat movement before the plunge. Price moves horizontally with the bottom of the board flat or nearly so. The board is often weeks to months long. Following the end of the board, price doesn't just drop or meander lower, it plunges. So I call the steep drop to be a plunge, that is, the drop from the board end to the subsequent low, a term I'll refer to in this chapter. The plunge is often severe, carrying price lower for several weeks to months. If a swing trader can determine when the stock bottoms, there's money to be made riding the recovery. You can think of this pattern as a small or shorter version of a cloud bank pattern. See the chapter on cloud banks and ride the stock back to the cloud base, the board. Trading the recovery is difficult to do. The diving board pattern doesn't have the large drop requirement that a cloud bank does, a drop of 40% or more, so a late entry will diminish the potential, and there's no guarantee that price will rise back to the board either. I'll describe how well this setup works later in the chapter table 25.11. In this example, price does return to the board and breaks out upward at C. The preferred method of trading diving board patterns is to wait for price to close above the top of the board, top of the chart pattern. Buy the stock and hope it continues rising. The statistics in this chapter discuss this setup. Identification guidelines. Table 25.1 shows the identification guidelines. Refer to Figure 25.2 for additional guidance. In your quest to find these patterns, imagine driving down the road and hitting a pothole. The road is the board, and the pothole is the plunge. In technical terms, find a flat base followed by a sharp sell-off. Once price recovers, it can soar. You want to catch price as it reaches for the sky. Appearance. Switch to the weekly scale when searching for diving board patterns because these are long-term patterns. Price moves horizontally, forming the board, often having a flat bottom, but ignore the appearance of the top. The figure shows the board portion of the pattern as the horizontal line eta. Price moves sideways for about 2 months and finds support on the line. Sometimes the bottom of the pattern isn't flat, but the sideways path should be obvious. I like to see price touch the board often, setting up a support area. Length of the board is often months, and in rare cases can be a year or longer. Board. The board portion of the pattern is the flat support region, A, before the plunge B. It does not include the plunge. Plunge. Price drops after the board ends. The plunge varies from a small amount single digits to 98% with the median plunge measuring 14%, average 19% for those patterns with upward breakouts. As I mentioned, the plunge is the drop from the end of the line added to the bottom at B. Volume. Volume trends upward from the start of the board to the bottom of the plunge. Often, you'll see volume rise as price plunges, especially at or near the bottom. Breakout direction. This is always upward by definition. An upward breakout occurs when price closes above the top of the chart pattern. Ignore the pattern if price fails to close above the top of the pattern, or if price makes a lower plunge. In this example, the top of the pattern is C, and an upward breakout happens when price closes above the line at D. At E, the stock forms a broadening top before continuing to move higher. Duration. The table gives guidance for how long the diving board pattern is. I like to see a diving board patterns at least 1 or 2 months long. Focus on failures. Figure 25.3 shows a chart busy with lines on the weekly scale. Let's discuss each one. Line shows lots of support with price dropping to or coming near to the line. Price plunges on the way down to B, completing a diving board pattern. Price makes a double bottom with not so equal bottoms at B and B1 and recovers. The stock rises to the bottom of the board A and continues higher. Unfortunately, price doesn't break out upward a close above the peak price in the board, so ignore this pattern. It fails to perform as expected. Points C, D, and F are additional diving board patterns. Price rests on support, touching or coming close to the horizontal support lines multiple times. Price plunges to E, which shares the plunge with diving boards C and D, and plunge G for board F. Boards A and C are in uptrends, and F is in a downtrend. A check of the numbers shows that there is a negligible performance difference after the breakout based on the trend direction from the trend start to the pattern start. In other words, boards A, C, and F should perform similarly even though they appear in uptrends A, C, or a downtrend F. The diving board patterns shown fail to break out upward, and that accounts for most of the pattern failures. However, if price fails to rise very high, more than 5% after the breakout, then that's a failure too. Statistics. Table 25.2 shows general statistics. I did not tally statistics for bear markets because the patterns ended around the same time, toward the end of the 2007 to 2009 bear market. You don't get the diversity that I seek in these statistics. Number found. Because I'm using the weekly scale, there will likely be fewer patterns than if I used the daily scale. Even so, the diving board pattern is plentiful. I used data from May 1990 to June 2019, finding patterns in 513 stocks. Not all stocks covered the entire range and some no longer trade. Reversal R, continuation C occurrence. Most of the diving board patterns acted as continuations of the upward price trend, not reversals. Remember, I'm only looking at upward breakouts, reversal/continuation performance. Reversals outperform continuations by a handsome margin, but that may be because samples were fewer, 278 versus 482. Additional samples may narrow the performance gap. Average rise. Because I'm using the weekly scale, price trends longer than on the daily scale because of the way I look for the ultimate high. So we show a huge average rise of 73%. The median or mid-range value is more sedate at 42%. That kind of a gain would still be a nice addition to your wallet or purse. Unfortunately, such a large gain usually won't happen overnight, except in your dreams. Standard & Poor's 500 change. The table shows the average gain in the S&P 500 index from the breakout of the diving board pattern to the ultimate high for the pattern. The pattern outperforms the index, and that's typical for chart pattern performance, regardless of the pattern type. Even so, having the general market help carry the stock is a nice addition. Days to ultimate high. The time to reach the ultimate high is about 15 months. Keep in mind that the average rise is 73%, so price climbing that far will take longer than smaller rises. Nevertheless, this is a chart pattern best suited for long-term investing and not swing trading. Table 25.11 discusses statistics to trade the recovery from the plunge low, something that may interest shorter-term traders. How many change trend? Almost 3/4 of the patterns, 72%, will see price rise more than 20% after the breakout. That's a huge percentage. Again, it probably has more to do with the weekly scale and how it affects the rise from the breakout to the ultimate high. Table 25.3 shows cumulative failure rates for the diving board pattern. I measure failure by how often price fails to reach a target. For example, I found that 34% of diving board patterns failed to rise more than 5% after the breakout. An additional 68 patterns, for a total of 102, 68 plus 34 or 13% of the total, failed to see price rise more than 10%. Notice that 234 patterns bottom of the table show price rising over 100%. Out of 760 samples, the 234 represent 31% of the patterns. The results suggest there's a decent chance of having a whopper of a gain lurking out there. Table 25.4. I decided to erase the table of breakout statistics because it contained only 2 rows. The first row said that all breakouts are upward from a board. A breakout occurs when price closes above the highest peak in the board portion of the pattern. The second entry discussed how performance was distributed across the yearly high-low range. Samples were too few in 2 of the ranges, leaving the bulk of the patterns approaching the 73% average rise shown in Table 25.2. Table 25.5 quantifies performance by size. Height. I measured the height of the pattern from the top of it to the bottom of the plunge and sorted patterns by the height as a percentage of the breakout price. Tall patterns outperform short ones, and that's typical for chart patterns of all types. Indeed, height is a superior indicator of performance. However, just because your diving board pattern is tall does not guarantee that it will see price rise more than the average. Similarly, a short diving board pattern may show performance that blows the doors off your Pinto. Width. Wide patterns perform better than short ones. Width measures from the start of the board to the bottom of the plunge, not to the end of the board. The median width, which determines narrow or wide, is almost 7 months long. Height and width combinations. Because tall patterns outperform and wide patterns outperform, you'd expect the combination of tall and wide to show the best performance. Indeed, that's what the table shows. However, the worst performance doesn't come from short and narrow patterns as you might expect, but from tall and narrow ones. Table 25.6 shows volume-related statistics. However, because the pattern is so long and it's on the weekly scale, I don't think volume matters because it'll be irregular looking. It might be more important to check fundamental factors to see what's moving the stock. Volume trend. Volume trends upward most often probably because of an increase of share turnover as price drops to the plunge low. Rising/falling volume. A rising or falling volume trend from pattern start to plunge low does not affect performance. Breakout day volume. Heavy breakout volume pushes price higher than does light volume, but I'm not sure this is meaningful. Few people are searching for diving board patterns anyway, but when price breaks above a prior peak, the breakout, I'd expect volume to increase when the bulls go on a buying spree and push price higher. Table 25.7 shows how often price will drop and touch a stop-loss order placed at various locations on the board, not including the plunge. I measured the drop from the week after the breakout to the ultimate high and compared it to the various points in the board, from the highest peak to the lowest low before the plunge occurred. Price will drop to the top of the pattern 74% of the time and less often to the middle and bottom of the board. I'm surprised that the 74% number isn't higher, but it's like buyers are saying, we want price to go higher. Now, if you wish to use this number, then placing a stop at the top of the pattern will trigger 74% of the time on average if your trade behaves like the average. Placing it in the middle of the board will cut the stop-loss triggers substantially, to 23%. Obviously, you'll want to determine how big a loss you'll incur if the stop triggers and adjust the stop placement accordingly. For long-term holds, for which this pattern is best suited, you may wish to not place a stop and just monitor performance periodically. Remember, it takes 2 years for price to reach the ultimate high on average. If you use a stop, you'll likely be taken out of the trade before it reaches its maximum price. Table 25.8 shows how the diving board pattern has performed over the decades. Performance over time. The 1990s had the fewest samples, 167, and the 2010s had the most, 395, so maybe the descending performance reflects the sample count. That is, as more samples become available, performance drops. Failures over time. Failures show a similar trend. The bigger the gain, the lower the failure rate. Table 25.9 is supposed to show performance for busted patterns, but I didn't analyze them for this pattern. Thus, you won't find Table 25.9 in the book. Trading tactics. Table 25.10 shows trading tactics. Measure rule, targets. The sample trade will give an example of how to use the measure rule. I found that if you use the full height of the pattern from the top of it to the low at the plunge and add the height to the top of the pattern, price will reach the target 62% of the time. That's if your pattern behaves like the ones I found. For a closer or farther target, adjust the height in the calculation accordingly. The bottom of the table shows how often the measure rule works for varying heights used in the calculation. For example, if you cut the height in half, the stock will reach the target 79% of the time on average. Once you know the height, you can divide it by the breakout price and check it with Table 25.3, failure rates. In the sample trade, we'll find that the height of a diving board pattern is 16.49 with a breakout price of 80.53 or 20.5%. Table 25.3 says that 28% of the patterns will fail to see price rise more than 20%, the closest to 20.5%. So you have a 72% chance of having a winning trade. That's quite good, but it depends on how you trade, of course. Stop location. Table 25.7 discusses stop placement, so make sure you check that table to understand the likelihood of being stopped out. Also, convert the potential loss into a percentage of the buy price. If the percentage is high, then you may wish to adjust the stop placement so you won't lose too much. However, with long-term trades like this one, you may wish to not place a stop. Just monitor the stock periodically and sell if the stock shows weakness or if the fundamentals or technicals deteriorate enough to indicate a sale would be prudent. Ride the bounce. You can trade a diving board pattern like you do a cloud bank pattern. The bottom of the board, the part before the plunge, would be the target. Make your entry after the plunge ends if you can tell when that occurs. Good luck with that. The difference between those 2 points will be your profit. If it's high enough to risk a trade, buy the stock and hold until price returns to the board. Lower plunge. If the stock makes a second drop, one that takes price down to or below the first plunge, avoid trading the pattern. It has a higher likelihood of failing. The sample trade shows an example of this at point B1 in figure 25.5. Buy breakout. To enter the trade in a timely manner, find the highest peak in the board portion of the diving board pattern. Set a buy stop a penny above this price and wait for the order to hit. Expect to hold the stock for months to a year or two to achieve the full potential of the diving board pattern. If the stock doesn't go up, then don't buy it. That's a joke. Bounce trading. Table 25.11 shows statistics that may help you decide if a bounce trade is worthwhile. The table applies only to bull markets. How many diving board patterns don't see price rise to the board, that is, they break out downward, not upward? Answer: 29%, not shown in the table. If you try to buy after the plunge ends and hope to see price return to the bottom of the board, you'll be wrong 29% of the time, on average, if your trade follows the patterns I found. That means you should be able to make money 71% of the time using this setup. You'll want to place a stop below the bottom of the plunge and consider adjusting it as price rises. Plunge depth versus performance. I measured from the lowest price in the board to the plunge low for all patterns in bull markets, sorted by breakout direction. The table shows the median mid-range plunge, 14%, 19%. If price rises from the plunge low to break above the top of the pattern upward breakouts, the depth of the plunge didn't matter much, gains of 75% versus 72%. However, downward breakouts tell a different story. Plunges shallower than the median 19% see price retrace 22% on average before heading lower and breaking out downward. Deeper plunges see price rise an average of 62% before heading back down. What does this mean for trading? If you're trying to catch the bounce, the larger the drop from the board, the larger the bounce. I found this same behavior in an event pattern called the dead cat bounce. Board length versus performance. The median length of the board doesn't vary much depending on the breakout direction. However, long diving board patterns, from pattern start to plunge start, seems related to performance. Long patterns outperform short ones substantially, as the table shows, for both breakout directions. Please note the difference between board length in this table and the width in Table 25.5. Table 25.5 includes the plunge, but Table 25.11 does not. Experience. Let me share one diving board trade with you. It's a cautionary tale that things might not work out as you expect or hope. I show the setup in Figure 25.4 on the weekly scale. Williams Companies, Inc. WMB started building a diving board in the summer of 2016, and it continued through November 2017. I'm scratching my head looking for the plunge. I think it's at C. The drop below the board low represents a decline of 3%. That's well short of the median plunge shown in Table 25.11, 14%. Apparently that didn't bother me because I made no mention of it in my notes. I was focused more on the flat base as a launching pad and a zone of future support in case the trade went bad. Let's go through the pattern. The board is at a flat base with price touching the bottom of the range several times over the months. The top of the board is at B. A close above B means an upward breakout. C is the plunge. A close below C would mean a downward breakout. On 19 December 2017, I bought and show the approximate date weekly scale at D. Notice that I didn't wait for an upward breakout. Here are my notes to the trade. I bought less than a full position, about 75% of full size, with the position size automatically determined by market and stock volatility. My computer calculated a volatility stop of 28.77 for a potential 4.6% loss, but this was a long-term holding, so I didn't use a stop. Upside target was 47. That was the first sign of significant resistance set up by two valleys in 2015. The stock and market trends were up over 1 and 2 months, but mixed at 6 months, stock was down but market was up. The industry was mixed over those 3 measurement periods too, with about half of the stocks trending higher and half not. I like to see my trades have all 3, stock, market, and industry, trending upward. Finally, the stock's relative strength against the Standard & Poor's 500 index was rising, meaning the stock was outperforming the general market. By reason, diving board has completed and price is moving up. Has a 4.04% yield at 30.14, which is very good. So this is like a utility but with upside potential if the diving board plays out. S&P says buy, as of 14 November 2017 when stock was at 27.83. Says dividend was cut 69% in 2016. Wow. Insiders, mixed buying and selling. Small buying 1K, 5K, 15K, 17K in May-June. Selling of 10K and 81K in May. Other selling in Aug, Sept, Nav, biggest was 272K in Sept. Small buys in August 5K and November 6K, 6K. Just saw now after I bought that they have 141% debt as percentage of equity or $21B in long-term debt. Current ratio is 0.97. Wow. Payout ratio is 193%. Jeepers. I bought this without doing enough investigating, I think. This sucker is high risk. S&P says it's undervalued fourth, with 5 being most undervalued. Says percentage of long-term debt to capitalization is 60%, but that's looking forward a year, I think. Statistics show the same benchmark in 2016 as 60%, up from 58.5% in 2015. Apparently, they don't view debt as a pressing problem. The stock broke out upward at F. However, at E, I changed my mind about the stock. Here's what I wrote for the sale. Date sold, 18 January 2018. Sell reason, weakness. Industry is mostly headed lower. This is a high-debt, high-risk co. They had permission to build a pipeline denied a week ago, and the stock has dropped on the news. I think it's time to get out near the top. Based on the bid/ask spread, this looks to open lower, below 32. Yuck, filled at 32.24, slightly lower than yesterday's close. The stock made a slightly higher high at G and then started down. COVID-19 pulled the rug out of the stock at H, where it bottomed at 8.41, or 74% below my sale price. My spreadsheet of the trade says I made 7%, but didn't collect any dividends along the way. I was late entering and late exiting. I'm not so sure I agree with that assessment. The optimum buy location should be a penny above the breakout price, and I bought in well before that, but also well above the bottom of the board. Perhaps I was thinking that the bottom of the board was the optimum entry price. If that's the case, then yes, I was late getting into the trade. As to the exit, I sold daily chart, not shown, right at the valley of the double top. Sigh. If I had sold it either 3 days earlier or 3 days later, I'd have a perfect exit, and yet selling when I did locked in a small profit and avoided a huge loss. Here are my lessons from the trade. Lesson: do better homework. Finding out the company was loaded with debt after I bought was a mistake. Lesson: stocks that cut their dividend rates outperform a year later. I learned this when researching dividends in my book, Fundamental Analysis and Position Trading, Evolution of a Trader, Wiley, 2013. Owning a stock that cuts the dividend is painful, but the year-ahead performance can be rewarding. Lesson: use a buy stop a penny above the top of the pattern as the entry price. Had I followed this, I'd have made less, but it's the proper way to trade a diving board. Lesson: when fundamentals change, sell. That's what I did when I learned the company lost permission to build the pipeline, selling locked in a small profit instead of a whopper of a loss. Sample trade. Figure 25.5 shows a trade Rich made in a diving board pattern, so let's dissect it, beginning by crunching the numbers. The board begins the week of 7 May 2018, A, and ends on 17 September 2018, A1, for a length of 134 days. Table 25.11 says that it's a short board. Note that the length of the board does not include the plunge A1 to B. Otherwise, the width is 176 days narrow for Table 25.5, as measured from A to B. Both tables suggest underperformance. Height of the diving board pattern for Table 25.10 is the difference between the high price in the board, 80.53, shown as the horizontal line ending at C, and the plunge low B, which is at 64.04, for a height of 16.49. If we assume an upward breakout, the height to breakout price ratio would be 16.49/80.53 or 20.5%. That's short according to Table 25.5, and it also suggests underperformance. Let's talk about the measure rule. The height of the pattern from the top of the board to the plunge low is 16.49, as I already mentioned. Adding the height to the top of the pattern gives a target of 80.53 plus 16.49 or 97.02. Table 25.10 says there's a 62% chance of making it to the target using the full height, which we did. Using half the height would improve the chances to 79%, from Table 25.10, of reaching 88.78. For bounce trading, Table 25.11, the plunge measures from the bottom of the board, 73.62 to the plunge low as a percentage of the board low, or 73.6264.04/73.62 or 13%. The plunge is shallow, and that suggests underperformance. We already calculated the board length and found it to be short, too. The statistics suggest this pattern will underperform. Regardless of the probabilities, anything is possible, so Rich decided to trade the pattern anyway. I searched and searched and searched, but couldn't find any reason for the plunge from A1 to B. Because earnings were due to be announced the week of Candle B, I thought that maybe the smart money was selling ahead of the earnings announcement. He wasn't lucky enough to catch the Candle B rise. Indeed, he was looking for a longer-term hold to capture some of the mouthwatering results this chapter describes. He understood that the results are based on trading hundreds of diving board patterns perfectly, but grabbing a share of a 73% average rise was too tempting to ignore. The week before I bought, the company announced annual earnings which the market liked. I placed a buy stop a penny above the top of the pattern, and it filled at 80.54. Because predicted performance of the pattern was dismal, as described above, he decided to use half the height as a measure rule target, or 88.78. Looking at the chart, the drop 2 months after B, shown as B1, didn't concern him because he hadn't bought the stock yet. However, the stock did form a confirmed double bottom, which was gratifying, but he didn't like how volatile the stock was. The quick drops were unnerving. After buying at C, the stock retraced and moved higher to D, peaking at 86.62, just short of the 88.78 target. He hoped the stock would continue higher, but he also knew the next earnings report was due on 2 May 2019, a week after the stock peaked. When the company announced earnings, the stock gapped open lower, so I sold this bad boy at 80.13. On the trade, he took a loss of 41 cents a share and was glad he sold. The stock dropped to E, bottoming at 62.35 for a potential giveback from the high D of 28%. Instead of making 73%, he took a small loss. Notice that this diving board pattern formed a lower plunge at B1. Rich took the trade anyway and paid the price. Chapter 26, Double Bottoms, Atom and Atom. Results snapshot. Appearance, twin bottom pattern with narrow V-shaped or spike bottoms. This is the first of 4 chapters on double bottoms. Each chapter represents a different bottom shape, a variation described by Adam and Eve designations. An Adam and Atom double bottom reminds me of a person on stilts, narrow legs, V-shaped, perhaps made of single spikes that touch the ground near the same price. The results snapshot shows the important numbers. Atom and Atom double bottoms have slightly above average break-even failure rates and mediocre average rises. That places the performance rank in the bottom half of the list of chart patterns. Throwbacks occur in 2 out of 3 trades, so you may be able to add to your position or initiate a new one during a throwback. Let's take a tour to see what the pattern looks like. Tour. Figure 26.1 shows the first example of an Atom and Atom double bottom. Since we are looking at bottoms, the pattern forms at the end of a downward price trend, and it acts as a reversal of that downtrend. The pattern can also appear in the corrective phase of a measured move up. Price trends upward, forms the double bottom during a retrace, and then continues trending upward. Notice the twin spikes bottoms that happen so often in this pattern. They drop well below the surrounding price lows yet bottom near the same price level. If the bottoms are not single spikes, then they take on the shape of a narrow V. Eve bottoms, by contrast, are wide and rounded looking. Price recovers between the 2 bottoms. The rise need not look rounded. Many times it appears irregular. Volume is higher on the left bottom than on the right, as in this example. Thus, the volume trend recedes across the pattern. The confirmation line marks the highest high in the pattern. A twin bottom pattern is not a valid double bottom until price closes above the confirmation line. That occurrence signals a breakout and time to take a position in the stock. But before you do, check the identification guidelines to be sure you have a good pattern. Identification guidelines. Table 26.1 shows guidelines for identifying Atom and Atom double bottoms. Appearance. The shape of each bottom should appear similar. That means both bottoms should look narrow, V-shaped, perhaps with a long downward price spike or tail. To gauge the width, look at the top of the bottom. I know that sounds confusing, but the top end of the valley will tend to remain narrower than Eve bottoms along their height. Eve bottoms, by contrast, will appear more rounded and wider than will their Atom counterparts. When judging bottom shape, Ask yourself if the two bottoms look the same or different. If they look the same, then you have either Adam and Adam or Eve and Eve bottoms. Narrow bottoms signify the Adam variety and wide bottoms signify the Eve variety. Price trend. Look for price trending downward into the start of the chart pattern. Thus, the double bottom acts as a reversal of the downward price trend. How long should the inbound trend be? As measured from the trend start, see glossary trend start for definition. Intermediate to long-term trends perform best. That's a trend longer than 3 months. Rise between bottoms. In the past, traders used to look for a rise between the two bottoms of more than 10%, as measured from the lowest bottom low to the highest high between the two bottoms. That's an arbitrary value. I don't pay much attention to a minimum height, except to say that taller patterns perform better than short ones. For example, consider figure 26.2, which shows a valid Adam and Adam double bottom center pattern and a potential one upper left at ABC. The center Adam and Adam pattern has two narrow, V-shaped bottoms and volume that is higher on the left side than on the right. Twin bottom AB, upper left of chart, does not have Adam-shaped bottoms. The bottom at B is wider and more rounded looking than what we expect to see in an Adam and Adam pattern. So this potential double bottom is an Adam and Eve pattern or perhaps an Eve and Eve. The rise to C is just 4%. That's fine but well below the 10% or higher I like to see. Bottom low price. From the lowest low on the left bottom to the low on the right, the price variation should be small. For example, do not try to assign double bottom status to the right bottom of the Adam and Adam in October and point D in figure 26.2. Point D does not drop close enough to the right bottom to qualify it as a valid bottom. The median variation between bottoms was just 1%. Bottom separation. How far apart should the bottoms be? Some texts say that bottoms must be at least a month apart, but I set no such limit. The median in my database was 16 days wide from bottom to bottom. Volume. The left bottom usually shows higher volume than the right one. However, volume higher on the right side should not exclude the pattern from consideration. Figures 26.1 and 26.2 show volume higher on the left bottom than on the right one. Breakout direction, confirmation. The breakout from a double bottom is always upward. If price does not close above the highest peak between the two bottoms, then you don't have a double bottom. A twin bottom pattern is not a valid double bottom until price closes above the high between the two bottoms. Always wait for confirmation before taking a position in a stock because price continues down 48% of the time. Figure 26.3 shows two examples of Adam and Adam double bottoms. Are they valid double bottoms or just twin valley patterns? In both cases, the price trend leading to the patterns is downward, as required, so they are bottoms and not tops. The bottoms are pointed with one-day spikes. All bottoms are V-shaped, not wide, rounded turns. The rise to the confirmation line, that is, the pattern's height, is 24% for the August bottom and 17% for the October pattern. The price at each bottom is close enough to each other that they look like bottoms, not steps. The time between the twin bottoms is 3 weeks for the August example and 2 weeks for the October bottom. Price rises to the confirmation point, shown as a horizontal line in a snappy manner, closing above the highest high in just a few days, but this isn't a prerequisite. The volume pattern is unexciting, including the breakout volume. In both examples, volume is higher on the left bottom than on the right, so the volume trend is downward. That's typical. Breakout volume is slightly above the 30-day average, classifying the breakout as having heavy volume. Thus, both patterns shown in figure 26.3 are valid double bottoms. However, price rises just 18% and 16% after the breakout. How can we tell the outperformers from the also-rans? Focus on failures. Figure 26.4 shows the first double bottom failure, and it is typical. The Adam and Adam pattern has valleys that form after a short-term downward price trend and bottom near the same price. The valleys are 29 days apart, with a 17% rise between them. The pattern squiggles confirm when price rises above the confirmation line. That's when it stages a breakout and the squiggles become a valid Adam and Adam double bottom. Price climbs just 2% after the breakout. Why? The first clue is that the pattern is in a bear market, which is never good for bullish chart patterns. The second clue is that there's not much of a downtrend to reverse. The downward price trend starts at the March peak, the highest on the chart, so it is not far above the confirmation line. In other words, the double bottom did not act as a reversal of the longer-term prevailing price trend, but as a consolidation. If you extended the figure to the left, you would see a long line of peaks stretching to May 2000. That line represented a massive zone of overhead resistance that the double bottom could not penetrate. A check of other stocks in the diversified natural gas industry showed that most of them were peaking in May or June. They all started tumbling at the same time. They showed topping patterns that predominated double tops and triple tops, signaling a downward price trend. Thus, a smart investor would have not taken this trade. Figure 26.5 shows an example of a second type of failure that perhaps you have seen. Here's how Ted traded it. Ted is a novice investor with an attitude. He looks at the stock chart, checks the identification guidelines, and believes that the stock is making a double bottom. When price rises after the second bottom, Ted decides to pull the trigger early and buys the stock, receiving a fill at 42.63. He reasons that all the indications suggest the stock has completed a valid double bottom, so why not buy now? Ted makes a good point. He is pleased with the stock's performance until it begins to round over. Does he sell out now at a small profit, or should he hold on and risk a downturn while waiting for additional gains? This is a recurring dilemma for traders. He decides to hang onto his position. During May, the stock surges upward again before beginning a downhill run. Ted watches in horror as his profit vanishes and losses mount. Eventually, when price spikes downward, he sells at the opening the next day and closes out his position. What did he do wrong? He failed to wait for confirmation. Price must close above the confirmation point, above the peak between the two bottoms before a trade is placed. Otherwise, your chances of success are diminished. 48% fail to confirm actually. Statistics. Table 26.2 shows general statistics. Number found. I found 1295 patterns in 662 stocks starting from the first one in August 1991 and the most recent one in February 2020. But not all stocks covered the entire period and some no longer trade. Bear market samples were removed from the tally because they were too few to include here. Reversal R, continuation C occurrence. The atom and atom pattern is a bottom and not a top. Thus, price enters the pattern going down and breaks out upward, so it acts as a reversal of the downward price trend by definition. Average rise. The average rise is shown in the table. It's below the 42.4% average for all chart patterns. Standard and Poor's 500 change. The S&P 500 index climbed and helped push individual stocks higher. I measured the rise in the index from the date of the double bottoms breakout to the ultimate high. Even with the general market helping push the stocks higher, the chart pattern still underperformed other chart patterns. Days to ultimate high. The pattern takes 7 months to reach the ultimate high, on average. Every trade is different, but it suggests traders need to be patient as price rises over the long term. However, the median is just 73 days. The difference is because some patterns just trend up and don't reach the ultimate high for years. Whether it takes 2 months or 7, ride the stock as long as you can before it bucks you off. How many change trend? This is a count of how many patterns see price rise more than 20% after the breakout. I like to see values over 50%, and double bottoms qualify. Even so, the average for chart patterns is 55%, so atom and atom patterns are a bit shy of the mark. Table 26.3 shows that double bottoms have a 5% failure rate that is above the average, meaning worse, of other chart pattern types. I show a list of failure rates in the table. For example, 16% of the patterns in bull markets fail to see price rise more than 5% after the breakout. Almost a third, 31%, rise less than 10%. Notice how the failures get worse as you scan down the rows. However, the increase from row to row isn't as steep as we've seen in other chart patterns, except for the move from 5% to 10%, where failures almost double. Another use of Table 26.3 is to check on the measure rule prediction discussed in the trading tactics section later. Suppose the rule predicts a move from 10 to 13. That is a 30% rise. How many patterns will see price rise more than that? Answer: 38%, 62% on average will fail to make it that far. Thus, it appears that a 30% target is too far away, but you could get lucky. Table 26.4 shows breakout-related statistics. Breakout direction. By definition, the breakout is upward when price closes above the highest peak between the two bottoms. All double bottoms have upward breakouts, otherwise they are not valid patterns. Yearly position performance. I sorted the double bottoms breakout price into where it occurred in the yearly price range. The best performing patterns have breakouts within a third of the yearly low. Avoid trading those near the yearly high. That suggests a bottom fishing strategy, buy low, sell high, would work well with double bottoms and not a momentum play, buy high, sell higher. Throwbacks. A throwback occurs in 2 of every 3 trades. That is a high return rate. Thus, if you missed investing in a double bottom, you may have another opportunity if it throws back. The average round-trip return time to complete a throwback is 12 days, which is typical for chart patterns. Notice that when a double bottom throws back, performance suffers. To avoid a throwback, look for nearby overhead resistance. The good news is if price does throw back, it resumes the upward trend 72% of the time. Gaps. Breakout day gaps help performance, but not by a huge amount. Table 26.5 shows statistics related to size. Height. Do tall patterns perform better than short ones? Yes. To use this finding, measure the height from the highest peak to the lowest bottom in the pattern and then divide by the price of the highest peak. Compare the result with the median shown in the table. A value higher than the median means you have a tall pattern. Lower than the median and you have a short one. Trade only tall patterns for the best performance. For the atom and atom pattern, the performance difference between short and tall is especially wide, so height is something you'll want to pay attention to. Width. Wide patterns outperform narrow ones by a substantial amount, so select wide patterns. I used the median length as the separator between narrow and wide. Height and width combinations. We've seen that tall patterns do especially well and wide patterns do well too. Does the combination tall and wide also outperform? No, tall and narrow shows a minor performance improvement over tall and wide. The numbers suggest you avoid short patterns, either narrow or wide. Table 26.6 shows volume-related statistics. Volume trend. Volume trends downward in almost 2 of 3 cases. Does performance change depending on the up or down volume trend, rising/falling volume? Answer: no. I didn't see any performance difference between the 2 trends. Breakout day volume. Often heavy breakout day volume suggests better performance, but not for this chart pattern. The performance difference between heavy and light volume is high enough that maybe you should pay attention to trading breakouts that have below the 30-day average volume. Table 26.7 shows how often price reaches a stop location. I split the pattern in half on the price scale and checked how often price reached 3 areas on the way to the ultimate high. If you placed a stop-loss order at the top of the pattern, price would stop you out 76% of the time. Move the stop to the bottom of the pattern, and the stop will hit just 3% of the time. Unfortunately, you'll take a bigger loss than if the stop is at the pattern's top. Regardless of where you place your stop, compute the potential loss as a percentage of the current price to see if you can tolerate or afford such a loss. Table 26.8 shows the performance over 3 decades. Performance over time. The Roaring 2000s showed huge average gains, 60%. The numbers do not include the 2 bear markets during the decade. The worst performance comes from the 2010s. A decade has almost half the performance rate seen in the 2000s, 34% versus 60%. Failures over time. Failures have been rising, almost doubling each decade. That's a scary thought, so maybe this is a statistic you shouldn't share with your children. Table 26.9 shows busted pattern performance. Busted patterns count. Over a quarter of patterns bust. That means price rises 10% or less before reversing and closing below the bottom of the chart pattern. Busted occurrence. I counted how often a pattern busts once, twice, or more than twice and show the numbers in the table. Most are single busted patterns. Busted and non-busted performance. I used the performance of atom and atom double tops as a proxy for a non-busted atom and atom double bottom. The busted performance, either for single busted patterns or the combination of single, double and triple plus, is better than non-busted patterns. Trading tactics. Table 26.10 shows trading tactics. Measure rule targets. Use the measure rule to compute a target price. The rule gives you a suggestion, an idea of how far price might rise after the breakout. It's not a guarantee, and we'll talk about numbers in the moment. To find the target, subtract the lowest low in whichever bottom is lower from the highest high between the two bottoms. Add the difference to the highest high. The result is the target price. For example, look at figure 26.6. The highest high is at 20, the breakout price or confirmation line, and the right bottom is lower at 15.50. Add the difference, 4.50, to the highest high to get the target, or 24.50. The bottom portion of the table shows how often price reaches the target. In this example, we use the full height of the pattern in the measure rule. That method works 73% of the time on average. Cut the height in half and you get a closer target but less potential profit. Double the height in the computation, and the success rate drops to 53%, but you could earn more. Once you have a target, visit the discussion of Table 26.3 to evaluate your chances of success. Wait for breakout. Since double bottoms act as reversals of the prevailing price trend, there is a 48% chance, I measured this in a 2018 study on the best entry, that price will continue declining instead of confirming the double bottom. That is why you should wait for a breakout close above the confirmation line, which is the price of the highest high between the two bottoms. Buying before the breakout is an easy way to lose money, but if you're right, you could make more. In my trading, I place a buy stop a penny above the top of the chart pattern to enter a trade. That means I'm not waiting for a close above the pattern and entering the next day at the open, but statistical results show the failure rate drops and the median rise increases slightly with this method. Trade with market trend. You'll make the most money if you trade in line with the market and industry trends. If the general market is bullish, then go long. If it's bearish, then don't add a long position until the bear market is nearing its end, like 1.5 years after it started. Check others in the industry. What are other stocks in the same industry doing? If they are showing signs of bottoming, then the double bottom becomes more important. If other stocks are continuing down, avoid trading the double bottom. Chances are the stock will fail to perform as expected. Stop location. Use Table 26.7 to assess the probability of a stop being hit. Swing traders will want to use a stop on most trades, but buy and hold investors will want to avoid them. Busted trade. Table 26.9 shows that busted double bottoms work better than non-busted double tops. A busted double bottom provides an easy entry signal for a short sale. Table 26.11 shows special features of double bottoms. Bottom-to-bottom variation. I measured the bottom-to-bottom price variation and found that it was smaller than I expected, 1%. I sorted performance of atom and atom double bottoms by whether price showed a smaller or larger variation. The table shows when the bottom-to-bottom price difference had a variation greater than the median, performance improved significantly. I don't know why this might be. I can understand if the right bottom is above the left, then that would indicate buying enthusiasm. The problem is it doesn't work. Why? The number item explains. Lower bottom. I checked performance depending on which bottom was lower. There's not a big performance difference as the table shows, but since you have a choice in the double bottoms you pick to trade, look for ones with a bottom on the right lower than the one on the left. Experience. Let me share some of my experience with the atom twins to see what lessons I can pass on. KB Home Corp. KB Home Corp, KBH, in 2010 made an atom and atom double bottom which confirmed. On 2 August I bought. Upside target was 16 and then 20 versus a buy price of 11.65, so the target was far away. Stop location was 9.91, which was closer than the volatility stop of 9.68 and below round number 10 support area. From my notebook, weekly scale industry 2, weak with many stocks making bottoms. The housing industry seems poised to make a turn upward here. Bad news, the stock's relative strength against the S&P 500 is falling. By reason, confirmed double bottom with a straight line run down. I expect this to V-bottom and make a B-line run back up, but if the market tanks, then sell below support at 9.91. Do not ride it down. I didn't use a buy stop a penny above confirmation optimum entry. Instead, I bought after the throwback completed and the stock started moving back up, second best entry option. Over the next week, the stock went down for 3 days and then recovered. After that, it just went down. Sell reason: the stock has broken through support at the double bottom low and it's going down. Time to sell. This could be a broadening bottom forming, but my guess is the stock will not bounce off the lower TL, which is what I hoped would happen today. The market has been down 3 days in a row, and I expect it to bounce back, but things seem to be getting worse this morning. I'm just going to sell this turkey. Filled at 9.5701. A hard stop just above 10 would have improved results, but 10 is a round number. I can never make money trading these housing stocks. Existing home sales were much weaker than expected, but the stock opened lower, dipped, and then climbed to close higher. Sigh. Today, 25 August, new home sales will be announced, and they are expected to be weak. Maybe that will take the stock down. I sold the day the stock bottomed. It moved up in a choppy manner until reaching the ultimate high at 16.11 short of the 20 target in January 2011. This double bottom double busted, taking 17% from me. That's double what I like to see. Lesson: a buy stop placed a penny above the top of the chart pattern would have lowered the entry price. Lesson: keep losses small. A hard stop one placed with the broker, a penny or two below the lower of the two lows would have limited losses. Charles Schwab Corp. A trade in Charles Schwab Corp. Schwa didn't work out either. 21 November 2002. I bought at market, filled at 11.72. This is an ODB trade with a +1 score. Merrill upgraded the stock and it broke out, paused at overhead resistance at 11.50. I expect to climb to 12.13 where it'll meet resistance and pause. With effort, it'll push through this and move higher as the bull market comes back. Downside is a drop to 9, the bottom of a support range 9.10. Neckline is at 8.50, so that may also add support. Median rise is 12.49 and I hope it'll beat that. I now expect a retest of the breakout, but we'll have to see. Other brokerage stocks are struggling. The double bottom formed a head and shoulders top as a new pattern between the two bottoms. The neckline of that pattern was at 8.50. After I bought, the stock made a symmetrical triangle with an upward breakout. That looked promising, but the stock reversed and headed lower. Here's the sale: 21 January 2003. I sold today because the stock has dropped through triangle apex support on a poor earnings announcement. Filled at 10.90 for a loss of 7%. Reason for sale: the symmetrical triangle didn't perform as expected, so it was time to get out. Again, I was late buying into the stock, which cost me. The stock continued down to 6.25, a drop of 43% below where I sold. Fortunately, I sold promptly and kept the loss reasonable at 7%. Lesson: beware of earnings announcements. This one chopped the stock price almost in half. Even people who buy and hold should pay attention to earnings and earnings warnings. Often selling immediately is the correct choice. Southwest Airlines. In late February 2002, Southwest Airlines Love stock peaked at 22 and slid all the way down to 10.90, where it formed the first bottom of an atom double bottom. The second bottom appeared about a month later, in mid-August. 2 days after it bottomed, before confirmation, I was in there buying, trying to pull back on the stick to keep the airline from hitting ground. 16 August 2002. I bought at market open, filled at 12.45. I think this has bottomed even though UAL might go bankrupt. It appears that this might be an atom double bottom, providing prices climb above confirmation. That might be tough in the short term as the market is nervous and airlines are the pits. I'll buy more if this descends to 11 or so, maybe in NAV, then pray for a rise into the spring as airlines usually take off over that time. Much to my surprise, the stock climbed and confirmed the double bottom. Yippee! The stock threw back to the breakout price. As one might expect, they happened 67% of the time, except this one kept going down and down. It bottomed at 11.23, or 27% below the high price. 15.30 reached just before the throwback. After the stock bottomed, it looked like a triple bottom, which saw the stock recover and confirm too. The stock bounced up and down around the triple bottom's confirmation price. On 14 November 2002, I wrote, "I'm going to sell my shares at market open." CCI shows negative divergence, and that's the key issue. Other airline stocks are bumping against overhead resistance, so I expect a decline. Although it's November, a good holding period, I think a short-term decline from a budding aught is in order. We could drop to 13, maybe 12, then buy it back. For now, take the money and run. I sold at 15 and made 20% on the trade, including a small dividend. If I had stayed in the trade for 2 more weeks, I could have sold at the ultimate high of 16.70. After that, the stock tumbled by 30%. Lesson: wait for the breakout, otherwise you risk losing 48% of the time. In this case, buying early worked well. Lesson: if it was a swing trade, it wasn't supposed to be. Having a defined exit price of 15 would have cashed me out in about a week when the stock peaked at 15.30. Lesson: I no longer use indicators. This took me out of the trade too soon, but at least I didn't ride the stock back down. Sample trade. Randy traded the stock shown in figure 26.6 and made a tidy sum of money. Let me tell you how he did it. First, he qualified the pattern as a true double bottom by reviewing the identification characteristics listed in table 26.1. Briefly, the stock started down in early January after a long-term uptrend that began in February 1995, not shown. The twin bottoms were narrow with one-day downward spikes. The rise between bottoms measured 29%. The bottom lows were 1% apart in price and separated by 64 days. Oddly, the right bottom showed higher volume, making for an upward volume trend. I placed an order to buy the stock at the confirmation price, and it filled at 20. The stock struggled by moving sideways for a week, then achieved liftoff. Price climbed until early June when it started retracing. The retrace turned into a throwback when price pierced the confirmation line at 20. I expected a throwback, but nobody expects the Spanish Inquisition. That's from Monty Python. Price moved up again and retraced, forming the handle of a cup with handle pattern. I got cute. I drew a down-sloping trend line along the handle, and the day after price closed above the trend line, I bought more at 22.73. He computed the target price for the double bottom, 24.50. See the measure rule in table 26.10, and smiled when price passed that, moving up. Then, he drew an up-sloping trend line following the contours of the handle, called the sell trend line in figure 26.6. I vowed to sell the day after price closed below the trend line, which it did in late November, at 32. That was down considerably from the high at 38.19, but he made 60% on his first trade and 41% on the cup with handle trade. Chapter 27, Double Bottoms, Adam and Eve. Results snapshot. Appearance, twin valley pattern with one narrow and one wide-looking bottom. The Adam and Eve chart pattern is a variation of the double bottom. The Adam bottom looks narrow and V-shaped, perhaps with a large downward price spike. The Eve bottom is wide, rounded-looking, and sometimes has many short spikes like weeds sprouting in a lawn. The two bottoms should look different from one another. Performance is similar across 3 of 4 combinations of Adam and Eve double bottoms with the exception, Eve and Eve showing superior performance. However, I treat each variation as a separate pattern just to be sure. The results snapshot shows the important performance numbers. The average rise in bull markets is slightly above the average for all chart patterns, 42.4%, placing the pattern's rank at 17 out of 39 where one is best. Throwbacks occur 2/3 of the time, but when they happen, performance suffers. Let me give you a tour of this chart pattern. Tour. Figure 27.1 shows an example of an Adam and Eve double bottom. It's not a good example, but it'll do. The Adam bottom seems to be an outlier in an otherwise straight line run down to the Eve bottom. And Eve, on this aspect ratio of width to height, looks V-shaped too. On my computer screen, both look better than shown here. However, my reading glasses may need adjustment. That, of course, brings up the first problem: how do you tell an Adam bottom from Eve? I programmed my computer to find them. It can differentiate between Adam and Eve consistently, not subjectively. I started to put the algorithm in the glossary but gave up. It's too complicated to describe in words, and few readers will care anyway. Oftentimes you can look at pattern and determine the Adam or Eve combination. When I look at this figure, my eye goes to the vertical line above the Adam label. The line points to the gap, but that line is the price bar which created the area gap when price opened lower. I checked 2 data sources to be sure I had good data for that price bar. The results are correct. The Adam and Eve double bottom appears after a long downward price trend in this example. The atom bottom is narrow, a one-day price spike in this example, but the eve bottom is wider and composed of several short price spikes. Not only is this atom bottom unusually long, but the price bottoms are uneven. More often, the price variation between the two bottoms is slight, which segues into the next section, identification guidelines. Identification guidelines. How do you identify an Adam and Eve double bottom? First, let us look at a few examples to get a better feel for what's involved. Figure 27.2 shows a double bottom midway up a price trend that began in March 2003. I show this as an example of the double bottom acting as the corrective phase of a measured move-up chart pattern. The double bottom allows price to regroup before renewing the attack on a new high. The atom bottom is a one-day downward price spike. The eve bottom also has a spike, but it is shorter, and the nearby wide price congestion differentiates the eve bottom from the narrower atom bottom. The two bottoms look different, skinny and fat. Figure 27.3 shows a better example of an Adam and Eve double bottom, except this one is part of a longer-term downward price trend. Price reverses after the pattern ends by moving up for a few months before easing back down. Again, the Adam bottom appears narrow, V-shaped, and the Eve bottom is wide and more rounded looking. Eve typically has several short price spikes and Adam has few, usually one or two. Table 27.1 lists identification guidelines, so huddle up. Let's discuss them. Appearance. The two bottoms should appear different from each other. The left bottom, Adam, should be narrow, pointed, and V-shaped, perhaps as a one-day downward price spike. The right bottom, Eve, should be wider and rounder, not V-shaped. Price trend. Since we are dealing with bottoms and not tops, look for the pattern to appear at the end of a downward price trend. Trend need not be very long, as figure 27.2 shows with the June peak, but the classic situation is like that shown in figure 27.3. Price declines for several weeks or months leading to the pattern. Rise between bottoms. I removed the minimum price rise between bottoms of 10% because I prefer to let the double bottom pattern tell me how tall they should be. However, taller patterns perform better than do short ones, so keep that in mind as you search for a valid double bottom. The median height in the samples I looked at is just over 12%, probably because of the 10% minimum standard in patterns I used years ago. Bottom-low price. The two valleys should bottom near the same price. Figure 27.1 pushes the limit because the bottoms differ by 8%. Figure 27.3 is a better example as the bottoms are closer together. Bottom separation. How far apart in time should the bottoms be? The median width is 25 days, measured from bottom to bottom. Wide patterns tend to outperform. Price rise after right bottom. The rise from the right bottom to the confirmation price may be brief, but it usually takes a median of just under 2 weeks, 13 days. If price makes a third bottom before confirmation, then you don't have a valid double bottom. Volume. Most Adam and Eve double bottoms will show volume heavier on the left bottom than on the right. Do not exclude a pattern if it has volume higher on the right bottom. Breakout direction. The breakout is always upward in a valid double bottom pattern. A breakout occurs when price closes above the highest peak between the two bottoms. It confirms the double bottom as a valid chart pattern. Only then should you consider buying the stock. I use the closing price in my statistics because it helps prevent premature breakouts. Why do double bottoms form? To answer that question, consider the double bottom shown in figure 27.4. After reaching a multi-year low in June, price recovered some of its losses by rising, leaving behind an atom bottom. A retrace of the downward move is common, with a retest of the low typically following. A retest is just like it sounds. Price returns to the low set earlier and it tests to see if the stock can find support at that price level. If it cannot, price continues moving lower. Otherwise, the low becomes the end of the decline and the stock begins to recover. Such was the case depicted in the figure. It's clear from the volume pattern that many investors believed the low, shown as point B, was a retest of point A. Volume surged on 2 occasions in the vain hope that the decline had ended. Investors were wrong. Price held at 21 for a week before continuing down. As price headed toward the level of the June low, the atom bottom, volume surged again. This surge marked the end of the downward plunge. Price hesitated at that level for slightly less than 2 weeks before turning around and heading up. A double bottom is nothing more than a retest of the low. Investors buy the stock in the hope that the decline has finally ended. Sometimes they are right, and sometimes they are not, which leads us into the next section, failures. Focus on failures. It is obvious that the pattern pictured in figure 27.5 is a valid double bottom. The first bottom occurs after a downward price trend, as you would expect. The two bottoms are far enough apart, the rise between them is sufficient to delineate two minor lows valleys, and the price variation between the two bottoms is small. The volume pattern is unusual in that the second bottom has a higher, denser volume pattern than the first. However, this is not significant. After the second bottom, price rises at a steady rate until the confirmation point. Then price jumps up and pierces the price of the prior minor high at about 40.63. When price closes above the confirmation line, it signals a breakout and swears the double bottom formation is a valid pattern. In this case, as is common for many double bottoms, price throws back to the breakout price. However, this stock continues moving down. Scrolling figure 27.5 to the left, you would see price making a new low in September 1993 at 31.63, not shown, below the February low of 34. Had you purchased this stock on the breakout and held on, you would have lost money. I call this type of failure a 5% failure. Price does not rise by more than 5% above the breakout price before heading lower. 5% failures happen more often than I like to see. Anything above 0 is too high. But the failure rate for Adam and Eve patterns ranks 14 out of 39, where a value of 1 is best, fewest failures. That's not too bad. Let's talk numbers to see how the average pattern performs in bull markets. Statistics. Table 27.2 shows general statistics. Number found. I found 1163 double bottoms in 680 stocks, with the first one appearing in July 1991 and the most recent in February 2020. As many patterns as that sounds, there were not enough appearing in bear markets, so I removed them from the presentation. Not all stocks covered the entire range, and some have the audacity to no longer trade. Perhaps they're shy. Reversal R, continuation C occurrence. By definition, a double bottom acts as a reversal of the downward price trend when price breaks out upward from the pattern. Average rise. The average rise is a smidgen above the average shown by all chart patterns, 42.4%, placing the performance rank for the pattern at 17 out of 39 patterns. That's slightly better than mid-range, Standard and Poor's 500 change. As double bottoms were climbing 43%, what was the general market doing? The S&P climbed 13%, helping individual stocks to climb as well. Technically, that's not really accurate, is it? The average is composed of 500 stocks, and as a group, they moved higher from the date of the double bottoms breakout to the date of the ultimate high. However, one could argue that the enthusiasm shown by the group encouraged investors and traders to buy stocks, and the rising tide lifted all boats. Days to ultimate high. How long does it take to reach the ultimate high? Answer: 7 months on average. Thus, be patient but do not fall asleep at the switch. Not all double bottoms will take that long before starting a massive decline, one that either takes price down by more than 20% or below the bottom of the pattern. How many change trend? I like to see values above 50% for chart patterns. To qualify for a trend change, a stock must see price rise more than 20% after the breakout. The average for all chart patterns is 55%, so Adam and Eve double bottoms slightly outperform the other pattern types. Table 27.3 shows failure rates. How do you read the table? Let me give you a few examples. In bull markets, 12% of the double bottoms will fail to rise more than 5%. Half will fail to rise 25%. The table shows how quickly the failure rates rise for a given price climb. Notice how failures double from 12% to 25% as the maximum price move rises from 5% to 10%. The table gives you a sense of how difficult it can be to make money trading chart patterns. Let's look at this table differently. Suppose you want to make 20% on your trade. How often will price fail to see that kind of return? Answer: 43% of the time. Thus, you have to let your winners ride and cut your losses short before the loss gets so big that brokers can't afford to close your account. Table 27.4 shows breakout-related statistics. Breakout direction. Price breaks out upward all of the time by definition. Remember, for this study, a breakout means a close above the highest peak between the two bottoms, yearly position performance. Mapping performance onto the yearly price range split into thirds shows that the best performance comes from patterns with breakouts near the yearly high. Avoid those with breakouts within a third of the yearly low. It's possible that the best performing pattern looks like that shown in figure 27.2 as part of a longer-term uptrend. I checked this idea and found only 49 patterns where the price trend using the trend start was upward. But those double bottoms saw price gain a massive 64% compared to the 975 others with downtrends that gained 42%. Using another method, the primary trend, which looks back 1 year before the chart pattern, to determine the trend, the results are more modest. If the primary trend was up, then price gained an average of 42% after the breakout compared to gains averaging 44% for those where the primary trend was down. I will say that I like how the trend of the results shown in table 27.4 increases along with which third you're looking at. That is, gains rise from 38% to 42% to 47%. That's better than a mix of up and down results like 47%, 38%, 42%. Throwbacks. The next several rows in table 27.4 concern throwbacks. In 2 out of 3 samples, the stock throws back to the confirmation price. Price rises 7% in just 6 days before reversing. The round trip takes an average of 12 days. The penalty a double bottom pays if it has a throwback is big, 17 percentage points. Thus, try to select patterns without nearby overhead resistance that might force the stock back down and cause a throwback. After a throwback completes, the stock resumes rising 69% of the time anyway. That's good news. All you have to do is be patient and wait for the stock to recover after a throwback. Gaps. Breakout day gaps hurt performance, which I find odd. I've seen this in a few other chart patterns too. Breakout day gaps usually help performance, not hurt it. Table 27.5 shows pattern size statistics. Height. Tall patterns outperform short ones, and I find height as one of the premier markers of future performance. To use this finding, compute the formation height from the highest peak to the lowest low in the pattern and divide by the breakout price, the highest high. Compare the result to the median. Values above the median mean you have a tall pattern. Width. Notice that the two values for width are mirrors of the ones for height. Interesting. A statistical anomaly, to be sure. Wide patterns perform better than narrow ones. I used the median width as the separator between narrow and wide, height and width combinations. As expected, patterns that are both tall and wide outperform the other combinations, but not by much, except for short and narrow patterns. Patterns both short and narrow are the ones you'll want to avoid. Table 27.6 shows volume-related statistics. Volume trend. The volume trend from the first bottom to the second is downward most of the time. Does it make a difference? Yes. Rising/falling volume. Patterns that show volume receding have a 3 percentage point performance advantage. That may not sound like much, but every little bit helps. Just remember your results may vary. Breakout volume. I have read that you should only buy double bottoms if the breakout occurs on heavy volume. Is that true? I found a large 6 percentage point difference between patterns with breakout volume above the 30-day average compared to those with light volume. Even so, I don't think it's true, but that's my opinion. Volume, in other types of chart patterns, usually doesn't give the kind of boost many expect. Table 27.7 shows how often price reaches a stop location. I looked back at Adam and Adam double bottoms and found they have nearly the same percentages as Adam and Eve patterns. Coincidence or deep state plot? If you place a stop-loss order at the bottom of the pattern, the stop will hit 3% of the time on average. However, the loss you may suffer could be quite large. Choose a closer stop location, and the potential loss decreases, but the chance of being stopped out increases. In other words, you have to find a stop location that works for you and your trading style. Table 27.8 shows the performance over 3 decades. Performance over time. The 2000s was the best performing decade, and the worst was the 2010s. That's not a good omen, is it? Failures over time. I counted how often price failed to rise more than 5% after the breakout. The rate was constant during the 1990s and the 2000s, but spiked in the 2010s. I don't know the reason for this. Maybe global warming. Table 27.9 shows busted pattern performance. Busted patterns count. Less than a quarter of the patterns busted, which I think is quite good. It says that 23% of the patterns I looked at broke out upward and failed to rise more than 10% before reversing and closing below the bottom of the pattern. Busted occurrence. Single busted patterns happen most often, which is reassuring because they perform best. Busted and non-busted performance. I compared 3 types of busted patterns: the performance of all busted patterns, single, double, and more than twice, triple plus, single busts, and Adam and Eve double tops. As you know, double tops break out downward, so they are a good proxy for a non-busted bearish pattern. Single busted patterns performed best. The other 2 tied for second place. If you want to short a stock showing a busted double bottom, then try to find a situation where there is little or no underlying support nearby to help prevent a double or higher bust. Trading tactics. As a bullish chart pattern, you need only know when to buy Adam and Eve double bottoms. Selling is, of course, the tough part. Before you buy, consider the trading tactics shown in Table 27.10. Measure rule targets. The measure rule calculates a target price for the stock. Consider the chart pictured in Figure 27.6. To calculate the predicted target, first determine the formation height by subtracting the lowest low from the highest high in the double bottom. The lowest low in this example occurs at the right bottom, with a price of 27.57. The highest high, marked on the figure by point A, is 31.09. Add the difference, 3.52, to the confirmation price, or the highest high between the 2 bottoms, that is, 31.09 plus 3.52. The result, 34.61, is the target. The chart shows that price met the target in late December. A few days after meeting the target, price momentarily descended before resuming its climb. During mid-April, the stock reached its ultimate high price of 40.26 before declining, not shown. How often does this method work? The bottom portion of the table shows the answer. I used the full height in the above example, and the table says it works 69% of the time. Cut the height in half and success increases to 85%, but profits will likely drop when you sell too early. Use 2 or 3 times the height and the success rate drops, but if the target is achieved, you could make more money. So use the probabilities shown to estimate how far price might rise. As a check, consult Table 27.3. For example, the height is 3.52 and the top of the pattern is at 31.09 for a potential rise of 3.52/31.09 or 11%. How often does price fail to rise more than 10%, the closest to 11%? Answer: 25%. That means you've a 75% chance of a winning trade, providing you trade it properly. Wait for breakout. Once the second bottom of a double bottom occurs, you can use the measure rule to set a target. If the potential profit is large enough, then wait for the breakout before trading. Point in Figure 27.6 shows the confirmation point with a line extending to the breakout point. If you decide to trade before waiting for a breakout, 48% of double bottoms will not confirm. That's almost half. You might be right and can buy in at a lower price, but it's a gamble. Trade with market trend. This is turning into a cliché, but a rising tide lifts all boats. Another way of saying that is to trade with the trend. Avoid making the mistake of being bullish in a bear market, which is like swimming against the current. You may still get to where you are going if a barge doesn't run you over. Check others in the industry. I find this tactic particularly useful. Before I trade, I check other stocks in the same industry. If they are rebounding or showing bottom reversals, then that gives me confidence that the trade will work as expected. If the other stocks are heading down, that increases the risk of a failed trade. It may be that this stock is a leading bullish indicator for the industry, but why take the chance? Stop location. Use Table 27.7 to help with stop placement. Be sure to convert the potential dollar loss into a percentage of the current price. If the loss is too large, then wait for another trade with better probabilities. You don't have to trade this pattern. Table 27.11 shows a few special features that double bottoms share. Bottom-to-bottom variation. I computed the median price difference between the two bottoms and compared the performance of patterns larger and smaller than the median. Those with large price variations outperformed. You might think this finding goes against the identification guidelines where the bottoms should be close in price. Close doesn't mean exact, and it was worth checking if any difference gave an advantage. It does. Lower bottom. Patterns with a lower right bottom performed better after the breakout than did those patterns with a lower left bottom. Who knew? Experience. Let me tell you about what I found in my trade review. Public Service Enterprise Group. Public Service Enterprise Group, PEG, is an electric utility. I like utility stocks because of the dividend checks they send me. In mid-2004, the stock formed an Adam and Eve double bottom that confirmed as a valid pattern. The stock broke out upward in a strong push higher and just as promptly threw back. It took its time returning to the breakout price, but then gapped open below the bottom of the double bottom. However, it closed above the double bottom's low. Because it didn't close below either bottom, it didn't bust the upward breakout. Less than 2 weeks later, I bought the stock. From my notebook, EDB, Adam and Eve double bottom after throwback. Interest rates are set to rise tomorrow 0.25 points, so that's a negative. This looks like it has bottomed, and utilities are the only thing going up in this market general, S&P market. Yield is 5.4%. The stock continued higher. 5 days before Christmas, word came down that Exelon would buy the company for $52.74 per share. Apparently, the smart money already knew of this deal. 7 trading days earlier, the stock had closed at 43.12, and the day before the announcement, it was already at 47.28. On the announcement day, the stock closed at 50.56, a tiny premium above the prior day's close. Fast forward to 5 March 2005. I must have been getting nervous. The stock was trading above the purchase price of the takeover, so I placed its stop at 53.33. On 22 March, the stock filled at 53.30. Sell reason, hit stop as FED raises interest rates. Lesson: if you hold onto a number of quality stocks, some of them will be taken over, often at a substantial premium. I made 35% including dividends on the trade. In this case, the merger fell through in September 2006. By that time, the stock was trading at 72.62, far above the takeover price. On the news, the stock only lost about $4 a share. The stock reached its ultimate high of 104.60 in January 2008, in the middle of the 2007-2009 bear market. In other words, I sold way too soon. If I had drawn a trend line connecting the two lows in July and October 2004 and extended that into the future, it would have taken me out of the trade at over $80 a share. I don't know why I used a stop-loss order on the stock. As a long-term holding, one paying a good dividend, having a stop in place is unusual for me, so I must have been nervous about something, probably the takeover falling through. Lesson: sometimes a stop-loss order takes you out of a big winner prematurely. That's especially true in buy and hold investments. Hughes Supply Inc. Hughes Supply HUG is one of those stocks where I traded it perfectly and lost money. A loss doesn't bother me too much unless it's large or it happens quickly. HUG did both. The stock made the Adam and Eve double bottom in September 1999. The day after it broke out upward, I was in the stock at just 6 cents above confirmation. From my notebook, 12 October 1999. Resistance at 26, support at 22. I bought at 23.3/8, not split adjusted, and expect this to continue rising due to hurricane season boosting sales without impacting outlets. That's the hope. Lowe's and Home Depot are doing well, but others are not. Fastenal, Building Materials Holding. They are probably not a distributor like this co. I bought because of the double bottom and higher low when compared to low in March. There is a bunch of resistance at 26, so I anticipate a stall at 25.1/2 to 25.7/8. If it punches through, it's up, up, and away. Downside is the twin lows at about 21. Sell at 27/8. That's a downside of 10%. I didn't log the sale in my notebook, but it happened just 15 days later when the stock threw back and continued down. I had to stop a few pennies below the lower of the 2 double bottom lows, and it triggered, handing me an 11% loss in just 2 weeks. I like to keep losses to 8% or less, and this happening in 2 weeks is like a kick in the pants. There's no lesson to share. Entry and exit were both perfect, except I got creamed in between. Family Dollar. The trade in Family Dollar FDO didn't result in a big loss or gain, but it does have some things I want to mention. In 2005, the stock made an Adam and Eve double bottom. Before confirmation, I bought, from my notebook, 13 October 2005. Bought at buy stop at 21.70, a penny above the confirmation price of 21.69. Placed after the market closed. Stop, 1.5 times volatility of 81 cents, so a stop at 19.33 would work, below the lowest low. That's a loss of 10.9%, which is a bit on the steep side. But since the market is trending down, it might be a smart play. Upside target, 25.50 to 26 for a big W rise, the site of overhead resistance in July. Buy reason, EDB Adam and Eve double bottom. This stock has been hit, 22 stores effectively closed by Katrina, so revenues will be down. Earnings came in a few days ago and net sales as of 6 October were up 9.3% for 5 weeks ending 1 Oct. SSS up 2.6% for the period. Book score +2. The book score is from my book, Trading Classic Chart Patterns, Wiley, 2002. Scores above 0 have a greater probability of beating the average rise. Usually, I scribble down the target calculated by the scoring system, but didn't in this case. The buy stop triggered the next day and filled at 21.70 to 21.71. This was another case of buying before the pattern confirmed, about a week too early. But it allowed me to buy in at a lower price than waiting for confirmation. In this trade, it made a difference. Let me be clear on this. I placed a buy stop a penny above the confirmation price of 21.69, and the order filled. However, the pattern didn't confirm at that time. Confirmation happens when the stock closes above the confirmation price, and that didn't happen until about a week later. 3 days later, I placed a stop-loss order at 20.32. This is a volatility stop because one placed below the double bottom low was too far away, and the stock is up this morning. It would have to fall 6% to trigger it. I used the low on 14 October at 21.13 minus 0.81 to get 20.32. What I want to mention here is that I felt the stop below the bottom of the pattern was too far away, so I chose to use a volatility stop instead. On 20 October 2005, I placed a buy order that executed the next day to buy more shares of the stock, doubling my position. The double bottom had confirmed the day before, so this was the optimum entry, made at 22.78, the opening price for the stock. The problem was, confirmation was at 21.69, which is more than $1 below where I bought. Lesson: I often choose to use a buy stop placed a penny above confirmation to get in at a good price, even at the risk of a premature breakout. The trading price during the day exceeds confirmation, but the closing price remains lower. I did a study on entry methods and found that using a buy stop instead of waiting for confirmation actually reduces risk and increases profits. However, for statistical purposes, I programmed my computer to wait for confirmation and buy at the opening price a day later. In this book, I repeat that you should wait for confirmation, but in my actual trading, I buy using a buy stop a penny above the confirmation price. Why? Here's what I wrote on my website, http://thepatternSite.com/bestentry. HTML. Waiting for confirmation, buying at the open the day after price closes above the top of the double bottom, doubles the median rise while cutting the failure rate in half. However, the best entry is to place a buy stop a penny above the top of the double bottom. That cuts the failure rate and marginally boosts the median rise too. Returning to the 20 October trade, buy reason, good upside breakout from the double bottom, especially coming on a day when the Dow was down 133 points. I wanted to add more to my position because I think this will big W move up to 25.50 to 26. I don't particularly like the company or its prospects, but I do think the Dow will recover tomorrow and help keep this stock moving up. I like countertrend trades, where the stock is moving up when the Dow Industrials are dropping, as in this case. I did a study of countertrends posted on my website about the effectiveness of countertrend trades, but it's too complicated to discuss here, and I'm not sure this stock actually qualified as a countertrend stock. I haven't checked. Lesson: Countertrend trades, when the markets continue lower but the stock continues to rise, can suggest better performance. Over the following days, I raised the stop 4 times, chasing price as the stock climbed. 8 December 2005. Stop raised to 22.33, just below the descending triangle that formed. It's the smart play. The next day, the stock hit my stop. Sold at 22.33, the stop price. Sell reason, hit stop. I raised the stop because I felt a downward breakout from the descending triangle would mean a giveback of any gains. On the first trade, I made 3% using a buy stop. On the second trade, I lost 2% waiting for confirmation. I mentioned the book score of +2 earlier. If I sold at the ultimate high on the first trade, I would have made 63%, handily beating the 44% average rise suggested in the book. In other words, the scoring system worked for this trade, predicting a good shot of reaching the average 44% rise if I hadn't sold too soon, that is. I sold because of the downward breakout from the descending triangle, but the triangle turned into a 5% failure when price resumed rising. It was a risk to hold onto the stock longer, so I think I made the correct sell decision even though the stock made a substantial rise after I sold. Lesson: sometimes trading well is more important than making money. If you trade well, money will often follow. It prevents bad habits from forming that can cause big losses. Sample trade. Lauren is a school teacher. Although she loves teaching kids, she would much prefer raking in the dough by trading stocks over the internet. Until that time, she shoehorns her investment activities into the few hours of free time she has each week. When I spotted the double bottom shown in figure 27.6, she placed her hand over her heart and said, "I knew it was love at first sight." The rounding bottom pattern from pointed to the breakout suggested higher highs were in store. However, she resisted the temptation to get in early because she could not guarantee price would continue moving up. She justified her action by pretending that she was teaching her students how to trade. If she could not do it properly, how could they? The stock climbed to the confirmation price for the double bottom, and I was ready to buy. However, when my broker read off the current quote, it had soared well above the confirmation price, so I decided to wait and pray for a throwback. About 4 weeks after the breakout, price dipped to the buy point, but would the stock continue down? I had to wait until I felt confident that price would rise. She changed her mind the next day when price made a higher low. It was a gamble, because 2 days of rising prices hardly made a trend. Still, she was getting antsy and didn't want to wait too long and watch price rise above the level that she could have bought a month before. So she bought the stock and received a fill at 31.38. The following day, volume spiked to over 3 million shares and price jumped over 0.75 points. The spike made her nervous as it reminded her of a one-day reversal, but the stock closed at the high for the day, which is odd for the reversal pattern. That is when she remembered to place a stop. I chose a price of 30.88, about a quarter point below the recent minor low, an area of prior support. The following day, price erased lower, but succeeding days saw the stock rebound. In mid-December, the stock went ballistic and fulfilled the measure rule. I couldn't make up her mind if it was worth selling at that point. By the time I decided to sell, the stock had returned to the up-sloping trend line drawn connecting the lows in September through January, so she held on. The stock moved up. In late March, the stock jumped sharply, climbing almost $1.50 in one day. That was a big move for the stock, and she wondered what was going on. She followed the stock closely, and it became obvious the stock had entered the bump phase of a bump and run reversal. Periodically, as the stock climbed not shown, she penciled in the sell lines parallel to the original bump and run reversal trend line. As she looked at the chart, she saw the narrow peak appear and knew the end was near. When the stock dropped below the nearest sell line, she placed an order to sell her holdings and received a fill at 38.63. "I made 22%, she said and clucked her tongue, "but on an annualized basis, I made 60%. She smiled, knowing that annualized numbers were something her math class needed to learn. Now she had the perfect example. Chapter 28, Double Bottom, Eve and Adam. Results snapshot. Appearance, twin bottom pattern with the left bottom wide and rounded looking, but the right bottom is narrow and V-shaped. Of the 4 combinations of Adam and Eve double bottoms, Eve and Adam is the rarest. A quick review of the results snapshot shows that Eve and Adam doesn't perform as well as 2 of its brothers. The performance is midway down the list. However, the failure rate rank not shown comes in at 12 out of 39, where 1 is best. That's a good showing. The volume trend is downward, but only 60% of the time. Even if the volume trend is upward, performance doesn't change much. Throwbacks happen in 2 of every 3 trades, so that's reliable. Unfortunately, performance suffers if a throwback occurs. Setting a price target and expecting the stock to reach it is lower than I like to see, but it's fine at 72%. You can adjust the height in the measure rule calculation to suit your needs. I'll discuss that in the trading tactics section later in this chapter. Tour. What does an Eve and Adam double bottom look like? Figure 28.1 shows a good example of one. Price trended down in a steady decline to the low in June, the Eve bottom. Volume picked up as price neared the low and then pegged the meter at over 1.1 million shares on 18 June. The day price reached a low of 12.69. From the March high, the stock declined 47% in 3 months. The high volume marked the turning point, and the stock started its recovery. However, a retest of the low was in store and price rounded over and headed down again. In late August, price made another low, the Adam bottom, when the stock dropped to 13.06, also on high volume. The day after the low, on a burst of buying enthusiasm, the stock pole vaulted and reached the confirmation point in just 2 days. Instead of continuing upward, however, the stock skidded sideways along the breakout price for just over a week before resuming its move upward. By late January, the stock reached a high 75% above the breakout price. All of that describes how the stock unfolded during 1992. The double bottom pattern at the Eve bottom is a gentle rounded turn, looking like a small cup. Compare that shape to the Adam bottom. Adam is pointed, narrow, and more V-shaped than Eve. Together, they form the Eve and Adam double bottom chart pattern, but only when the stock closes above the highest peak between those 2 bottoms. Price after the pattern breaks out makes a wonderful recovery, sending price up to near the old high. Identification guidelines. How do you identify an Eve and Adam double bottom? While it is easy to find 2 bottoms near the same price, it can be difficult to distinguish between the combinations of Adam and Eve. Figure 28.2 shows another example of the Eve and Adam double bottom chart pattern. Although the figure does not show the pattern confirming a close above the highest high between the 2 bottoms, the pattern does confirm off the chart to the right, meaning that it is a valid double bottom. Notice how the 2 bottoms have different shapes. The Eve bottom is wider and rounded looking. The Adam bottom is more V-shaped, narrower, and usually composed of 1 or 2 large downward price spikes. The Eve bottom also has spikes, but they are many and short. Figure 28.3 shows another example of an Eve and Adam. This Eve bottom has longer spikes than those in the prior figure. The Adam bottom appears V-shaped, especially in contrast to the wider and more rounded-looking turn of the Eve bottom. Now that we've seen a few examples, let's talk about identification. Table 28.1 lists the guidelines. Appearance. Look for 2 valleys that bottom near the same price. Each bottom should be a minor low, not 2 spikes emanating from the same congestion region, but be flexible. Do the bottoms have a different shape? If yes, then you are on the right track. The pattern is either an Adam and Eve or Eve and Adam double bottom. The Eve bottom should look rounded and wide, especially near the top of the bottom, if that makes any sense. If spikes appear, they should be short and bunched together. The Adam bottom should look different from Eve. It should be narrower, V-shaped, and usually have a long 1 or 2 day downward price spike. Price trend. The pattern does not form in a rising price trend unless it is part of a correction retracement, usually the corrective phase of a measured move up. More often, though, the double bottom marks the end of a downtrend. The inbound price trend need not be very long, but averages about 4 months. I excluded any pattern where there was a price dip below the left bottom. The pattern should have 2 bottoms, not 3 or more. Rise between bottoms. Usually tall patterns perform better than short ones, so look for the rise between the bottoms to be at least 10%. That's an outdated guideline, so you can allow any value you wish. I set no minimum or maximum height restriction. Bottom low price. Look for bottoms that have almost the same low price. They need not be the same, but the median price variation is small, 1%. Bottom separation. I allowed bottoms to be as close or as far apart as they felt comfortable, but the median was 23 days. Patterns wider than the median outperform. Price rise after right bottom. Price should confirm the pattern. Until that time, price should not make a third bottom. Volume. Most patterns have volume higher on the right bottom, but only 60% of the time. Heavy breakout volume has no effect on performance either. Breakout direction. A breakout happens when price closes above the highest peak between the two bottoms. If price closes below the bottom of the pattern first, it's not a valid double bottom. When price breaks out upward, it confirms the chart pattern as a valid double bottom. Is the twin bottom shown in figure 28.4 a valid Eve and Adam double bottom? Running through the characteristics shown in table 28.1, we find that the pattern appears at the bottom of a downward price trend. The two bottoms look different. The first one is wider than the second, and more rounded looking too. The second bottom is narrow and V-shaped, with a 2-day downward price plunge. The difference between the two bottom lows is small 1%. The separation measures 43 days from bottom low to low. No dips appear on either side of the pattern that would turn this into a triple bottom. Volume is heavier on the right bottom than the left, and the breakout volume is below average. The pattern is valid. Thank goodness. Otherwise, I'd have to consider replacing the figure. Focus on failures. What can we learn from failures? Figure 28.5 shows what I call a 5% failure, the failure of the stock to climb more than 5% above the breakout. The bottom price variation for this double bottom looks wide, but the difference is only 4%. If you scan through the identification characteristics listed in Table 28.1, you will find that the pattern confirms as a true Eve and Adam double bottom. Why does price fail to rise much above the confirmation price? The answer is typical for these types of failures: overhead resistance. If you were to look at the historical price series for the stock, you would find two tops in early to mid-1996, at 37 plus. Those tops either peak at the confirmation line or show congestion at or above that price. In other words, the peaks highlight a resistance zone right above the breakout. In fact, the overhead resistance is so strong that it turns back price in mid-1998, not shown. This double bottom gained just 3% before tumbling 47%. On the fundamental side, the company warned in mid-September that full-year earnings would fall about 20%, although the company raised its dividend. A broker downgraded the stock. The stock gapped lower breakaway gap on the news. Did the smart money know about all of this near confirmation? If so, then perhaps they started selling, trying to exit before everyone else learned of the news. In a moment, we'll see that the 5% failure rate for this chart pattern is 12%. To flip that around, you have an 88% chance of avoiding a 5% failure. You can still botch the trade or wait long enough for a losing position to turn into a winning one. How you trade the stock is up to you. Before you buy, make sure you understand the risks, both technical and fundamental. Be wary of buying a stock within 3 weeks of an earnings announcement. I learned that lesson the hard way. There are lots of other checks you can make, but let's focus on the numbers. Statistics. Table 28.2 shows general statistics. Number found. Eve and Adam double bottoms are the rarest variation of the 4 Adam/Eve combinations, as I mentioned. I found only 855 of them in 539 stocks, but that includes bear market patterns. Those were too few to include in the statistics. The first double bottom in the study appeared in July 1991, and the most recent was in February 2020. Not all stocks covered the entire time, and some no longer trade. Reversal R, continuation C occurrence. By definition, this bottom pattern acts as a reversal of the price downtrend. Average rise. The average rise shown in the table is a bit shy of the 42.4% gain for all chart pattern types. I guess you could say this pattern is an average performer. However, don't think that you'll be able to make 42% from your trade. The number in the table is an average of hundreds of perfect trades. That means buying at the breakout price and selling at the ultimate high. You might be able to do that once or twice in real life, I have, but not hundreds of times. If you place a stop-loss order too close and get stopped out of a promising trade, then you're watching from the sidelines as the stock doubles. It can go the other way, too. Buy a stock just before the company announces an earnings shortfall and the stock opens 35% lower, handing you a loss that stings. Standard & Poor's 500 change. The S&P 500 index showed an average rise of 13%, helping to lift the stocks I studied. The sample times were measured from the dates of the breakout and ultimate high of the chart pattern, applied to the index. Days to ultimate high. A 42% average rise can take a long time to achieve or not. I traded Conseco, now called CNO Financial Group, in 2009, which doubled in a week. The average time to reach peak performance is just over 7 months. That means traders need to be patient while the stock struggles to achieve its potential. I suppose it's like watching your kids grow up. They can show promise but stumble along the way. How many change trend? This is a count of how many double bottoms see price rise more than 20%. Values above 50% I consider good, so this pattern does well. Table 28.3 shows failure rates for the Eve and Adam double bottom. Failures are a count of how often a chart pattern fails to meet a given price rise. Sounds confusing, doesn't it? For example, 12% of the stocks will fail to see price rise by more than 5%. Almost half will fail to see price rise more than 25%. The rate starts out small, if you can call 12% small, but doubles in the next row down. Scan down the rows, and the increases are alarming, so expecting a hefty gain from a double bottom might be a dream. Table 28.4 shows breakout-related statistics. Breakout direction. By definition, the breakout is upward from a double bottom. A breakout happens when price closes above the highest peak between the two bottoms. If that doesn't happen, then you don't have a valid double bottom. Yearly position performance. Mapping performance over the yearly price range, we find that the best performance comes from patterns with breakouts in the middle third of the yearly price range. You'll want to avoid trading double bottoms with the breakout price within a third of the yearly high. They perform worst. Throwbacks. Throwbacks occur twice every 3 patterns. When they do occur, it takes 12 days on average for the stock to return to the breakout price. However, the appearance of a throwback hurts performance. I guess it's like having ants on your food at a picnic. Joy turns to disappointment. After a throwback completes, the uptrend resumes most often, so don't panic sell during a throwback. Gaps. If price gaps upward on the day of breakout, it suggests better performance. Because I measure performance using the opening price the day after the gap, you can buy the stock and still hope to participate in the better performance. Table 28.5 shows pattern size statistics. Height. Many chart pattern types have tall patterns outperforming short ones, and that's what we see here. In fact, the performance difference between short and tall patterns is quite large. For a trading advantage, measure the height of the pattern from the tallest peak, between the two bottoms to the lower of the two bottoms, and divide by the price of the tallest peak. If the result is higher than the median shown in the table, then you have a tall pattern. With such a large performance difference, it's worth taking the time to check if your double bottom is tall and avoid trading short ones unless there's a compelling reason for doing so. Width. Wide patterns perform better than narrow ones. I used the median length as the separator between narrow and wide. The performance difference is quite large for this item as well. Height and width combinations. Tall and wide patterns should produce exceptional gains, and they do, but they are not the performance winner you'd expect. Rather, tall and narrow double bottoms do best. You'll want to avoid short and narrow ones. They perform worst. Table 28.6 shows volume-related statistics for Eve and Adam double bottoms. Volume trend. Volume trends downward most often, but 60% isn't exactly a robust endorsement. Don't discard a chart pattern because it has an atypical volume trend. As we see in the next item, the performance difference isn't worth worrying about. Rising/falling volume. Patterns with falling volume perform slightly better than do those with rising volume. Breakout day volume. Does heavy breakout volume suggest better performance? Not for these chart patterns. I found no performance difference between light and heavy breakout day volume. Table 28.7 shows how often price reaches a stop location. I split the pattern in half and tabulated how often price returned to various locations on the way to the ultimate high. For example, if you place a stop-loss order at the bottom of the pattern, it'll trigger 3% of the time. That's a low hit rate, which is good, but the potential loss of having the stop at pattern's bottom could cost you a bundle if it triggers. When deciding where to place a stop, measure the potential loss and convert it to a percentage of the stock's price. If the percentage is too high, some say 8% or less is good, then look elsewhere for a lower risk trade. Table 28.8 shows the performance over 3 decades, performance over time. The 2000s, without counting the 2 bear markets, were the best performing decade. The worst performing decade was also the most recent, the 2010s. That's troubling. Does it mean performance will continue to deteriorate? Time will answer that, so don't change the channel. Failures over time. Notice how failure rates have increased each decade. The failure rate in the 2010s was 4 times what it was in the 1990s. That's scary, especially if the trend continues. Table 28.9 shows busted pattern performance. I prefer to trade busted patterns where price trends upward after busting, not downward like this pattern. Upward moves can have unlimited gains, but downward ones can only lose 100% of their value. Busted patterns count. About 1 in 5 patterns will bust. A bust happens when price breaks out upward and rises no more than 10% before turning down and closing below the bottom of the chart pattern, below the lower of the 2 lows. Busted occurrence. Single busted patterns happen most often, followed by double and triple or more busts, respectively. That may sound obvious, but a number of times we see 3 or more busts placing second for frequency. Busted and non-busted performance. Single busted patterns perform best by seeing price drop an average of 25% below the bottom of the pattern. I used Eve and Adam double tops as the proxy for a non-busted double bottom. The drop from them matches what we see for the combination of single, double, and 3 or most busts. Trading tactics. Table 28.10 shows trading tactics. Measure rule targets. To determine how far price may rise, use the measure rule, the height of the double bottom, highest high minus lowest low, added to the breakout price. For example, the double bottom shown in figure 28.6 has a confirmation or breakout price of 12.50, and the atom bottom is the lower of the 2 bottoms, at 9.00. The difference between the two, 3.50, represents the pattern's height. Add this value to the breakout price, the confirmation line of 12.50, to get the target of 16. Price reaches the target in mid-March. The bottom portion of the table shows how often various heights in the measure rule work. For example, the target just calculated uses the full height. It works, on average, 72% of the time. If you slice the height in half or double it, the success rate changes. The table lists targets using various height multipliers. As a sanity check, consult Table 28.3. For example, we know the height of the double bottom shown in the figure is 3.50, and let's assume the current price is the breakout price, 12.50. The height means a potential rise of 28% to the target. Let's call it a 30% rise. Table 28.3 says that 55% of double bottoms will fail to see price rise that far. That also means you have a 45% chance of having the stock reach the target. Wait for breakout. I updated a study of the frequency of unconfirmed double bottoms and found that 48% of the time, price did not confirm the pattern. Price closed below the bottom of the pattern, instead of breaking out upward. Price must first close above the highest peak between the 2 bottoms to confirm the pattern as valid. Always wait for confirmation unless you have a special reason for entering a trade earlier. I can get creative in my excuses, such as I like to lose money and the sun was in my eyes. How about you? Any favorites? Trade with market trend. Trade double bottoms in bull markets because they are bullish patterns. Even if you make mistakes, a rising tide lifts all boats and the market is more forgiving. Trying to trade a bullish pattern in a bear market is like being swatted by a rolled-up newspaper. It could hurt. Check others in the industry. Are other stocks in the same industry doing well? Are they showing bottom reversal patterns, double or triple bottoms, head and shoulders bottoms, that sort of thing? If many companies in the industry are doing well, that should give other investors the courage to buy the stock and add to demand. That activity reduces your chance of a small gain. However, if stocks in the industry look sick, what makes you think this stock will do well after the breakout? It will be swimming against the industry current. If the industry is weak, save yourself some money, aggravation, and avoid the stock. Look for a more promising chart pattern in another industry. Stop location. Table 28.7 shows how often 3 locations in the double bottom will trigger a stop-loss order if it's placed there. That gives you an idea of how often you may be stopped out, so visit with the results and tell them Tom sent you. Table 28.11 shows special features for the Eve and Adam double bottom pattern. Bottom-to-bottom variation. I computed the price variation from bottom low to bottom low, and then measured the performance for those double bottoms with a price variation larger and smaller than the median. If the bottoms were uneven by more than the median, they tended to perform better. We've seen this result for other double bottoms types, too. Lower bottom. Double bottoms with a left bottom below the price of the right bottom tended to perform better after the breakout. To me, this makes sense because a higher second bottom suggests more buying enthusiasm near the old low. People started buying the stock before it reached the price of the prior bottom, halting the decline. Experience. Let me tell you about what I found in my trade review. Alaska Air Group. This is one of those trades where I look at the chart and thank the stars I sold in time. It happened in March 2001 when the stock in Alaska Air Group ALC formed the Eve bottom. In late June, the Adam bottom was in place. The pattern confirmed in mid-July as a valid Eve and Adam double bottom. Here's my notebook entry, 23 July 2001. I bought at 32.19 at market. The stock has completed a confirmed Eve and Adam double bottom coupled with an upside earnings surprise on 19 July. The stock has moved higher but may have overhead resistance at 32.33, where it is now trading. I expect it to push through this region, then post new highs. The earnings announcement may be the reason I didn't buy when the double bottom confirmed, or even why I didn't have a buy stop ready to get me into the trade. Lesson: avoid buying shares within 3 weeks of an earnings announcement. Oil prices are falling, but OPEC is expected to tighten the spigot in coming weeks, putting upward pressure on fuel prices. Economy is slow, but some predict it's bottoming. The airline is one of the few still profitable. Sell in the early spring when the market for airline stocks usually goes soft, strong starting in the fall. Upside is 38, another mild resistance zone. Downside is 28, a prior support zone in March through June 2000 on weekly scale. That would put the loss at a rather steep 13%. That region is also just below the double top high, a likely support zone. This is a risky trade due to overhead resistance, so I limited the position size. The stock cooperated by moving sideways for a week, but then easing higher, forming what looked like a rounded top. Here's the sell details. 6 September 2001. I put a stop at 31.50 this morning and it was hit. The stock has breached a support level, and with weakness in the economy and September/October upon us, it's time to leave with a small loss. I should have bought at the breakout price. On the trade, I lost 2%. Here's the kicker, and the date says it all. 5 days later was 9/11. The stock market didn't open for a week, and when it did, the stock was down to 22.24. It bottomed near the end of the month at 17.40, a drop of 45% below the sale price. I sold the stock just in time and escaped being slaughtered. Lesson: sometimes you don't know how well you have traded until well after the sale. Cash. I was going to show you a chart of this trade, but there's not much to see. Coming off the 2007-2009 bear market, cash dropped and bounced, forming an Eve and Adam double bottom, with the second bottom in March 2009, bottoming just 3 days before the bear market officially ended. I didn't know it at the time, of course. The chart pattern confirmed on 26 March, turning the squiggles into a valid double bottom. Price moved up in a nice straight line run, and I bought when it formed a handle of a cup. That's what it looked like. On the left of the chart was the left rim, then the double bottom, and a right rim mirroring the one on the left. A handle 18 days long followed, and I bought about midway in that handle. From my notebook, 9 April 2009. By reason, S&P rates stock a hold, has nearly zero debt, has tons of insider buying since September, but share sizes are unimpressive, 20K largest, 936 shares smallest. Ford has strong sell. 3 of 5 ratios are at bottom. P and E is mid-range since cash flow has dried up. Earnings are negative. late to a confirmed Eve and Adam double bottom. Upside target was 8, 13, and 16 with a potential stop of 2.63 or 19.7% below the current price. With a stop so far away, I didn't place it. I think this was a buy and hold type trade, one where I often don't use a stop. Confirmation of the double bottom was at 2.29, and I bought at 3.10 or 35% above the optimum entry. So that was really awful. Lesson: bottoms are often V-shaped, tops are more rounded appearing. You have to be quicker to buy at a bottom than to exit at a top. Lesson: buy as close to confirmation as you can. It helps limit risk and increase profit. I'm not sure why I didn't buy earlier, but I knew by the entry I was late, as my notebook entry acknowledges. The closest target was 8, far above the 3.10 buy price. Why so far away? The bear market sucked the stock down quickly from a peak at 13.90 to a low of 1.41, or a 90% drop in 3 months. On the weekly scale, it looked as if the stock stepped off a cliff. So there weren't many pauses along the way that would make for good resistance targets on the way back up. Having resistance far above the current price isn't a bad thing, really. You can hope that price doesn't pause along the way to the target, but that's often wishful thinking. In 2008, the stock made a slowly rising channel from 8 to 15, so that's where it called home. I was hoping it would return home, but it only got halfway there. After I bought, the stock cooperated though, helped by traders returning to a bull market. The stock climbed to 5 and then turned right. It retraced back to a low of 3.20 in July 2009 and peaked at 7.25 in the spring of 2010, which would have been a wonderful time to sell. After that, the stock made a dip that dropped the stock in half before bringing it back up. For the sale, I have 2 notebook entries, one on the day before the sale, 10 January 2012. Order details: sell limit order day at 5.93. Sell reason: broker downgraded the stock, and I want to exit the women's apparel stocks. I'm taking the profit with a market order at the open tomorrow. This is trading near the yearly high, and it's a good time to exit. I expect a downward breakout from the ascending triangle. Since this is so thinly traded, I'm hoping I can get a good fill, but doubt it. I changed the market order to a limit order near the day's open today, Tuesday. The ascending triangle started in May 2011 and lasted to January 2012, about a week after I sold, with an upward breakout. That's a hint that I sold too soon. Here's my notebook for the day I sold. Sell reason: fundamentals, weakness. If the prediction is right that the market will drop in March, I am liquidating my stocks that show gains and are looking to drop. This recently peaked, but I don't like the industry, women's apparel, and a broker downgraded the stock. I sold near the bottom touch of the triangle, almost 3 months before the stock peaked at 7.88. After that, it was a steady drop to 2.00 in December, a 75% decline. My instincts on this trade were good, helped by the ending of the bear market where almost anything you buy soars. I bought in late, left early, and made 86%. Annualized, that's a gain of 31% a year, which is wonderful too. Lesson: the end of a bear market provides wonderful opportunities for stocks to recover. All you need is the courage and the cash to buy. I bought in late, left early, and almost doubled my money. Sample trade. Figure 28.6 shows a trade Willie made in the stock. He ran through table 28.1 and checked the identification characteristics against the pattern. Briefly, the stock price was trending down to the first bottom of the double bottom. The Eve bottom caused him concern because the twin spikes were long but separated by a few days. Was the Eve bottom really an Adam bottom, or was it a narrow Adam and Adam double bottom by itself? The Adam bottom had a shorter spike. Was it an Eve bottom? He looked above the spikes and saw that the Eve bottom was several weeks wide, but the Adam bottom remained narrow over most of its height. He concluded that the pattern was an Eve and Adam double bottom. The rise between bottoms was over 10%, and the bottoms looked to be about 6 weeks apart. Volume was higher on the left bottom than the right, spelling good news for performance. I watched the pattern develop, and lo and behold, a head and shoulders bottom appeared before my very eyes. He drew in the down-sloping neckline, and when price closed above it, confirming the head and shoulders bottom, he bought the stock and received a fill at 11.00. After that, it took just 2 days for price to confirm the double bottom pattern. I rode the stock higher like I was competing in a rodeo, and the stock took on the shape of an ascending scallop, a rounded turn with a right handle. When the second scallop appeared, I got concerned. Sometimes, consecutive ascending scallops get narrower as they appear higher in the price trend. An unusually narrow one sometimes appears just before price peaks. So I decided to sell as soon as price dropped below the scallop bowl. That occurred in early May, and he received a fill at 14.93 for a net gain of 35%, and that was in a bear market. Chapter 29, Double Bottoms, Eve and Eve. Results snapshot. Appearance, a twin bottom pattern with wide, rounded bottoms. The Eve and Eve double bottom is what many refer to as the classic double bottom. It sports two rounded bottoms, well separated with a rounded climb between them. That is the ideal pattern, but few look like that in the real world. Of the four varieties of double bottoms, the Eve and Eve double bottom has the highest average rise, 50% in bull markets, ranking 5 out of 39 where a rank of 1 is best. I can see why this chart pattern is a classic. The performance rank is more than 3 times better than the other 3 varieties of Adam and Eve double bottoms. Not only that, but it has a comparatively low break-even failure rate, 12%, ranking 13 out of 39 not shown. What more could a trader want? Let's take a look at this double bottom variant. Tour. What does an Eve and Eve double bottom look like? Figure 29.1 shows a good example of the twin Eve bottom. This double bottom forms after a broadening bottom chart pattern, the pattern on the left of the chart. The two Eve bottoms are wide, rounded, and distinct lows separated so that they are not part of the same congestion region. The rise between the two bottoms in this example measures an unusually tall 40%. In March, price closed above the highest high in the pattern, confirming the twin bottom as a true double bottom. Why does a double bottom form? All chart patterns show the struggle between buying demand and selling pressure. When price drops to a point where traders view the stock as a steal, they buy. If buying demand is high enough, the stock moves up in price. That is why the bottom usually shows a volume spike or high volume. In a double bottom, selling pressure balances buying demand, making the bottom turn long and gentle as bulls and bears struggle for dominance. When buying demand prevails, price rises and continues to rise until sellers, viewing the stock as overbought, take profits. This selling pressure eventually stalls the upward move. When other traders see the upward momentum slowing, they dump their shares and down goes the stock. When price drops to a low enough level, the smart money accumulates shares again, sometimes quietly and sometimes not. Others see the slowing downward price trend and predict a turn. They buy too. As price pulls out of its dive, more traders buy and the second Eve bottom forms as a gentle, rounded-looking turn, often near the price of the first bottom. Price begins climbing again. When it approaches the high between the two bottoms, it often stalls there as traders take profit. In a confirmed double bottom, the selling pressure does not send the price down again. Instead, traders sense the intrinsic strength and buy. This buying demand forces the price to tick up, moving above the high between the two bottoms. That is the breakout signal. It turns squiggles on the price chart into a valid double bottom. Technical traders watching from the sidelines buy the stock in droves. Volume skyrockets along with price. Reluctant sellers dump the stock to eager buyers. Price climbs for several days and then things change. About 2/3 of the time, price throws back to the breakout price. The throwback is brief before price gathers strength and rises again, soaring to new highs. Identification guidelines. I find identifying Eve and Eve double bottoms is easier than identifying birds, but in both cases, you have to know what to look for. Not just any two bottoms at the same price will suffice for an Eve and Eve double bottom. Listed in Table 29.1 are guidelines that make correct selections easier. While considering the guidelines, look at Figure 29.2. Appearance. Assign each double bottom pattern into its Adam and Eve category. Adam bottoms are narrow and V-shaped, perhaps with a 1 or 2 day downward price spike. Eve bottoms are wide, rounded turns. They may also have price spikes, but they are usually shorter and more plentiful. Price trend. The stock shown in the figure begins declining in mid-October 1993, not shown from a price of about 56.50. It bottoms out at about 41.50 in mid-May, forming the first Eve bottom. Price never drops below the left low on the way to the first bottom. The reason for this guideline is to avoid triple bottoms or those patterns that do not act as reversals. The 2 points marked and B represent an incorrectly selected double bottom because point A has lower lows to the left of it. It acts as a continuation of the upward price trend and not a bottom reversal. Rise between bottoms. When I first started studying double bottoms, lots of books said that the rise between the two bottoms should be at least 10%, as measured from the lowest bottom low to the rise high. None of them proved it or said why it's important. I threw away that requirement and decided to let the pattern tell me how tall it should be. I found that taller is better, so the 10% guideline is fine, although I allow many shorter patterns. Bottom-low price. The bottom-to-bottom price variation should be small. The basic rule is that the two bottoms should appear near one another on the price scale. The figure shows a price variation of about 1%. That value matches the median difference too, bottom separation. The two bottoms should be at least a few weeks apart, but that's an arbitrary value. Eve turns are frequently wide enough to require a few weeks to complete, not always, of course. Many bottoms in a double bottom are separated by several months, like the one shown. A month is the minimum separation that many professionals view as leading to powerful rallies. I set a lower standard to help verify that this is true. It is. Price rise after right bottom. Price should rise up to the confirmation price without first making a third bottom. Volume. The volume chart for double bottoms usually shows the highest volume occurring on the left bottom. Diminished volume appears on the right bottom, and the volume trend of the overall chart pattern is downward. None of these are absolute rules. Sometimes volume is highest on the right bottom instead of the left. Don't discard a chart pattern because of an unusual volume pattern. Breakout direction. All double bottoms break out upward by definition. If they don't, then they are not double bottoms. What is a breakout? It happens when the stock closes above the highest peak between the two bottoms. Confirmation. The confirmation point is the same as the breakout price. It's the highest high between the two bottoms. It's when squiggles on a price chart become a valid double bottom. Why wait for confirmation? In a study I did, I found that 48% of the time price broke out downward from a twin bottom pattern instead of confirming it as a valid double bottom. Thus, if you buy before confirmation, on average, you'll likely lose money nearly half the time. Now that you know what a double bottom looks like, let's discuss how to separate the bottoms into their proper Adam or Eve category. Figure 29.3 shows another example of an Eve double bottom, but one harder to identify. Both bottoms have a one-day downward spike, which is more typical of an Adam bottom. However, as your gaze moves up, the bottom widens. If you were to shave off that one day's growth, you would have a rounding turn on both bottoms. Adam bottoms are narrower and usually taller. Adam bottoms often have price spikes 1 or 2, but they are longer than what you see on Eve bottoms. A good example of an Adam bottom occurs in December when price plunges downward for 3 days. The bottom looks narrow and pointed, not wide and rounded. Notice the difference between the Adam and Eve bottoms. When trying to determine whether the double bottom has Adam or Eve components, ask yourself if the two bottoms look similar, Adam or Eve, or different Adam and Eve or Eve and Adam. If they look the same, are the bottoms wide or narrow, pointed or rounded? Let us look at another example, figure 29.4. The left Eve bottom is narrower than the right one and it looks like a widely spaced horn. It has 2 minor lows. The right bottom looks wide, but it is V-shaped. Are these Adam bottoms? Sometimes the answer lies not in the bottoms themselves, but in the surrounding landscape. I searched the stock for examples of Adam and Eve bottoms, and they appear in the inset. Clearly, the differences between the two are startling. Compare each inset with the alleged Eve double bottom. Which inset looks like the double bottom? I think the Eve inset matches each Eve bottom. Trying to figure out if you're looking at Eve or Adam is subjective. I computerized the identifying of Adam and Eve bottoms to provide consistency across my research. Focus on failures. Figure 29.5 is a test. Is this an Eve bottom or an Eve and Adam? The answer is, of course, who cares? The stock failed to climb much after the breakout, and I consider losing money more important than identification. The left eve bottom, most would argue, is a true eve bottom. It appears wide and rounded, not needle-sharp like an atom bottom. What about the right bottom? No 1 or 2 day price spike appears. It does look V-shaped if you consider the V as slanting to one side. Does it look like the eve bottom at point O or the atom bottom at point B? My computer says this double bottom is an eve and eve pattern. Why did price not climb far after the breakout? I have highlighted 2 overhead resistance zones. The top one looks strong enough to turn back most advances because it's wide and flat. The lower one is a solid block in late June but it's short. It extends back to April, but April is looser looking. Tighter is often better than loose. I measured this. Before the April to August price bump, the stock was in a long-term decline. A block of horizontal price movement appeared at 17.50 that was 3 months long, not shown, if you include some minor lows. Thus, the reason the eve and eve pattern failed to rise was overhead resistance coupled with a deteriorating fundamental picture. I like to know what is going on in the stocks I follow. I keep a database of events and can match an event to the price action. The company released earnings on both sides of the April/August price bump. The first release helped power price up, and the second helped cut it down. During creation of the eve bottom, news appeared that machine tool orders were soft, down 2% month to month, and down 30% from the prior year. Coupled with increased foreign competition and insider selling, the fundamentals were turning bad. That information did not help the technical picture. Statistics. Table 29.2 shows general statistics. Number found. I found 1,093 patterns in 675 stocks from September 1991 to February 2020. Not all stocks covered the entire period, and some stocks no longer trade. Because bear market samples didn't rise to the threshold I set for this edition, I don't include them in this presentation. That's why I show fewer than 1,000 patterns in the table. Reversal, R. Continuation, C. Occurrence. Because price enters the chart pattern from the top and exits out the top, the pattern acts as a reversal of the downward price trend, by definition. Average rise. The average rise in bull markets is one of the better performances I have seen for chart patterns. Standard & Poor's 500 change. The strong general market upswing 13% in bull markets helped carry along the chart pattern's average rise 50%. I can't say whether that's really true, but a rising tide lifts all boats. I'm beginning to dislike that cliché, though, because I use it too much. I guess it wouldn't be a cliché if people like me didn't use it. Days to ultimate high. How long does it take price to top out? Answer: about 7 months. If you want to reach the ultimate high, it will take a long time for a stock to rise 50%. The duration is an average, though. The median is just 71 days, about 10 weeks. How many change trend? Out of 39 chart patterns, the eve and eve double bottom ranks 8, where a rank of 1 is best. I like to see values above 50%, and this chart pattern far exceeds that. By the way, I added this measure to count how many double bottoms see price rise more than 20% after the breakout. It was my attempt to determine if a chart pattern led to a sustained trend. Table 29.3 shows failure rates for double bottoms. Let me give you some examples of how you read this table. In bull markets, 12% of the patterns failed to see price rise more than 5% after the breakout. 23% didn't exceed a 10% rise. Notice how failure rates nearly triple to 32% from 12% for rises of no more than 15%. Half the patterns will stop climbing before reaching 30%. This alarming progression of failures is typical for all chart patterns. It emphasizes that making money using chart patterns isn't as simple as buying the first one you see. Table 29.4 shows breakout-related statistics. Breakout direction. By definition, the breakout is always upward from a double bottom. If the double bottom breaks out downward first, close below the bottom of the lowest valley, then it's not a valid double bottom. Yearly position performance. Where are the best performing double bottoms located? The performance numbers are closer than I expected, but it's clear that you want to avoid patterns with breakouts in the middle third of the yearly high-low price range. Throwbacks. Throwbacks occur about 2/3 of the time. They give investors another opportunity to take a position in a stock or to add to an existing position. When price does throw back, it takes 12 days on average from the stock to return to the breakout price. That suggests price peaks in less than a week, which it does, 6 days after rising 8%, and then drops back. Notice that patterns having a throwback pay a penalty for performance. After a throwback completes, price resumes rising 72% of the time. That means the other 28% continue lower, so there's a risk when a throwback occurs. Gaps. Breakout day gaps help performance in bull markets. I measured performance from the opening price the day after the gap to the ultimate high, so even if you miss owning the stock when a gap happens, you can still participate in the better performance. The numbers are averages, so your results may vary. Table 29.5 shows pattern size statistics. Height. The results surprise me because tall patterns usually perform significantly better than short ones. That is still true, but the performance difference is minimal, 1 percentage point. To use this result, measure the double bottom's height from the highest high between the two bottoms to the lowest low in the pattern, and then divide by the highest high, the breakout price. If the result is smaller than the median listed in the table, then you have a short pattern. The median values, 31% rise for tall patterns versus 24% for short ones, show a bigger difference, so checking for height is a task you should consider. Trade only tall patterns unless you have good reasons for doing otherwise. Width. I measured the pattern width from lowest low in the left bottom to the right bottom low. Those patterns wider than the median performed substantially better than narrower ones. I've been seeing that trend in many patterns, that is, wide patterns beating narrow ones, but the indicator isn't as good as height in predicting future performance. Height and width combinations. If you look at the table and see tall patterns perform best and wide patterns perform best, you'd expect the combination of tall and wide to beat the performance of the other combinations. But that's not what happens here. Short and wide patterns come in first place and tall and wide place second. You'll want to avoid tall and narrow ones, though they perform worst. Table 29.6 shows volume-related statistics. I removed volume shapes because for wide patterns, volume often formed different shapes within the pattern, and determining the actual shape was too subjective. Volume trend. Volume trends downward most of the time, but don't discard a chart pattern simply because it has a rising volume trend, rising/falling volume. Indeed, a rising volume trend Eve and Eve double bottom shows slightly better performance than one with falling volume. However, the difference may not be statistically significant. Breakout day volume. Many technical analysts will say that heavy breakout volume suggests strong performance, and you should avoid patterns with light breakout volume. These statistics say the opposite, that patterns with breakout day volume below the 30-day average show better performance. Table 29.7 shows how often price reaches a stop location. I split the double bottom into pieces half, really, and found that if a trader placed a stop at the bottom of the pattern, the stop would trigger an average of 2% of the time. The other two locations show higher hit rates. You can use this information to help you decide where to place a stop, or if you should even use a stop. Just remember that a stop too far away may entail a substantial loss. You might take the time to convert the potential loss into a percentage of the current price, divide the two and multiply by 100. If the percentage makes your hair stand up, be thankful you still have hair and consider adjusting your stop placement. Table 29.8 shows the performance over 3 decades. Here's where the ride gets bumpy. Performance over time. The 2010s showed the worst performance and the 2000s the best. I am concerned that the most recent decade had the worst performance. Does that mean performance going forward will struggle too? Failures over time. Here the differences are startling, with failures tripling in the 2010s from the prior decade. Note that I removed the bear markets from all of the numbers in the table. Bear markets only happened in the 2000s. Failures, by the way, are a count of how many chart patterns failed to see price rise more than 5% after the breakout. Table 29.9 shows busted pattern performance. I prefer to see bearish patterns bust, not bullish ones, as in the case of a busted Eve and Eve double bottom. Busted patterns count. 1 of every 5 double bottoms will bust. That means price will rise no more than 10% before collapsing and closing below the lower of the 2 bottoms. Busted occurrence. Single busted patterns happen most often, which is typical. If you're confused about what a single, double, or triple plus bust means, consult the glossary. There, I have included a picture for your viewing pleasure. Don't forget to bring the popcorn, busted and non-busted performance. I used Eve and Eve double tops to gauge the performance of non-busted patterns. Only single busted double bottoms outperformed the non-busted counterparts. Trading tactics. Table 29.10 shows trading tactics for Eve and Eve double bottoms. They are the same as for other double bottoms. Measure rule targets. Use the measure rule to predict a target price. Having a target to aim at may allow you to get out near the peak. If price nears the target, evaluate the situation. Will price continue moving higher, or is there a larger likelihood of a drop? To find the price target, compute the height of the pattern by subtracting the lowest low in the bottom from the highest high between the two bottoms. Add the result to the highest high to get the price target. For example, figure 29.6 shows an Eve and Eve double bottom. The lowest low in the pattern is the left bottom at 14.27. The highest high is 18.39, the breakout or confirmation price. Add the difference, 4.12, to the highest high to get a target of 22.51. In this example, price rose to only 20 before dropping. You can use table 29.3 to check the probability of your stock reaching the target. In this example, a move of 4.12 from the launch point of 18.39 means a 22% rise. If we ignore that the double bottom shown occurs in a bear market, Table 29.3 says that 39% of Eve and Eve double bottoms will fail to see price rise more than 20%. It's probably more like 41% will fail to see a 22% rise. It also means 59% or so will succeed. The trade has a lot of risk, and it's up to you to decide whether to take that risk. The bottom portion of the table shows how often price will reach the target. Using the full height, as in our example, price will reach the target 66% of the time. Use half the height or 3 times the height and the likelihood of success changes, as the table shows. Wait for breakout. Even in bull markets, trying to anticipate a bottom by buying a stock simply because it seems cheap is not a good strategy. Tomorrow, the price may be cheaper. By next week, the company could declare bankruptcy. With double bottoms, waiting for price to close above the confirmation price is a good way to trade. You can still lose money, but that is the way to bet. Trade with market trend. Let the smart money trade against the prevailing trend. You should follow in their footsteps only after they have cleared a path through the landmines. In other words, trade with the general market trend. Buy bullish chart patterns like double bottoms in a rising stock market. Avoid going long in bear markets. Check others in the industry. If other stocks in the same industry are doing well, then that bolsters the case that your double bottom will break out upward, reversing the downward price trend. If other stocks in the same industry are showing bullish bottoming patterns, or if their stock price is rising, then trade the double bottom. If price in other stocks is breaking down, making lower lows, then look elsewhere for a more promising situation. Double bottoms are plentiful. Keep searching. Stop location. Table 29.7 can help with stop placement. Be sure to convert the potential loss as a function of the current price into a percentage. Try not to gasp if the result is big. You'll wake the baby. Table 29.11 shows special performance features of double bottoms. Bottom-to-bottom variation. Do double bottoms with small price variations in their bottom lows perform better than do those with large variations? No. Large variations see better performance than small ones. To get this result, I computed the price difference between the bottoms of each double bottom and then found the median of all patterns studied. Those with bottom-to-bottom price differences higher than the median were termed large, lower than the median were termed small. Lower bottom. When the left bottom was below the right bottom, performance improved after the breakout. The performance difference is marginal though, just 2 percentage points. Still, an edge is an edge. Experience. Let me tell you about what I found in my trade review. Guess Inc. In the spring of 2003, Guess Inc. Jess started making a run for the moon. It climbed from a low of 1.65 to 9.79. That was a warning that the stock would move sideways to rest for a spell. Because the stock rose by almost 6 times, the likely horizontal move would last for months. Lesson: if a stock makes a significant climb, expect a sideways move of extended duration, proportional to the height of the rise. I don't think I knew that then, and if I did, I ignored it. The stock formed an eve and eve double bottom in the rarefied atmosphere near 7. The stock confirmed the double bottom at 8, and I was there with cash in hand, ready to give it to the smart money. From my notebook, 18 June 2004. Filled at 8.065. Stop, 7.29 for a loss of 10%. This is below the minor low on 4 May 2004. Upside target, 9.92 for a 23% rise. I expect price to stall near old high, say 9.25. Mood will trade work, bought too soon, excited but cautious. I don't expect this to work out well. I think the market is about to tumble. Buy reason, EDB. The apparel market seems to be doing well. In the last few days, the stocks have moved higher strongly. Many are like this one. They've reached a yearly high, then backtracked and are struggling to recover. The bad news is that it has a PE of 50. Ouch. I have my doubts about this one working, but if the market continues to climb, this might do well too. I placed the stop with my broker and watched as the stock threw back to the breakout and continued lower. It hit my stop and filled at 7.28. A day after I sold, the stock bottomed and completed a triple bottom, which later confirmed as valid. However, the stock only climbed as high as 9.17, 8.5% above confirmation of the triple top, before dropping below 6. So it wasn't a big gainer either. I made a perfect entry but either sold too soon. I could have let price climb up to confirm the triple bottom or sold too late during the double bottom throwback. I lost 10% on the trade. I think the real key to this trade was the lesson stated earlier, that of knowing price was going to rest after a strong uptrend, which it did, for about a year. CH Energy. I was sorry to see CH Energy, CHG, stock stop trading when it was taken over by another company. I like the dividends the electric utility paid, and capital appreciation sweetened the deal. This is one of those trades where you don't try to do what I did unless you're an experienced trader. On 3 June 2010. I bought because this has bounced off what I consider a forming double bottom low, yielding 5.7%, and I have lots of cash that's just sitting there earning zip. I bought it for the yield. If you look at the chart, you'd see the eve and eve double bottom clearly on the chart, bottoming after the 2007-2009 bear market. I bought as the second bottom was forming, so I got in well before confirmation. Lesson: don't try this at home. Often waiting for confirmation is the correct approach. After I bought, the stock climbed. It looked like a rising staircase with no huge plunges to frighten the children. On 5 April 2011, I placed a limit order to sell at 52 and it filled. Apparently 52 was my target. From my notebook, sell reason, hit target. Since the stock is moving up, I decided to sell only half my position. On the trade, I made 35%, including those tasty dividends. Even better, the stock peaked the next day and dropped down to 48 and change about a week later. I love it when the stock later shows I was right to sell. However, in this case, the decline was short-lived. It moved sideways in the mid-50s for the rest of the year and then jumped to the mid-60s during the takeover. Cypress Semiconductor. The trade in Cypress Semiconductor, SI, I would call a mistake, and that's good because it gives me something to write about. The stock started trending higher from the September 2004 low and formed an eve and eve double bottom along the way. This double bottom acted not as a reversal pattern, but as a continuation. They look weird because they don't have a left side that towers above the pattern. I like to see the left side be above the top of the peak between the two bottoms. In this case, the stock only made it about 3/4 of the way up. On 7 February 2005, I bought the stock, filled at 12.69. Here's my notebook. Stop, 11.05, just below the pennant in February. Upside target, 15.71. Future NASDAQ direction, guess. I expect the NASDAQ to stall at the knot of overhead resistance and turn down. That's not good for the stock, but it shows strong upward momentum, and I'm hoping the flag will support the stock. Buy reason, EDB. A strong breakout on Friday suggests an extended move, but I think the fundamentals are weak. This may throw back at 14 due to knot of resistance in June 2004. The 13-16 range is going to be a problem for this stock, May to June consolidation region, a MMD corrective phase. If the NASDAQ turns around continues up, this stock might do well. I chose this over Intel because of the book score. Intel has a 4 score and an upward breakout from a descending triangle. Lesson: never chase a stock. If you can't get in at a good price, wait for a retrace or look elsewhere for a better trade. Confirmation of the double bottom was at 11.83, and I bought the stock at 12.69, or 7% above the optimum entry price. Now, I wouldn't touch the stock until it behaved. Perhaps you heard me yelling for the exit 3 days later. I sold, and the order filled at 13.28. Sell reason: stock has made what looks like a tail. Time to sell before I give back more profit and the stock plunges. If you are familiar with candle patterns, the stock made a gravestone doji or shooting star. In non-candle terms, it was a tail or spike. The stock made a tall upward move, but ended the day near the bottom of the trading range, right where it began. Often tails, if followed by a lower high the next day, mean price has peaked and will head lower for a few days or longer. The key is, you have to wait to see if the price bar stands alone like a single tree atop a hill. In this case, it didn't. The tail was buried in a forest. The stock continued higher for about another 2 weeks. I made 4% in 3 days, which isn't bad if I could annualize it, do that every 3 trading days for a year. Lesson: if a technical pattern unfolds the tail in this case, wait for it to complete before trading. If the stock had turned lower, then this would have been a terrific exit. Unfortunately, that didn't happen. Also, tails that shoot lower are more reliable than those that shoot upward. Lesson: bullish tails' downward price spikes work better than bearish ones' upward spikes. Sample trade. Not all chart pattern trades work as expected, and figure 29.6 shows an example. To be sure we are dealing with a valid Eve and Eve double bottom, let us run through the identification guidelines. Is the price trending downward to the pattern? Yes. Although the figure shows a high in mid-January, the stock peaked back in mid-November 1999, not shown. Do both bottoms resemble an Eve bottom? The shape appears rounded in both bottoms. The left bottom comprises 2 minor lows, but if you exclude the first minor low shown as point A, the Eve assessment does not change. Rise between the bottoms is 29%, and the bottoms are 4% apart in price and 18 days distant, measured from lowest low to lowest low. This is one of the narrower Eve bottoms, but it is still fine. Volume is higher on the right bottom than the left in bear markets. This observation suggests slightly better performance, a rising price trend, from table 29.6, but does not guarantee it. Price rises up to and closes above the confirmation price without first dropping below the right bottom low, so the breakout is upward. The pattern is a valid double bottom. What happened after the breakout? Price climbed enough to clear the confirmation line, then threw back and continued down. The stock reached a low of 4.24, recovered, and then dropped more, bottoming at 2.02 in February 2003, not shown, but ouch. If you bought at the breakout price and sold at the highest high, you would have made 9%, without deducting commissions or other trading costs. My guess is many traders would have lost money, perhaps a lot of it if they rode the stock down. What went wrong? Is this another case of overhead resistance? No. This is a case where the fundamentals take center stage. See that large gap on the left of the chart. 10 days before the gap, a brokerage downgraded the stock. The stock dropped, sure, but it hardly noticed the downgrade. On November 29, when the market was closed, the company announced that it would not meet its previous sales projections. When the stock opened the following day, price gapped lower, an exhaustion gap, closing 36% below the prior close. In short, the stock dead cat bounced. The bounce phase was the rounding turn before the double bottom, point B. A brokerage firm rated the stock outperform on the day it gapped lower. Such positive statements after a large down gap help drive the price higher in the bounce phase. However, the dire situation eventually catches the hype and the stock sinks, sometimes dramatically, like that shown here. Thus, even though we had a valid Eve and Eve double bottom, the fundamentals were screaming sell. I do not recommend taking a position in a stock showing a dead cat bounce for at least 6 months, sometimes even up to a year. Many chart patterns during that time look promising but fail to perform as expected. This is one example. Chapter 30, Double Tops, Atom and Atom. Results snapshot. Appearance: 2 well-defined peaks, narrow, pointed, and separated in time but near the same price. This is the first of 4 chapters covering the various combinations of Adam and Eve double tops. An Adam and Adam double top is a twin peak chart pattern, but not just any 2 peaks will do. Adam peaks are narrow, inverted V-to-S, and sometimes have a long, one-day upward price spike. Volume is heavier on the left top than the right, usually. The results snapshot shows the performance results. The average decline measures 15%, placing the performance rank of 19 out of 36, where 1 is best. That's almost midway in the list. Pullbacks occur in about 2 of every 3 cases. The percentage meeting price target uses the full height for the measure rule computation. In the trading tactics section of this chapter, I give an example of how to use the rule. Tour. Figure 30.1 shows an example of an Adam and Adam double top. Notice how the twin peaks look similar both in height and width. Price shoots up like a rocket in a 1 or 2 day spike and then returns to the launch pad. The width at the base of the top is comparatively narrow. The top is not rounded, looking like you see in Eve tops. In a way, each top looks like a hypodermic needle. The twin peak pattern becomes a true double top when price closes below the confirmation line, or price. Qualification is important, as an earlier study I did found that price continues rising 60% of the time without confirming the twin peak pattern. Thus, always wait for confirmation unless you have valid reasons for trading earlier. Volume is usually higher on the left top than on the right. That is what you see here, but it's hard to tell on the chart. I used linear regression for trend analysis, so I didn't have to guess. Identification guidelines. Double tops are easy patterns to find, but there are guidelines that help. I discuss them in a moment, but first, look at figure 30.2. The twin Adam peaks look similar, and that is key. If they look different, such as one wide and the other narrow, then you have an Eve and Adam or an Adam and Eve top. When they look the same, you have either an Adam and Adam or an Eve and Eve double top. The difference between an Adam top and an Eve top is their width and shape. Notice how Adam tops are narrow and pointed, looking like an inverted V. Look at the Eve top highlighted in February. See how it appears rounded and wide. The 2 Adam peaks confirm as a valid double top when price closes below the confirmation line. The confirmation line is the lowest low between the 2 peaks. Adam and Adam peaks and B are not part of a double top because price does not confirm the pattern. Instead, price rises above the higher of the 2 peaks, invalidating the double top pattern. Figure 30.3 shows another example of an Adam and Adam double top and an Eve top, not a good one, mind you, but it'll have to do. The Eve top is wide and composed of several short spikes, minor highs, and the group appears rounded. Adam tops are narrow, inverted V-to-S, usually composed of 1 or 2 day price spikes. Price climbs into the Adam and Adam pattern, forms the 2 tops, and drops to the confirmation line, validating the double top. In this example, volume trends upward, and that is unusual. Volume is also heavier on the right top if you bracket the peak with 5 days of average volume, 2 days to the left to 2 days to the right. Volume is usually heavier on the left peak. Table 30.1 shows identification characteristics for double tops. Consider figure 30.4 as we go through the table. Appearance. Look for price to climb into a twin peak pattern. The peaks should top out near the same price. After the double top, price should drop and confirm the pattern as valid. Price trend. Price must trend upward, leading to the pattern to qualify it as a top, not a bottom. The upward price trend can be short though, valley between tops. A dip should separate the 2 tops, making each top stand out as its own minor high. Do not select patterns that are part of the same congestion pattern. For this reason, the peaks marked in B in the figure are not part of a double top. Top-high price. The price difference between the 2 peaks is usually minimal, the median is 1%. The key is that the 2 peaks should appear to peak at or near the same price. The 2 Adam tops shown in figure 30.4, for example, have a 4% price variation. Top separation. How far apart should the peaks be in time? Some analysts argue that a month is the minimum, but I put no such limitation on the patterns I selected. However, be sure that the tops are distinct minor highs. Price decline after right top. The stock must decline to the confirmation price before you consider taking a position unless the situation warrants a quicker move. Sometimes, instead of confirming, the stock forms another peak, forming a triple top. If that happens, treat the pattern as a triple top. Volume. Volume is usually higher on the left peak than on the right. Linear regression on the volume from peak to peak says it trends lower from left to right. Breakout direction. A breakout occurs when price closes below the lowest valley between the two tops. The breakout is always down, or else you're not looking at a valid double top. Wait for price to close below the confirmation line before trading a stock showing a double top. Focus on failures. Double tops have two types of failures. The first is one of identification. You must wait for price to close below the confirmation line. Only then does the twin peak pattern become a true double top. You can try trading the pattern before price drops to the confirmation line, but if you are shorting a stock, you will probably take a loss when price soars away from you. Do the smart thing and wait for price to close below the low between the two peaks before trading. The second type of failure is what I call a 5% failure. That means price confirms the pattern and then drops no more than 5% below the breakout price before rebounding. It happens more often than I like to see, so be prepared and use a stop to limit the loss. Consider figure 30.5, a double top that obeys the identification guidelines, including closing below the confirmation level. The uphill run starts in May 1992, not shown, and peaks in the first top during March 1993, representing a rise of over 60%. Price retraces the gain for a month before gathering steam and trying for a new high. It succeeds at the beginning of June, when price crests the old high by 63 cents. However, the celebration is short and price tumbles. It drops over 20% before meeting support at 26. The new low is below the double tops valley between the two peaks, the so-called confirmation price, but the stock quickly turns upward. Price climbs at a smart pace and does not stop until it touches 39 not shown. That is a 50% bounce off the low. If you sold your shares when price closed below the confirmation level, thinking the stock would continue down, you would have walked away from a chunk of money, that is, holding onto the shares and seeing price rise 50%. The failure of price to drop more than 5% below the breakout is what I call a 5% failure. Price breaks out downward but fails to descend by more than 5% before turning around. Unfortunately, 5% failures are plentiful for atom and atom double tops, ranking 21 out of 36 patterns, where one has the lowest failure rate. Speaking of numbers, let's talk about them, shall we? Statistics. Table 30.2 shows general statistics. Number found. I discovered 1282 patterns in 656 stocks starting from July 1991 to March 2020. Not all stocks covered the entire period, and some no longer trade. Because few patterns appeared in bear markets, I removed them from this edition. The number found reflects that change. Reversal/continuation performance. Since we are dealing with tops and the breakout is downward, all patterns act as reversals of the upward price trend by definition. Average decline. The average decline measures from the breakout to the ultimate low, which is the lowest low before price climbs more than 20% or closes above the highest peak in the double top. Standard and Poor's 500 change. Despite including only bull market samples and using the dates of the double tops breakout to ultimate low, the S&P dropped 4%. That decline helped suck price lower. Think of a rising tide lifting all boats. No, that's not right. A receding tide strands fish, so that doesn't sound right either. I'm sure you can figure out a suitable metaphor. Days to ultimate low. In other chapters, I found that price drops twice as fast as it rises, so this pattern reaches the ultimate low in about 7 weeks, covering an average drop of 15%. What that means is you can make more money shorting in a quicker period than going long and waiting for price to rise. Of course, it also means you can lose money faster. How many change trend? For upward breakouts from bullish patterns like double bottoms, I like to see more than half of patterns clear a 20% rise. For downward breakouts, like you see from atom and atom double tops, I don't have a good sense of what's a decent number. If you're going to short a stock showing a bearish chart pattern, then obviously you'll want to see a monster number on this item. It's a tally of how many patterns see price drop more than 20%. Table 30.3 shows failure rates for double tops. The bull market starts out with a high failure rate, break-even, and it almost doubles in the next row down. The losses are painful. Let me explain with examples. 25% of atom and atom double tops fail to see price drop more than 5%. That's a lot. The next row down shows that 46% will fail to see price drop more than 10%, and so on down the list. If you are considering shorting this pattern, then maybe you should reconsider. Table 30.4 shows breakout-related statistics. Breakout direction. The breakout direction of choice is downward. How often? All of the time. That's by definition. A breakout occurs when price closes below the lowest valley between the two atom peaks. As the identification guidelines explained, if price doesn't close below the confirmation price, then it's not a double top. Yearly position performance. The performance difference for bearish patterns doesn't vary much depending on where in the yearly high-low price range the breakout appears. We see that in the table. It does indicate, however, that you should avoid shorting a stock within a third of the yearly high. Does that advice make sense? Consider that there's a reason a stock is making new highs and another stock is making new lows. You want to short weak stocks, those making new lows for a reason, not those you believe are overvalued and ripe to tumble. A rising price trend can continue longer than you expect, sometimes for years. Pullbacks. A pullback happens almost 2/3 of the time. That's about the rate we see for both throwbacks and pullbacks, oddly enough, and that's reassuring. Only pullbacks apply to double tops, so don't let me confuse the issue with facts. It does not take long for the stock to return to the breakout price, 11 days on average. When a pullback does occur, it hurts performance, as the table shows. I think that's because the upward curl of a pullback robs downward momentum, eventually hurting overall performance. Don't quote me on that because it's only a guess. After a pullback completes, price continues to drop 54% of the time. Gaps. A breakout day gap does give better performance on average, but not so you'd notice. However, the gap size is painful compared to some other bearish chart patterns with gaps. Table 30.5 shows pattern size statistics. Height. Tall patterns perform better than short ones, and the difference for a bearish pattern is surprisingly wide. And that's coming from an author who abhors adverbs. I determined height from the highest peak in the pattern to the lowest valley between the two peaks. I divided the height by the price of the lowest valley. The results for all atom and atom double tops measured this way I show as the median in the table. A value above the median means the double top is tall. Width. Wide patterns perform better than do narrow ones, but the performance difference isn't big. I used the median width as the separator between narrow and wide, height and width combinations. The table shows the performance results when combining the height and width traits. Patterns that are both tall and narrow perform best by seeing price decline most after the breakout. The table also shows that you should avoid short double tops. Table 30.6 shows volume-related statistics. Volume trend. I used linear regression to determine the volume trend. I found it recedes as measured from the left peak to the right one. However, that's only true 59% of the time, so allow variations. Do not discard a pattern because it has an unusual volume trend. Rising/falling volume. Double tops with rising volume performed slightly better than did those with falling bottoms, but not so you'd want to stand on the rooftops and yell, "Eureka!" Breakout day volume. Many traders will swear that heavy breakout volume adds to the reliability of a pattern. Some technicians demand it, but have they proved it? The table shows what I found, and it's a yawn. Heavy breakout volume does help, but only by 2 percentage points, and that's if you trade it perfectly and often enough, over 1,000 times. Table 30.7 shows how often price reaches a stop location. I split the pattern in half but used anesthetic. I found, for example, that a stop placed at the top of the pattern triggered 3% of the time. However, if you were shorting the stock, the stop might be too far away to be tolerable. Perhaps you'd like something closer. If so, the table shows the hit rate for 2 other locations. Table 30.8 shows the performance over 3 decades, performance over time. The 1990s showed the best performance, with the other 2 decades tied for second place. Failures over time. This is what I like to see, numbers that show a trend. In this case, the failure rates have increased from a low during the 1990s to almost double that in the past decade, the 2010s. Oops, that's not really good news for chart patterns, is it? Table 30.9 shows busted pattern performance. Busted patterns count. Almost half of downward breakouts will bust. That's huge. Busted occurrence. I sorted the patterns by how many busts they showed. Single busts came in first place, but triple or more busts came in second. That may sound odd, and it is, but other chart patterns show a similar trend. Busted and non-busted performance. I used atom and atom double bottoms as the proxy for a non-busted double top. That is, one with an upward breakout. There's no such a thing, hence the substitute. This instance is one of the few cases where the non-busted double bottom beats all combinations single, double, and triple plus and single busted patterns. It suggests that you do better trading bullish chart patterns, not bearish busted ones. Trading tactics. Table 30.10 shows trading tactics. Measure rule targets. Use the measure rule to predict a target price. To use this, subtract the lowest low between the two highs from the highest peak in the pattern, and then subtract the result from the breakout price, the lowest low between the two peaks. The result is the target price. For example, in figure 30.7, the highest high is the left peak at 35. The lowest low is at 24.88. That gives a height of 10.12. Subtract the height from the lowest low to get a target of 14.76. If the result is negative, then ignore it. Price cannot decline below zero. The bottom portion of the table shows how often the measure rule works. For our full height example, we see price will reach the target 64% of the time. Cut the height in half or use another height, and the probability of success changes. Consider changing the predicted decline into a percentage, then looking up the failure rate in table 30.3. In this example, the decline from a breakout of 24.88 represents a loss of 40%. Does that sound reasonable? Correct answer, no. Table 30.3 shows that 91% of double tops will fail to drop more than 35%, which is short of the 40% target, of course, but it's closest in the table. Thus, the target price is too far away, and you should choose a more conservative, closer one. Wait for breakout. Usually, it is best to wait for the breakout when price closes below the confirmation line before trading this pattern. If you do not wait, chances are price will rise 60% of the time in bull markets instead of dropping below the confirmation line. The sample trade shows an example of how to ignore this rule and make more money. Trade with market trend. Trade with the market trend for the best results. Since this is a bearish pattern, you will have more success shorting a stock if the general market is also trending down. It need not be in a bear market because price can rise in a bear market too. Just be sure price has been trending down. I use 1, 2, and 6-month trends in my checks. Check others in the industry. Other stocks in the same industry can give a vital clue to performance of the stock you want to trade. If other stocks are going down or showing signs of topping, then consider a short sale or selling a long holding. Look for a stock that turns down first followed by the others. For example, Lowe's reports earnings a few days before Home Depot, but this could have changed. I haven't checked in years. When Lowe's reported soft earnings, that also hurt Home Depot stock. Home Depot dropped even more when it reported the same problems, soft lumber prices, and weak results. Look for which stock turns down first, and see what happened the last time they all dipped, perhaps during the same month in prior years. Seasonality. Stop location. Table 30.7 can help you determine where to place a stop to avoid it being hit while still doing its job to protect your assets. Be sure to change the potential loss into a percentage of the current price to see if the loss is reasonable. If it's not, a stop placed 8% away is common, then select a different location. Don't put it so close that you are guaranteed of being stopped out. A volatility stop can help you decide. See the glossary. One person emailed me saying he used a stop that was like 1% away. He was being stopped out for small losses continually. No kidding. He wasn't able to tolerate a larger loss. Don't fall into that trap. Be sensible with stop placement. Table 30.11 shows special features of the atom and atom double top. Top-to-top variation. Does the price variation between tops suggest better performance after the breakout? Yes, if there's a large variation more than the median 1%, then performance improves in the double tops I looked at, and the performance differences are wide enough to pay attention to. Lower top. This measure is a letdown. The performance difference between which top is lower doesn't make a big performance splash, just 1 percentage point. Yawn. A lower right top showing better performance makes sense to me. Why? It tells me the situation is especially weak, that price can't even make it up to the old high. Experience. Maybe I was trying to be cute and pretended I could pull a rabbit out of a hat with this trade in Phillips Petroleum, now called ConocoPhillips Cop. Figure 30.6 shows the damage I caused. The stock made a strong push up to the atom and atom double top at AB. The stock confirmed the pattern as valid when it closed below C. That happened at D. Price behaved itself and slid down to E in a nice strong push before pulling back to F. However, at G, I bought the stock and helped push it higher. Here's my notes for the entry. 16 April 2002. I bought at market, filled at 29.92. The book score for the double top is 9, suggesting a weak formation that won't decline more than 12%, the median for OTS. A 12% decline would put the low at 26.74. That could happen as earnings are due out shortly and are expected to be weak. However, it's already been pre-announced, and I believe the stock will recover and return to old highs. I think the worst in refining margins are here now or are already behind us. Also, the Otter one-day reversal on 12 April 2002. E, as far as it appears on my screen, suggests a rebounding stock price as in the February 2002 decline. J. This stock pays a dividend, too, 2.4% at current prices. Money markets are at 1.0% now. The book score I'm referring to is from my book, Trading Classic Chart Patterns, Wiley, 2002, and it introduced a scoring system for chart patterns. Price moved horizontally for a time, creating a rectangle top pattern at F, the two horizontal trend lines. Lesson: sell if a chart pattern breaks out downward, especially if the technical and fundamental reasons support a sale. The rectangle was the perfect exit for this trade and would have saved me money. The correct sell location was I, the day after the downward breakout. On 3 June, the price bar to the left of J, I wrote more in my notebook, support zone at 30 has now been busted through, and stock is declining. I don't think it'll hit the median decline for an odd of 12.4% to 26.74. I could sell now with a 3% loss. Support is difficult to see in this chart. SAR form thingy shows best support at 27.50. If the stock closes below 26.50, then sell it, a 10% loss. Otherwise, collect the dividend. The notebook entry confirms that I knew about the stock breaking through support, but thought of round number 30 as support. On 15 July H, I threw in the towel and sold the stock. This stock has tumbled along with the market below the stop price, so I sold, filled at 25.81, well below the mental stop price of 26.50. Ouch. The refining industry is in the dumps and the market is taking everything down. Even its dividend couldn't support it. A mental stop is one kept in your head. In situations like a day trade where you need to get in and out fast, mental stops are invaluable. In cases like this trade, not having it in place can mean selling below the exit target. Lesson: use a hard stop, a stop-loss order placed with your broker, instead of a mental stop unless speed is needed. The lessons in this trade cost me 14%. Notice the October low at K. That was the bottom for the stock. From there, it climbed all the way up to 95.96, a gain of 436%. I had the right idea about this trade, but my timing was off by about 6 months. Sample trade. Since I trade from the long side, let me give you an example of how to use a double top defensively. Say you own the stock in figure 30.7. How do you trade this one? You hold on like an amateur investor, or do you dump at the first sign of weakness, like a swing trader? The answer depends on several factors, such as taxes, industry, and market outlook. Sometimes it may be wise to ride out the decline. Say you bought the stock at the February low, 19.25. At the first atom top 35, you made 82%, nearly a double. Watching the stock drop to the confirmation line must have been painful. That drop took price down to 24.88, a decline that reduced your profit to just 29%. Look what would have happened if you sold the stock the day after price closed below the sell trend line. That would have gotten you out at 29.94 for a profit of 56%. I recently sold a utility stock because it shot up like the rise to point A. Since a quick decline often follows a quick rise, I was willing to sell my stock for a $7,000 profit, plus over $1,300 in dividends, because I did not want to give back thousands. I will miss the 5.3% yield at a time when money market funds are paying just 0.3%. The stock has declined since I sold it. Points A and B are called spikes or tails. Point A is especially good because the price closes near the daily low. That is important. Look for a long price spike with a close near the daily low. For the first atom peak, if you sold the day after the spike, you would have made 62%. If you sold at the close the day after points B and A, you would have made 55% and 40%, respectively. Those are good gains regardless of how you slice it. Most amateur investors may have held onto the stock and wrote it back down. As it bottomed at the confirmation line, they may have sold, some did, as the slight rise in volume suggests. Others held on, vowing to sell if price reached the old high. When price climbed and approached the old high, their tune changed. Their desire to sell melted into greed. Why sell if the stock is going up? Good point. But you have to sell sometime. Price fluctuations may shake amateurs out, or they may turn stubborn and hold on, this time riding the stock down to the confirmation point. That is when the twin peaks turn into a valid double top. That is also the time to sell. Placing a stop-loss order at the confirmation line means your position sells without your having to worry about it. In this example, a second sell trend line would work well when price closed below it in September. If you sold at the close the following day, you would have made 50%. That is much better than the 29% gain when selling at the confirmation line. Am I advocating selling before confirmation? No. Every time I have done that in a double top, the stock never confirmed, and I gave up profit because price made new highs. Still, you can increase your profit by taking shortcuts to selling, as the example shows, using trend lines, for instance. You can always buy back in if price does not sink to the confirmation price. The choice is yours. If you are just days away from changing a short-term gain into a long-term one, it may be wise to hold off selling. I did something similar by waiting 3 days to push a trade into a new tax year, shifting income. By delaying, I changed a 40% profit into a 27% one. Oops.